right, welcome in. This is Benzinga's Future of Digital Assets stage. We will be here all day. We have a fantastic lineup. Renato's going to go into it a little bit. If you don't know Renato, you really should. I'll let him introduce himself, but he has been helping us curate these agendas, curate the content around fintech, around digital assets for Benzinga for years. For forever. But everybody, my name is Elliot Lane. I'm the head of event sales and partnerships at Benzinga. And Benzinga, if you don't know, is a financial media company. We are for the individual investor. But beyond that, Renato, you had a few other things, on Benzinga that you wanted to mention before we get started.
Sure. How's it going, everyone? So, what a crowd. No. I joined Benzinga in 2019. I was super passionate about markets, but I couldn't get a job at a bank. So I was like, how do I get close to these people? And so I emailed the founder of Benzinga, who is Jason, who will be here later today, I believe. And I was like, hey, I'm super passionate, but I'll do anything you want me to do. And I ended up joining as a journalist, and I started hacking my way in, and I started interviewing a bunch of folks over the years, and I did end up working in markets and analysis and trading, but I always stayed at Benzinga some sort of way, but ended up building quite a network that we kind of leverage for these events today. And so today we've got the Future of Digital Assets and the FinTech Deal Day and Awards. Technically, those are separately branded events, but we're starting to bring them together. So, we have them today on the same day, just on the stages on top of each other. And in regards to the digital asset stage, really, when we first started this conference in 2022, I believe, it was very much focused on retail investors and trying to get them to engage and participate in kind of a smarter way. Over the years, we kind of grew up as a company, and you can kind of see that by the quality of content and these sorts of speakers that are going to be here today. And there's tons of thought leadership and a lot of institutions speaking, a lot of big names, whether that be a Moody's, a Citi, you name it. And we're just really happy to welcome them here today and see the interesting things that they have to say about the future of digital assets, right?
Absolutely. Couple housekeeping items, y'all. Please, if you're not, hop on Benzinga Connect, right? This is, at all of the Benzinga events, this is one of the more well-received activations for our events that you can participate in. You all can network, set up meetings. The networking tables are upstairs in the networking hall, in the exhibit hall. So you can network with each other, do business. The whole purpose of events is to meet people in person and get deals done, or at least start partnership conversations, right? Beyond that, some great education. We have a ton of people watching from home, so thank you all for tuning in. But beyond that, Benzinga Connect, if you have any questions about that, seek us out, and we're happy to help you get on. Beyond that, shall we get started? All right. Please welcome to the stage your moderator for the first discussion, Jason Lau, Chief Innovation Officer of OK Group. Please put your hands together.
All right. Good morning, everyone. Thanks for being here with us today. We've got an amazing panel to kickstart the day. We're going to do an overview of the state of digital asset adoption globally here in the US as well, but also take a peek around different sectors and see how things are going. I'm Jason. I'm Chief Innovation Officer at OKX. We're a crypto exchange and platform, operate globally. We'll pass it along quickly for some quick intros, and also tell me in one short sentence, how are you feeling about state of digital asset adoption? Keep it short and punchy.
Sure. So very glad to be here. I'm Rajiv Bamra, part of Moody's Ratings, and I oversee global strategy and operations for what we call Digital Economy Group. Why we call ourselves digital economy? Because we believe that the integration of the digitalization of assets with the traditional economy is going to be the future. And about the adoption, I can say that we are seeing the number of issuances in digital bonds and tokenized funds go up. So I will just throw some numbers before I pass on to Sandra. We've seen about 85 digital bonds be issued since 2017. The first one was, I believe, the World Bank, and these are all ballpark numbers, so don't quote me on this. The overall notional value is $18.5 billion, which compared to The real economy is a fraction, a tiny little decimal fraction of the overall economy. However, what we've seen in the last 12 months is about 45 digital bonds having been issued and of that 37 were issued year to date, which is about $7.5 billion. So the growth or the exponential growth of the issuance of digital assets by corporates, local governments, sovereigns, institutions just goes to show that the technology is here to stay and the adoption is going to sustain. It's just that there are few concerns and issues pertaining to interoperability and scalability, which I'm sure we'll be talking about later in the panel. Thanks.
Hi, everyone. Sandra Rowe. I'm the CEO of the GBBC, Global Blockchain Business Council. We represent more than 500 institutional members across 117 jurisdictions and disciplines. I just came back from a month out in APAC region, and I will say this. If we were running on just a handful of cylinders around the world, I think we're about to go into 2025 running on all cylinders. However, that does not mean we don't have blockers. In order to scale, what do we need? We need standards. We need commonality around not only regulatory frameworks coming out, but they actually need to make sense and work across region. This technology, as we all know, is global and borderless. And so we are being blocked by what I would call localized specificities and frictions. So I think that we will need to continue to work on. But with the US looking like it's turning the corner in certain aspects, I think the view around the world, at least what I got from APAC, is that everyone has been going guns a-blazing, basically, but the US now coming into the fray, if that's truly true, we're going to see a pretty dynamic 2025.
Hi, I'm Meredith Hannon. I lead business development for Wisdom Tree's digital assets business. And we are a global asset manager with two platforms, a retail platform and an institutional platform, offering 13 tokenized products, as well as a gold token and a stable coin, and very, very focused on, I'll just add 2 points to what Sandra was saying. I think what I'm excited about is really mainstream adoption. And I think all those pieces that Sandra was just mentioning are really critical to how we get to mainstream adoption. But I think more and more investors coming into this space is really going to power us. And how we do that is through really ease of access and making these assets easily accessible, but also safe, regulated, and through the standards that will really protect investors at the end of the day while still providing the underlying assets.
Hi, everyone. Greg Wysocki, Coinbase Institutional. I lead our hedge fund practice, whereby we have a prime brokerage unit that is a full qualified custodian and helping hedge funds move into the space, especially those that have a focus on the safeguarding rule and anyone that is sensitive to being in a qualified custodian. I'd say, yeah, pretty bullish right now. Our CEO, Brian Armstrong, I think what makes him so great is that he's got a very stoic, pragmatic approach to this industry. And he always says, it's never as good as it seems. It's never as bad as it seems. But right now, it feels like it's as good as it seems.
All right, thank you. So what I heard was we're generally feeling pretty good, especially heading into 2025. There are still some, we're still early. There are some blockers and risks, but being stoic, I think, is important because I've been in crypto professionally for almost 9 years now. And when you get too optimistic, you know, things never play out exactly the way you expect them to. So I think some caution is always great. Diving deeper into sort of this global landscape, Sandra, that you mentioned, especially in APAC, we had Singapore and Hong Kong have their fintech weeks recently. I was out in Thailand, heard some developments out there. I'm curious if there's anything you kind of share a few things with us here.
Well, first of all, I think most of the audience knows because they follow the global map. UAE has been absolutely dominating relating to attracting talent and companies. So has Singapore. Hong Kong is trying to come online. I think, unfortunately, they've got a bit of the anti-China hangover and China risk hangover that we'll see what happens into 2025. It is still a global market center. And you've got Japan, I would say is the one under kind of represented G7 country that is finally trying to get all their ducks in a row. And I think they're the one to watch if they get this right. So they've got a couple blockers, but I like Japan. We're spending a bit more time there. I think Korea still needs some work. But when I look at the global landscape, there's still like a couple hubs that you look at as the main centers. And I think it's actually interesting and easy to say Europe is this monolith, but even within Europe, I think you do have to pick some pockets. Yes, they've got Mika. By the way, the deadline's December 30th. For anyone who's reading stuff in the press that there's some kind of extension, I'm hearing from my guys on the ground, it is December 30th. There is no extension. So you might want to verify that on the ground. But the reality is the stuff is hitting reality. And I think what we will see is the regulatory frameworks that work in practice versus the ones that need further clarification and tweaking. So it's going to be fun. 2025 is going to be a lot of action.
Greg, Meredith, anything to say about the U.S. here? What do you guys feel and seeing?
I would say simply that we had the last 4 years with a major policy headwind, and it feels as if those headwinds are turning into very strong tailwinds. And when you think about all that this industry has accomplished under the prior regime and now moving into this new regime with actual help from the politicians and the rule makers, it's just very exciting as to what kind of innovation, growth, and investment we can see in this new regime.
And I would add, I mean, over the last 3 or 4 years, we've had a lot of success actually with registered products, both with the SEC, the CFTC, getting our New York Trust license. So we have had success there. It has definitely taken time. But what I'm excited about is, I think with MICA, I think with other areas of the world adopting regulation and implementing regulation, I think it also provides a path for the US to accelerate that, and where we'll see even more products come into the market, even more access. And I think that's what really, really excites me, is the speed that we can move at. I think will really accelerate now. Again, yet to be seen, but if you just look over the last 2 weeks in terms of what we've heard, even some of the news yesterday around Bitcoin reserves, I think we're going to see more and more adoption, but also the acceleration of those timelines, which is going to be an exciting year. Yes, for sure.
I agree with all of that was said, and I think we will see more and more public and private partnerships with pilots and projects like the RLNs and RSNs of the world, and also seeing a lot of sandboxes, which kind of at least is a step ahead by the regulators across the globe, where they are allowing the industry to innovate within a certain framework to make sure that in the meantime, they can find the correct guardrails and the correct frameworks to adopt. And also to what I think Sandra mentioned, we are already seeing a lot of influx into Middle East, and a lot of issuance, as I mentioned earlier, are also being seen in APAC and the European region. UK is probably following the EU in terms of bringing up their regulations, and potentially we'll see something happening in US next year as well, specifically noting CFTC's recommendation through their Digital Asset Committee recently about supporting the use of collateral, allowing the collateral mobility of tokenized assets. We are also seeing SEC kind of approving the exchange traded products, the funds for now, and then potentially we'll see some funds being used to drive the derivatives industry as well.
Sounds good. I think when we talk about regulations, a lot of this comes down to investor protection, right? And making sure the asset class needs to be accessible, but also those protections need to be in place. Meredith, you guys work with retail investors as well. I mean, what are you guys seeing from that specific sector? What are they? What sort of appetite do they have? Is it stable coins? Is it what do you see?
what's the benefit of a tokenized money market fund connected to a debit card? This is where instead of having cash sitting in your checking account, earning nothing, you can earn yield because it's a tokenized money market fund, and then you can swipe your Visa and you can pay for a cup of coffee. And it's that just incremental benefit to the end consumer that's really going to shift a usage and adoption in a way that the customer might not even know that they are using a tokenized product, but they're using their phone. And so therefore, it doesn't necessarily matter. When it comes to crypto, it's about access to a new asset class that they might not have had access before. And what we were talking about before the panel that I thought was really cool is you were giving an example around someone in Bangkok saying they bought $5 of Bitcoin, while my mom called me Sunday asking how she can buy Bitcoin. It's the same Bitcoin, right? Underlying from a liquidity perspective. This is the first time beyond fiat that we've been able to see that and showcase that from a democratization perspective. So I'm really excited about that. And I think that's where regulation plays in, is that investors are looking for the trusted, secure, regulated products to invest in, but it has to be a little bit better than what they have today in their brokerage account. I think that's what we can really deliver, especially in this new environment where everyone's very focused on the safety and security, but at the same time, what's that incremental benefit?
Greg, we were talking a little bit about Base earlier. I know Coinbase has done quite a bit pushing sort of USDC and Base usage, especially for retail. I don't know if you have anything to add on some of those efforts there.
Sure, yeah, and to Meredith's point, the whole idea here is to make this interoperable, and we'll be thinking about crypto, hopefully not talking about the inner workings of the rails and the actual engineering behind it, similar to what we did with the internet back in the late 90s, early 2000s. Coinbase is working really hard to just have, say, a username, similar to what you have with an email address, and for it to be totally interoperable with anyone around the world, and the ability to transfer value from one to another, I think is going to be the next step, and where it really gets crystallized for the rest of the world. This has largely been something that I think international retail people have understood better than the US for a lot of inflationary reasons. I think the US is now starting to understand that a bit more, just given our money supply has been growing 7% a year for the last few years. But I think the point is, we're going to reach a point where we're not talking about the actual engineering behind each of these blockchains, and that the ability to transfer value from one username to another is going to look a lot like email does today.
Can I just add and add on to the conversation here? I think, we're all generally very positive that we're going into a favorable 2025. I think from an industry standpoint, if I can even use that word, I think one thing we could do to not screw this up is actually take a moment and say to ourselves, how can we actually set the bar higher? How do we actually make sure we keep bad actors out? How do we actually ensure that we help regulators use the technology for their own betterment? Because frankly, a lot of them are using technology that frankly aren't fit for purpose to be able to do the effective oversight and monitoring that they need to be doing. So I think the question I would like to pose to the industry is, while we have this golden moment, which I think a lot of people think we do, how do we do better? And how do we actually make sure that we are at a place where we set the bar high enough that we do all the things that we just talked about? Because ultimately that means more opportunity, more money, and more profits for everyone. And I think that's something that should not be lost on folks as we go into 2025.
Yeah, one thing we talk to regulators and policymakers about, we do a thing called proof of reserves, where we show basically your on-chain assets are there and unmoved. And I think that's the power of the technology itself, right? The transparency that it offers. And I think we should be broadly as an industry adopting this technology for those benefits. Pivoting to institutions quickly, Greg, you talked to a lot of clients, Meredith, you too, and Rajiv, obviously. What's the sentiment here? How are people positioning themselves into this golden 2025? Anyone, feel free to jump in.
I'll kick it off. So I think the fact that Bitcoin has led this rally, I think, tells you very much that this has been an institutional-driven move, not necessarily retail. Certainly retail's participated, but even when you look at the market structure of Bitcoin and the way it's been trading and some of the moves happening around the market open, there's clearly a big ETF influence. But there's a clear use case for institutional investors that has actually been in place for a while. It's via basis trading, so shorting CME futures, long spot. That has grown quite substantially. It's one of the biggest trades in crypto, and as much as people have echoed, institutions are coming. They've been here in this trade for quite some time, and I think as we start to get more regulation, we start to see more ETFs, more futures contracts that are created. You'll see more involvement there, and then directionally, Bitcoin, I think, has widely been accepted by institutions as a real macro asset class. Even a year ago, I was on panels talking about whether or not we should even consider it as a macro asset. It's now the 7th largest macro asset, surpassed silver last week. And when you consider the fact that U.S. dollars and money supply is growing on average 7% a year, I think Bitcoin and where it fits within a portfolio is increasingly being tough to debate the other side of it. So institutions are extremely excited. Those that don't own it directly likely have some type of exposure via ETFs or futures. But when I started at Coinbase 4 years ago, we were spending a lot of time just trying to get in front of the right people at some of the largest asset managers and hedge funds, trying to figure out where this would fall under. Today, we have reverse inquiry. Everybody has to have at least a view on blockchain and on crypto. So it's getting too big to ignore. I think we've crossed that Rubicon.
And I would just add, those are traditional institutions and how they're adopting cryptocurrencies and digital assets. I think what we're so interested in is also there's a new cohort of institutions which are really, it's the DeFi community. So it's stablecoin issuers, it's DAO treasuries, it's crypto hedge funds, it's prime brokerages, it's the use of collateral. There's all these now new entrants into the market too who are using these assets in similar ways to what we've seen in the traditional markets, but also in new and different ways in terms of thinking about cross-border payments, thinking about the utility of money market funds to underpin these stablecoin reserves. So I think that's also been an interesting shift to see the broadening definition of what institutions are on chain, what that looks like, and whether they're utilizing crypto as an asset class within their portfolio traditionally, or whether there's this new entrant that's now taking traditional assets and utilizing them on chain. So I think we've seen that explode this year, and I think into next year it's going to be even more of an accelerant.
If I may add a comment on the retail investors part before jumping into institutional, and I may be at the cost of repeating myself. I think we need to find a Web2 wrapper for the Web3 applications in a way that's easy for the retail investors. Meredith's example and point for our parents or grandparents to be able to log on to an application and be able to invest in decentralized finance assets. It's very important to actually have onboarding processes that are simple and then access that is more democratized in nature. And I was talking to a tier 1 asset manager recently, and I was asking them what are they doing in order to solve the issue about accessibility to retail investors, because that's where the adoption is lacking. And they are testing digital identity within their own infrastructure and trying to see if that could solve the issue for a client who could log in or onboard once, but is able to then access other applications within or offered by that institution as well. So there are other solutions and POCs and pilots that are being tested that need to be expanded to institutional side as well. Talking about institutional risks and the investors that we are talking to and the demand we are seeing in the market is the quantification of inherent blockchain risks. That's all technical in nature. These are new forms of digital risks and some unknown risks that are now popping into the whole risk assessment portfolio, either of issuances or issuers. And we are trying to solve for that by trying to identify what kind of models need to be developed so that this qualitative data can now be quantified to give a black and white answer instead of a risk assessment output that is more gray, that is more in the gray area. So it's important to kind of solve for that in order to have the investors understand better about the technology risks on the assets, digital assets that they are potentially trying to invest into, but don't have enough knowledge or understanding of what risks underlie that asset if they go and invest into it. It's important from an education perspective to also do that. Other thing is that tokenization itself is not a solution to liquidity. It's a channel to offer liquidity, but then the whole markets around tokenized assets is also missing, which is a cause for concern in terms of wider adoption. And I think the market makers play a big role in kind of doing that. And based on the discussions we are having in the ecosystem, some of them are trying to solve for that as well and understand that's a cause of concern, which is currently, I think, lagging in the ecosystem and is causing that break between the primary and the secondary markets. And I'm sure we will agree that we don't have a stable settlement asset either. I know we are seeing stable coins grow by the second. I know their adoption is growing as well, which is great. But then the whole tokenized money market funds are another option that could potentially be used as settlement assets as well. And we are seeing tokenized deposits too. So the whole sales CBDC pilots and tests in APAC and EU are potentially going to solve for that too. So it's important to bring the value chain onto the blockchain or onto a digital platform end to end, which is going to help with that wider adoption.
Yeah, thank you. And we have just a few minutes left, so I'm just going to wrap and start with you, Sandra, on so what are you most excited about over the next 12 months? Name a couple things, 1 minute each, and let's see how it goes.
So the word I'm going to use is convergence. And the reason why I'm using that word is because when we can get crypto assets on the same rails or interoperable at least with real world assets, and then we solve for the digital cash leg, that is the holy grail. And frankly, we're starting to see that happen. We're not there yet, but to work towards that convergence in 2025 is what we'll be focusing on. And so we can just do away with conversations like crypto bad, blockchain good, I only do, tokenized assets. Like those kind of conversations just need to just go away at some point. And I think that's 2025 is convergence of all of these things, interoperable and seamless as possible and secure, so that people can get access and institutions can get access.
I love that because that's a lot of what we've built. And talk about ease of access with our retail app. So absolutely, I agree with that. I would also just add in terms of access and also interoperability, I think is key as well. As we were talking about various chains too, I think that's going to be a big key to figure out not only just when it comes to asset classes, but also the actual underlying liquidity, which will be really exciting. But I think mainstream adoption is definitely the one that I'm the most excited about. And I think it's definitely here. And I think there's going to be a really broad surge in the market. And we'll see what other factors come out, which it's never a dull day in this space. So
I'm going to go rapid fire. I think regulation just unlocks everything. We have rules of the road. It allows institutional investors to trade and own assets outside of Bitcoin and Ethereum, creates more dispersion, and just enhances market structure, which is much needed for institutions to be involved. Number two, stable coins. I think costs and infrastructure are at a place that we can now have mass adoption, cross-border transactions. It's going to be a very real, tangible use case. Number three, crypto as a new part of the capital structure. We saw during the FTX bankruptcy that FTT tokens actually held value through the bankruptcy process. That argues that there is value here, that it is a part of the capital structure. And then lastly, what are the risks? It's oftentimes when you can't identify the risks that market is most risky. I would say today, the risk that I see is that we go up too fast, and upside volatility slows adoption in some cases for larger institutional investors. But needless to say, it's a very bullish backdrop from where I sit.
I can use a minute. Just joking. All right. So we are seeing comprehensive and complex pilots across the board globally, and we believe that this is going to continue. It is time to move beyond POCs and pilots is what the industry talks about, but the importance of doing these industry pilots that are complex is solving for that production grade implementation. And why this is also helpful is because this is the partnership between the regulators, between the industry, between the blockchain and tokenization platform providers, and the collaboration and solving for interoperability between various networks and platforms is what we believe this economy is going to lead to. So what started as, let's say, digital islands working in silos are now we believe are going to evolve into digital archipelagos. And we are moving towards that platform economy, which will solve for scalability, security, sustainability, and privacy. That's my 30 seconds.
Awesome. I love how convergence, I think, is a nice word to kind of sum it all up in that interoperability aspect. It seems like there's just so much to be excited about going into next year.
We're trying to stay cool, Jason.
And there's also a lot to be excited about for the rest of today too. There's panels on real world assets, on stable coins, on infrastructure, on regulation and policy. So thank you to our panelists here today. Hopefully you guys got a good start to the day. Thank you.
Thank you.
Thank you.
Really appreciate you all joining us. As we transition to the next session, thank you, Jason, for being here. Really appreciate everybody joining us. We have 2 stages running most of the day, Future of Digital Assets and the FinTech Deal Day right above us. We have a little teaser before our keynote of the day. We have Herwig Konings, the CEO and founder of Security Token Markets, presenting a new project for a couple minutes, and then we'll bring out Mario and Grant for our keynote. So please put your hands together for Herwig as he comes up and joins us to present.
Hello, everybody. What a beautiful room. Thank you all for coming out here. I am so excited to be here and present something very special today that we've been working on for quite some time in stealth with a lot of different people. You're going to hear about it. But we're hearing from some amazing speakers. And first, I just want to get a pulse from the room. I got the mic, so I need you to participate. Who is pumped about crypto right now? Who's excited? What's going on? Raise the hands. Give me some excitement. Woo, that's what I'm talking about, all right? But you know what's even more exciting to me? Tokenization, right? The adoption of real world assets. It was very exciting over, almost 15 years ago when Bitcoin was created, this concept that we can decentralize finance, remove the fiat banking system that controls and has a moat over many unbanked. But unfortunately, I feel like the banks have done a pretty good job. We're seeing Bitcoin get adopted. But ultimately, there is still a strong infrastructure when it comes to capital markets. And that, as we are hearing today, and for many years now, is changing. And I am super bullish about this new concept of an operating system that is actually democratized, actually fair and inclusive, an opportunity to not only take advantage of instant transfer of value with real assets backed by them, but also for geographies all over the world, for assets all over the world. For different chains. It's an exciting time ahead. But again, I feel like we might be losing the narrative. So for those of you who don't know me, I'm Herwig. You can also call me Happy. But I've been in this space for over 8 years. Okay, I advised one of the first tokenized stock offerings in the United States back in 2017, 2018. I've helped over 50 different firms since then explore this concept. We have a company called Security Token Market. We've raised millions of dollars, had millions of people come to our platform, read our research. I've done 260 plus episodes every single week over the last 5+ years as a podcast to cover this space. So I'm a little biased, but I really believe in this technology as the future. But I'm really worried that there is a lack of focus around crypto natives, right? We're seeing a growth around capital markets. Once again, the banks, the asset managers, the same people who run today's infrastructure are rebuilding it using blockchain and forgetting the crypto natives and those who came into this space first. That's why I'm excited to reveal today an initiative that addresses this called the RWA Foundation. The team at STM, my business partner Mario, we were working very hard to figure out how can we reach crypto natives for RWA adoption. And when we look at foundations in crypto, they work great, right? They harness community, they are able to provide education, support, even grants and things like that. So we plan to copy the same model because RWAs are no exception. Just because they can be multi-chain, just because there are so many different applications, doesn't mean we need to unify this very fragmented community today. And that's why I'm excited to say we've got some of the biggest partners involved in today's launch. The biggest players like Securities, T0, INX here in the United States. In Europe, we've got Bricken and Archax. In Singapore, IXSwap and Shintai. We've got more major players like Maple, Mountain Protocol, Neoclassic Capital. We've also got the chains themselves, right? Avalanche, Polymesh, Providence, many others that are also looking to join or are already represented, like Binance through Bricken or Solana through MetaWealth. MetaWealth's a great real estate platform. We've also got Realty, Proppy, Steelwave Digital, and infrastructure. Credora, Particula, Chronicle Labs, the Oracles, everything we need to bring this community together. And what are we going to do for our community? We're going to come up with perks around all these partners. We're going to come up with airdrops related to RWA governance tokens, right? Because in order to decentralize the future operating system of capital markets, we need that component. And finally, last but not least, of course, we will be launching many more initiatives and programs and education and resources for this industry. So please take the time real quick to go to rwaf.xyz, rwaf.xyz. Go meet our mascot, Wally the elephant, and if you sign up for the wait list, you're probably going to be in for a good surprise down the road. So with that, everybody, trunks up and happy tokenizing.
All right, thank you, Herwig. Appreciate that. All right, y'all, we have a very, very fun, informative, educational fireside coming up. Please give a warm welcome to Mario Knopfel leading a discussion with Grant Cardone here for us on the future of digital assets. Give him a warm round of applause. Mario and Grant.
Test. Grant, how are you, sir?
Good, I'm good.
Never thought I'd see you on a crypto stage. Congratulations on you can't talk crypto without talking politics first. I don't care what anyone says. That's what everyone's talking about in the space. So first, a big congratulations to you and Elena. You've been didn't Elena do a GoFundMe for Trump?
Yeah, we were leaving. I was doing a real estate event for a bunch of mortgage brokers in Austin, Texas. We were flying home. The judgment, I think this was February, the judgment against Trump for $450 million had been passed, or whatever you call it, had been announced. And we were actually trying to buy $500 million worth of real estate right here in the city. And she says to me, go start a GoFundMe account for Trump. I said, I have to cancel these deals. I'm pulling out of New York because if they can do that to him, they'll do it to me. So I was canceling deals. While I was canceling the deals, she was starting a GoFundMe account to help his legal fees.
Did you face any pressure when you became a lot more vocal and supported Trump?
Pressure? What kind of pressure?
I don't know. You tell me anything at all. Any investors? Anyone telling you?
Sure. I mean, some people are like, oh my God, we have 17,000 investors with us that we've crowdfunded in our real estate activities, 150,000 customers in our education business every year. Sure, there's some people that don't like me, voicing my political opinion, but
and if anyone,
we do live in America, so I should be able to do that. And if the investor bails out, I'll replace him with another customer, another investor. There's no shortage of people on the planet. There's 8 billion people, and so you just keep communicating to the ones that want to play with you. I mean, that's the beauty of being in America. Like, and the politics and the business should be separate. If I have a good value proposition, a good offer, what do you care how I vote? Or if I vote? Like,
one thing I see in common, everyone that supports Trump, Elon is another good example. It's like that kind of attitude of, I just don't give a shit. Like, that's my opinion. It is what it is.
I mean, I do give a shit. I just gonna replace it with something that's a fit. Like it's a puzzle. Business is a puzzle. And the puzzle, I need to find the right pieces. And most of the time it's people. It's not mechanics. It's not, it's the people are the right. I have to have the right customer, the right investor, the right employees, the right audience for anything to work.
And before digging into crypto, like one thing, I actually want everyone to just go on your Twitter account, check Grant Cardone's account, check the first tweet up there. It gives you an idea of Grant's approach to any criticism.
I don't even know what the first tweet is.
You should check it out. So essentially, let me read it out. What Grant Cardone
it's probably
was team posted. So we should congratulate him on this. It is a pretty unique appointment by Donald Trump. I think it's the first tweet. Let me see. Oh, no, it was a while ago. It's the one that you were appointed as the head of some department. I thought it was the latest tweet. Last political question, because I kind of ask selfish questions first, and then we dig into RWAs and what you're doing in the space and when you got into the space. But the last question from a political standpoint is just your expectations in the States when it comes to crypto, but the country as a whole, under a Trump administration, especially with all the appointees that we saw over the last few days.
What's the question?
Your thoughts on it? How big of a change do you think that will lead to?
Trump is a marketing machine. He is number one first. He's a promoter. So he is, to me, what he's doing is he's sending a message to everyone. Here I come. And he's going to sell that message. He's going to market. He's going to promote it. He's going to brand it. And he's going to put people back. He's going to put the audience on their back feet, and he's got a tremendous amount of energy and force, and he uses it. So, everybody should market in a way that gets a lot of attention. I remember when he first had his plane at LaGuardia, he didn't keep it in a hangar. He kept it outside. And I always wondered, why is the guy keeping his plane outside? It's because people can see his plane outside. Southwest is rolling up every day. Like, you see the Trump name. So he's out there marketing, selling that name first. And I think that's what his cabinet's doing, is selling a message of strength. It's a new time, new moment. I think most of America wants something new, whether they voted for the guy or not. Most people are concerned about their money, their finances, the inability to get a mortgage. I saw a number today that we have the lowest acceptance of credit card, bank applications for mortgages and for business loans today, and credit card applications. So that just means the American consumer is extremely weak.
And moving to crypto, Trump's stance on crypto, I think the market responded very positively. Have you spoken? I know you've spoken on, I think, 2 events, Trump events. And have you spoken to anyone in his administration about crypto at all, and to understand their stance, and how serious are they about it? Because obviously they got a million other things to worry about. How important?
I know the boys are very serious about it. So, and they're serious. So they're very serious about it. I mean, look, Donald Trump loves real estate. He loves low taxes. He doesn't trust dollars. Why would you take dollars and convert them to real estate if you like dollars? So anything that he can get his head wrapped around that says, hey, this new asset class is better than the cash. That's what real estate people like. Real estate people and Bitcoin people have a lot in common. Scarcity. It's a physical asset. You can't take it from me. You can't break it up. You can't grab it. You can't steal it. We have 42 buildings, 15,000 renters. If there's some litigation against me, you're not busting up the partnerships. You're not taking my property away from me. And so, as much as there's a lot of middlemen in the real estate, but to me, the two universes between real estate and crypto, when they start communicating to one another, they have this natural symbiotic relationship. And the asset, the pieces, the benefits of real estate, of the cash flow and the leverage that crypto might not have, I think are very compelling to people in the crypto space.
So how do you see that overlap between real estate and I'm curious in what you're doing in the space? Actually, before going into real estate, first, your story into crypto, your stance on crypto early on and how that shifted, especially after the approval of the ETFs and the landscape now that we're moving away from Gensler and the Biden administration.
Yeah, well, look, I'm a coward investor. I don't invest in stocks. I've always been a coward. I get rid of cash. I don't like cash either, by the way. So I get rid of cash. Our companies produce quite a bit of cash, and I want to get rid of the cash. I want to be at zero all the time. And so what can I put my money into? I know if I put my money into a real asset, not office, but apartment buildings like we purchase, they're going to provide me with cash flow. If you're a coward, you like cash flow. And I'm a coward. I admit I'm a coward. Any cowards in the room? I like to put something in, get something out. And so we just accomplished $500 million worth of transactions in Florida that was going to be up here, by the way. We paid cash. We pay cash for these beautiful buildings that we buy from institutions. Those buildings produce a 5 or 6% cash flow, institutional quality, great locations. And we have no debt on it. We'll wait for the debt market to go to 4%, and then we'll put debt on it. But I'll wait until, or 3% or 2%. I believe that we see 3% interest rates again in the next 24 months. I think Trump's going to put his foot on the Fed's throat and say, yeah, I'm not going to fire you. You're not going to quit. You're just going to go to 2. And now, how much real estate can I buy? Well, the cash flow could buy real estate. The cash flow could buy Bitcoin. Now, the way everybody's been trying to do it, and nobody's done anything, is they're trying to put property on the blockchain. And I've had 5 different groups. I've been on Spaces and saying, hey, you show me how to do that. I'll donate $100 million worth of real estate. You show me how to put it on the blockchain. You show me how to break it up into tiny little pieces and get the SEC to sign off on it. And I'll do the project tomorrow. And everybody's like, I can't quite get there. So the other way to do it is a simple way, which is buy the real estate with cash and have the distributions or the cash flow from the real estate, buy the Bitcoin for this massive audience of people out there that do not want to go out and buy Bitcoin because they don't know where to store it. They don't know how to buy it. They actually don't even know what it is. But if the real estate bought their Bitcoin, rather than getting a distribution in fiat, they would get a distribution and maybe a fund that holds Bitcoin.
You kind of flipped it around. Can you go back?
And so that like Ryan Secco, Ryan's, what are you, 40 years old? Okay, you look good for 40. So he's a pilot. He's a real estate guy. He hadn't bought any Bitcoin yet. But if I told him I'm going to invest in a deal, okay, and the distributions aren't going to come in cash. They're going to come in, every month we're just going to simply buy your BTC for you and hold it. So now I get 2 explosions. I get 3. I get the cash flow. It buys my Bitcoin. It feels like it's free. I get the tax write-off and the depreciation from the real estate. And then I have the appreciation possibility of long-term appreciation of both the real estate and the explosion of the BTC.
So have you launched that? Did you have a date on when you launched it?
We're in progress.
Okay. But you mentioned something interesting earlier, because I did see you on a space just a few days ago. And you mentioned a bit of a concern on moving real estate onto the blockchain. You asked, like, show me how to do it. When you had those discussions, what were the...
Nobody can show me how to do it. Anybody in this room can show me how to do it. I'm ready to go today.
It's a genuine question, by the way, if anyone wants to take up the challenge and actually...
Everybody's like, oh, they did a house in Aspen. Why didn't they do a second house? Oh, they did a hotel in so-and-so. Why didn't they do a second hotel? If you can't scale it, you can't do it. If you didn't do it twice, the first time had some problems. Like, I don't need research. I don't need a white paper on it. Why hasn't there been 50 or 100 or 200 of these projects? Because they're not doable. They're not approvable by the SEC.
So it's a regulatory concern mainly.
100. And, I don't want to go to jail. I'm not interested.
And that applies outside the US as well? You've seen the same. Have you looked into Europe or other countries?
No, I haven't. But
just the US.
You're right here. I don't even need to look any further than this, right? Like, this is great.
And do you think that could change under a Trump administration, or you'll just wait to see?
I don't think that. I don't think he can change that. I think he's got his hands full with other projects. So,
all right. And have you looked?
I think Donald Trump's going to be interested in reducing taxes, reducing regulation, let you guys go do business the way you want to do business. I think he's definitely going to make sure that you're not canceled, shadow banned. and overregulated by media. I think those are his concerns, and I think he's serious about the deportation thing.
Just back to the RWAs, because obviously it's a space we're invested in. So your concerns are something I'm selfishly interested to better understand. So like all the different use cases of kind of moving real world assets onto the blockchain, accessibility, the efficiency of it, leveraging smart contracts, fractionalizing real estate, it all makes sense. But you're saying that the most important hurdle is getting regulatory approval. How long do you think it would take for that to happen?
I don't want to wait for it. So, I mean, nobody has shown me, oh, we're going to get rid of the middleman. You're not getting rid of the title. You're not getting rid of escrow. You're not getting rid of insurance. You're not going to get rid of the mortgage. Like, I don't know what you're getting rid of. What are you getting rid of? It's like, and I have to wait to take this isn't a single family home. This is not one house with one address. This is 300 or 400 or 500 units. I have rental. I have different leases going through it constantly. Okay. I'm going to break it up into 10,000 pieces. And it's going to sit on the blockchain. What are you going to do? You're going to transfer. Well, what happened? Like there's no mathematical formula for how you trade that back and forth. And then why would you want to? Like, I just don't understand. Do I get rid of my title? Yeah, I guess I get rid of my title insurance. I get rid of or there's some middlemen that are going to go away. I mean, maybe, but that's not why I'm buying real estate. I'm buying real estate because I think it's going to be more valuable in the future. It's going to provide me with cash flow. And then the big benefit, he's going to come back with bonus depreciation. I'd bet dinner that bonus depreciation goes back to 100%. So a $100 million building should bring $40 or $50 million worth of tax write-offs year one. How do I put that on the blockchain? Who do I give it to? And by the way, once I give it to you, when you trade it on the blockchain, where did that depreciation go?
Another thing, though, you've done, kind of step in the direction, getting your beak a bit wetter, is putting both. I think you put 2 homes on a blockchain-based.
Yeah.
How did that go?
Yeah, I have a house in Malibu, and I have one in Golden Beach, Florida, and we put them both on the what is it, Proppy?
Oh, you put it on Proppy? Yeah. We're invested in them. So.
Yeah, and but so. Where's the fucking offer?
When did you listen?
Where's the offer, bro? Like, who's going to trade Bitcoin for a piece of real estate? Nobody. Nobody's ever going to do that. You're not going to do it. Let's say Bitcoin goes to $1 million. You're not going to trade your $1 million of Bitcoin. You're going to go borrow against your $1 million. You're going to borrow $250,000 against your Bitcoin. You're going to take the $250 and buy your house. You're not going to trade your Bitcoin. Why would you? For toilets and termites, tenants, you're not going to do it. You're going to keep them both. What's better than just the Bitcoin? The Bitcoin and the real estate.
Have you gotten any offers yet?
No, we didn't get any offers. But I mean, I got them priced into the, up into the stratosphere. So, basically they're priced where I just crack somebody.
Well, that might play a role waiting.
But it's great promotion. Like anything to do with the Bitcoin space is going to be great promotion. It's just tremendous amounts of promotion. Now it's sexy, it's exciting, it's in the news.
Your stance, we talked a bit backstage. You've invested in Bitcoin. It's been a long time. The journey started a lot longer than many people would guess. Maybe tell us more about your journey into crypto and where do you stand now in the industry?
So I got a phone call. There was a group doing an event in Las Vegas, and they wanted to pay me in Bitcoin. And I think it went to Jared first. Jared's like, no, here's our fee, and this is what it is. And then it went to somebody else in the company. No, we don't do that. And then I heard about it. I'm like, hey, I'll take it. I'll take goats. I'll take like whatever. Like, I'm not working that day anyway. I'll go up there and do the deal. Give it to me, right? So they gave me, I forget what, 100 pieces. And I didn't know what it was. I had no clue what it was. I still have them today. So it was about $500. I think it was trading for $500, and my fee back then was 50 grand and travel, and they took care of the travel, and I kept the Bitcoin, and it's the best speaking gig I ever did. It was the best. I was the best, by the way. I was freaking brilliant that day, and so I still have that today. And again, and then I added some more along the way. Added some at 30,000, and some other things that we've done along the way, but I'm never selling any of that stuff. Like, I'm not looking for a place to get off. It's another thing I'm trying to collect that hopefully I can pass on to somebody else.
You believe in the store of value argument. You're bullish on it.
Well, I really believe that there is no other store of value, you know? So, like, I don't have to convince myself of the store value. We were talking about this morning on the way over here. I'm just convinced that cash is not a store of value. That cash is not king. That was a lie. Saving money is a ridiculous proposition. No one should do it. It's a loser's bet. There's no such way. It is an oxymoron. You cannot save money. It's impossible. There's no such thing as it. So what do I go into? I don't want gold. I have no interest in gold. Never had any interest in gold. I'm 66 years old. No one has ever offered me gold or silver for a transaction, ever. So I don't understand the whole gold thing. I'm going to keep it. I got to dig it up out of the ground. I got to put it back in the ground. I got to pay somebody to hold it, somebody to insure it. If I want to sell it, I have to get it transported, authenticated. Like that's going to take a week. So I never understood the gold thing, the silver thing. Wall Street, never understood it. Okay, if I buy a stock, I never buy enough. And if I buy enough, it goes down. So I'm trading paper for another piece of paper. I'm trading a piece of fiat, U.S. currency that has God on the back of it, so you know it's bullshit. Because it says in God we trust, and I don't think God had anything to do with the U.S. dollar. And then I take the U.S. dollar and I convert it to another piece of paper that Apple distributed, or whoever, whatever company. Most of these companies only last 7 years. When I was growing up, they'd last 70 years. Now they're 7 years. These AI companies, you're going to have 99 of them bust out for the one that makes it. And so how do I convert cash that they're going to continue to print? What handful of things can I convert a piece of fiat to that has a chance of being more valuable in the future?
It's probably one of the best arguments to present, to clip and present to anyone in TradFi that's still not convinced. But Grant, we're over time. Really appreciate your time, man. And thanks a lot.
Thank you.
Grant and Mario, thank you all very much. An awesome discussion. Really appreciate everybody being here. We are not at all done yet. We have a full panel coming up right now, but a couple quick reminders. Benzinga Connect, if you are not on it, make sure to download your app. If you have any questions, anybody that has Benzinga on their name badge should be able to help you connect with each other. That's the whole point of being here. Next up, please welcome Sasha Gabali from the TIE, moderating a full discussion. Really excited about this one. Please put your hands together.
All right. We have a very exciting discussion for you today. So we will be exploring integrating alternative assets into portfolio, why and how to put digital assets into investment portfolios. Busy day today, right? The Bitcoin ETF options just started trading this morning. So I'm sure a lot of us are quite anxious to get back to a screen and see what's going on. But we'll get started. And so let's start with a quick round of intro, starting to my left with Charlie.
Yeah, it's great to be here with you all. I'm Charlie Sander. I'm an investment partner at CMT Digital. We're a venture fund focused on digital assets based out of Chicago, and more largely part of the CMT group, and have been investing in the space since 2016. We're actively investing out of our fourth fund.
Hello, everybody. It's a pleasure to be here. My name is Jeff Park, and I'm the head of alpha strategies at Bitwise Asset Management. Bitwise Asset Management, for those who may not be familiar, we manage about $10 billion in assets today and are one of the leading providers of helping investors get access to crypto assets.
I'm Robert Leschner, the CEO of Superstate. We are an asset management firm with a twist. We create funds that we tokenize and bring on-chain. So we have two products, a T-bill fund, which is as traditional as it gets, and a basis trading cash and carry fund, which is based on crypto assets. Both of these are tokenized and are used by crypto native investors, not traditional investors.
Hi, folks. Great to be here today. I'm Emma. I am the co-founder and head of engineering at Atomic. We are an embedded wealth management service and brokerage service. So we offer essentially streamlined ways for financial institutions to embed brokerage services into their offerings. We're a regulated broker-dealer in RIA, so we're highly TradFi in that sense, but we've been working very closely with a lot of digital asset institutions to give them access to things like fiat rails, invest permissible assets, and also high-yield cash accounts.
So let's start with a quick recap. There's been a lot going on this year, and last year was so pretty intense. We've always been talking about institutional adoption, been waiting for it for a long time, and now we have Larry Fink saying that Bitcoin is a store of value. So how have institutional attitudes changed over the past year, and what are the key things that happened that you think are game-changing?
I can start. I mean, as a regulated broker-dealer, we have been seeing how reserved people are around anything that touches crypto. And even just the mention of crypto in conversations is usually, a red flag or a kind of high alert, puts regulators on high alert. What we're expecting to see is just a more open adoption and more nuanced understanding also. I think regulators are struggling with understanding how they can still enforce AML and have firms maintain fiduciary responsibility at this time. But now I think they're going to take a more nuanced approach, and rather than saying no crypto adjacent, they're really going to understand the mechanisms of, okay, what is the ledgering, what is the accounting, what are the protections, and really go from there.
Yeah, so I think this is the first year where the doors have been blown off and the institutions actually are coming. And that really begins with the approval of the Bitcoin ETFs and later the Ether ETFs. I think, Jeff can speak to the numbers a bit better than I can because he's created some of the products that institutions are buying. But we're starting to see, hedge funds buying Bitcoin through ETFs where before they had a difficult time setting up crypto native infrastructure, digital asset custodians, trading software, accounting, record keeping, et cetera. But they're set up to own an ETF. It's simple. It just slots into all of their existing workflows. And so we're starting to see a huge increase in participation in digital asset exposure by people that just didn't want to get set up in a crypto native way. And that's also leading to the second piece, which is institutions are now crypto curious, and the ETFs are a stepping stone. For them, once they own Bitcoin, once they own Ether, once they're including in their portfolios, they say, okay, well, how do I actually get set up with an Anchorage account or a Coinbase Prime account or something to hold digital assets natively if I want to start, cutting out the management fees and all of these things. And so we're starting to see, just a massive upswing really beginning this year.
Yeah, I would add to that, the ease of use, as Robert mentioned, is certainly one of the most compelling parts about buying the Bitcoin ETFs and other crypto ETFs. But the other component that may have been maybe under-indexed was Bitcoin ETFs also bring new kinds of liquidity in the marketplace that suits the interest of traditional players. So when we talk about liquidity, most people jump to thinking about just market liquidity as the definition of how we measure that construct. But a very big component of the financial system actually operates in the back of what I call funding liquidity. And ETFs give you the chance to bring funding liquidity in a way crypto and native assets, at least to this point in time, has not been able to do so in a secure and regulated way that is minimizing counterparty risks. And those kinds of benefits do ultimately accrue to the individual investors. So next time you actually buy Bitcoin and you have it as an ETF format, you can actually participate in the securities lending market and earn yield off of that in a way that would have been difficult with the spot assets that would have faced, an OTC counterparty, for example. So I think that is a big unlock. And we're going to see more adoption by sophisticated players, like Robert mentioned. Those are trading Bitcoin for different purposes as well. We've seen a lot of interest in trading relative value strategies with Bitcoin as a part of the global proxy baskets of multi-asset allocations. And institutions are definitely coming. I anecdotally will share a story that one of the Taft-Hartley plans here in the East Coast was actually working with a consultant and thinking about how to bring BlackRock into their model portfolio that would include Bitcoin as part of their fixed income allocation. So actually, this isn't like pitching Bitcoin to your board. You're actually saying, BlackRock's going to help me devise a fixed income allocation, and we're going to put a little bit of Bitcoin to enhance the return optimization. And that shouldn't be surprising, because for all the reasons that has been seen now widely on TV, a lot of people see Bitcoin as a true store of value. You don't have to hear from me or anyone here on the panel. Paul Tudor Jones is out there saying it. Larry Fink has been out there saying it. Even Ray Dalio actually has come out and said Bitcoin could be useful as a store of money. And the list goes on. Maybe the only person that's not on that list is Warren Buffett.
One day.
I think, he's older than Joe Biden and Donald Trump, so maybe one day he'll actually probably just croak first. So we'll leave it at that. But that's how I think about the institutions coming into this space.
Yeah, and I'll just add quickly, I think you're already seeing kind of the next level of adoption and exploration. I think 2 weeks ago, you had Citi and Fidelity debut an on-chain foreign exchange swap using smart contracts with the Monetary Authority of Singapore. Yesterday, Goldman Sachs announced that they're spinning out their digital asset platform as a standalone entity to work with a lot of different institutions. And obviously, BlackRock led the way with ETFs, but I think you just see continued innovation and exploration on that front.
So let's bounce back on the ETF since we have you, Jeff. So how, what do you see as the future for the ETF? What's going on right now with the options starting to get traded? What does it mean for access and exposure to crypto?
Yeah, I think ETFs are suitable for a lot of different kinds of trading, but there's a whole world out there that touches wealth management in a product category called structured products business. And it's actually a very lucrative corner of the wealth management industry where you're able to create different kinds of custom payoffs that guarantee certain kinds of trade-off on the risk return for the high net worth and accredited investor types. And the ability to build those products now with Bitcoin ETF options being available in the marketplace is a huge, huge unlock. It allows, for example, people to imagine getting principally protected notes that earn yield on the back of Bitcoin with some kind of custom participation to the upside. And these kinds of things are exactly what you want to bring to market when you hear about institutions saying, I don't want to touch Bitcoin because it's just too risky. Well, now there's a way to structure a product that actually won't look as risky on the downside in ways that the ETF options can permit. So I think those are all pretty interesting things. Bitwise also very recently just filed for a 19B4 to uplist our index fund, BITW, into an ETF. It is today the largest index crypto fund in the world. And I think that's another benefit that many investors will find useful, where they can actually make an allocation towards a diversified basket. And indexing is another important transformative tool of financing, in my opinion, in the capital markets that is perhaps a little bit underweight in the role that it services for investors to get access to asset classes.
So thinking about, indexing, putting everything into a basket, diversifying risk. Now, what if we are less, about risk diversification, more about innovation? So Charlie, I'm turning to you. So what's the VC landscape? What are the more at the frontier of the growth of the digital assets ecosystem? What trends do you see?
Yeah, I think on the venture side and on the opportunity side, the two kind of big narratives that we've seen over the last 12 months or so, one has been positioning yourself for kind of the transition of traditional assets or I guess the blending of traditional assets and digital assets, whether that's bringing on chain money markets and other traditional assets or institutionalizing Bitcoin. And then the other big one is payments. And looking at stablecoins and how you can use those for global international settlement. I think that's headlined by Stripe's acquisition of Bridge, which was about $1.1 billion. And actually yesterday, John Collison announced that they're going live. And so now you can pay all invoices cross-border with stablecoins, which is a pretty massive unlock for Stripe because they obviously own the end user and do trillions in volume, but their margins are actually quite small because they're paying interchange fees. And so I think it increases their margins by 3 or 4x if they can settle via stablecoin instead of via a credit card. So I think that's a huge opportunity. That's what we've seen. And then another big unlock too, assuming an administration change in the US, you're seeing a lot more opportunities pop up for startups to be innovative on the early end in the US.
And you mentioned moving, between on-chain, off-chain, bridging the gap between, the more traditional rails and the crypto native rails. So what about real-world assets, right? What are the challenges, but also the opportunities that you guys see in bringing off-chain assets on-chain?
Yeah, so real world assets is a packed term. Really, it covers up the fact that there's so much innovation happening that merges traditional financial and capital markets with activity happening on a blockchain. And there's firms like Superstate that are acting as bridges between the two by taking trad assets, creating a token, and moving them on chain. There's platforms like Coinbase that in some ways is an RWA platform because they're bridging payment networks between off-chain and on-chain. And they're doing it not just with like a centralized exchange, but also with their own blockchain as well. We're going to see these two worlds start to merge into one a lot more. And we're at the very early stages of this where, we're going to have a lot more, innovation and combinations between these markets. And they're not going to feel so separate. You're going to have products that span both. You're going to have, things that get built that start off with crypto, entirely native to crypto, and all of a sudden the assets being used in a DeFi protocol are no longer just crypto native assets, they're also tokenized off-chain assets as well. And we're going to start to see lots of different combinations. And this is an area that, I think you should be watching incredibly close over the next 2 years.
And I'll add to that as well, but from the on-chain, off-chain perspective, maybe going the other way, one of the most fruitful partnerships that we've had to date, our client Uphold, for example. That's an example where we worked with them to offer high yield cash accounts, brokerage accounts. And the way that we work with them is basically allowing for fluid movements between their kind of crypto portfolios and a high yield cash account, which could expand into other traditional financial assets, securities, ETFs, et cetera. And that's been amazing because the expectations of consumers from the traditional finance segment is that everything be more, immediate and efficient in the way that on-chain has been. But then on-chain has had their, I would say they've had struggles in terms of being able to connect to all of the different networks from traditional finance. And so we really think that the place in bridging the gap there is a really exciting one, and we'll see a lot of innovation come from that.
Can I maybe share a funny story at Bitwise
Please do.
where this happens all the time? So one funny story that maybe some of you guys may know is we do at Bitwise actually publish our addresses on chain for the ETFs where you can actually see the holdings. But it also means that it is a publicly available address for which you can interact with. So when we launched the BITV ETF, we've actually gotten people who just sent Bitcoin into that address because they like us. It's like a tip. You're tipping an asset manager, which has never happened before. And when it happened, we were like, wow, what are we going to do with this thing? I mean, it's infiltrated into it. So it's part of the ETF.
So did you spend more in tax advice than
I think we're probably at the point now where AUM has subsidized for that tax advice. But ultimately, the conclusion we reached was we can actually distribute it or recognize it as an income on behalf of the ETF investors. So when you think about even the possibility of a weird performance spread between the Bitcoin ETF by Bitwise versus BlackRock, the idea that tipping, because we're actually on chain in a way, challenges a lot of these fundamental businesses upside down. The other thing I want to mention is staking. I actually think staking is the vector for a lot of institutions where they're going to have on-chain meet off-chain through wrappers like ETFs. And it's no surprise that none of the ETFs today in the United States offer staking as a service within the Ethereum wrapper. But I think that's going to change too. And part of why Bitwise acquired Attestant earlier this week and made the announcement is because we envision a world where staking is going to become a very core function of how people choose how to access these vehicles, recognizing there are these on-chain opportunities. I think staking often gets misconstrued as a dividend, which is actually unfair because dividends are passive endeavors and they're generally the same number you get for every investor. But that's not true in staking, right? Staking actually is a very active process of validator management, and everyone's results actually vary based on how you do it. And so this is truly, truly on-chain endeavors. And so I bring up staking as another core construct where the institutions are going to find off-chain, on-chain intersect.
And when you can see someone's address, and obviously you can try and send them tips, but you can also sometimes get tips and think about collateral management and looking at on-chain transfers that give information on your positions. And so how is that impacting secondary markets, or how do you see the interaction with DeFi and secondary markets?
I think there's still kind of a gap between bridging those in the current state, and a lot of it comes down to regulation, but also just creating kind of a boxed environment where today I think on-chain, like Chainalysis and TRM do a good job of monitoring it, but to Jeff's point, when something's publicly available and anyone can interact with it, you do kind of need some walled gardens in some format or some kind of recourse for that. You saw it, I think, was it Brian Armstrong's wallet, who got like a bunch of OFAC, like when Tornado Cash got sanctioned, right? People started dusting a bunch of wallets. And
I got dusted too.
What?
I got dusted.
You got
too.
dusted too, yeah. And so like, I mean, that causes for an individual causes kind of a headache. So I think there's still kind of a path forward of figuring out like what is the proper procedure and kind of go forward there. But I think Robert can probably dive a bit more into this and what he sees going forward in 2025.
Yeah, absolutely. So prior to Superstate, I was one of the founders of the first DeFi protocols called Compound. So this is an area I'm passionate about. Right now, we're at a very early stage of societal knowledge and research into what does a completely open and autonomous financial market look like, and how does it work, and what does it do? And one of the things that you'll notice today, if you look on chain, is that none of the DeFi protocols really interact with real world assets or off-chain trad assets, because right now there's this huge gap, and it's from a lot of things. It's from compliance, it's from tax, it's from all sorts of rules of not just the US, but every regulatory body around the world. And so right now, DeFi protocols are pretty much entirely separate of traditional assets. And that's because of these complex questions that have to be answered. Like, do you have to, have a walled garden? Well, right now, none of the DeFi protocols really are built to be walled off and self-encapsulated. Does it, jeopardize the value proposition of a DeFi protocol to even do that in the first place? How does that coexist with DeFi protocols that are completely public, open, transparent, autonomous, and don't have those requirements? Where does liquidity build? Does it build in the walled garden, or does it build in the completely open version of it, that's global? So far, we haven't really seen very many experiments in this closed off DeFi environment. And I think what we're going to see happen is, these two systems meeting halfway. I think, and this is a personal prediction from my role in Superstate now and the assets we're trying to create, I think what will most likely happen are highly controlled and permissioned assets in markets and platforms and DeFi protocols that are less permissioned. And so people will say oh, I can use this protocol if I stay within this small list of assets that are trad assets or RWAs or whatever you want to call them, that have compliance and permissioning built into the assets themselves, not the DeFi protocols. And I think next year we're going to start to see a lot of experiments here for the first time.
So would that be, so basically you see this as silos that, are compliant within the silo, but then you have this sort of public layer that's more secure and that allows the interaction between those silos. Is that correct?
Exactly.
Very interesting. And, speaking of silos and, when people have their, manage their assets, typically you can use a number of different brokerages. You have these different pools of assets, and typically you have a lot of frictions moving assets around. What are the implications, and not just about moving the assets around, but also in terms of getting exposure to digital assets, incorporating these into everyday portfolios? What are the considerations for brokerages and wealth managers?
Yeah, absolutely. So right now, it's a very segmented industry, as you mentioned. Someone might have their crypto portfolio in one place and kind of trade their stocks in a brokerage and maybe have a wealth advisor. or a robo-advisory platform and really have to manage all these different destinations for their wealth management. However, we do envision a future as it becomes easier to operate in between these platforms as we build out these bridges, that people will want to consolidate into a single financial relationship. And that's what we're doing at Atomic is also really empowering firms to go beyond their initial scope by offering a very broad range of different offerings. And so, for example, like if you're a crypto and you want to actually expand your offering to offer traditional assets, that's something that we can help them expand their business in that way, and vice versa. So I think really the consumer expectations are going to drive a consolidation of these very segmented markets currently.
Any other take on how wealth managers will partake in the adoption of crypto?
I mean, another lens to which I think people will appreciate it is really what's obvious to everyone here, the liveness of crypto in ways that the regulated markets are not. So it's actually one thing that I think is a very obvious utility for wealth managers, and the way I think Superstate also is doing a great job bringing product market fit for that reason. If you even think about what happened with Silicon Valley Bank in March, last year, that whole episode actually unfolded over the weekend. And so it was from March 10th and 12th, where there was a lot of uncertainty about how to access those T-bills that was being custodied with Silicon Valley Bank from Circle. And that was the gap in which you saw the USDC depeg close to 15% on something that shouldn't have. And so I imagine a lot of wealth managers will find those kinds of episodic things to be really wished upon to be avoided if possible, and crypto will literally facilitate that problem. So we're not even talking about like additional income, additional yield. It's not even like a trade-off of benefits. It's actually like risk mitigation on the other side. And so I see that as a very useful thing for the wealth management world that crypto is going to bring to life in the near future.
I remember that weekend very well.
Yeah, that's trauma for me.
I mean, I think to that point, one of the things that we've seen in this last year is really the risk when it comes to traditional finance and banks in particular. And we've seen a lot of our clients have to move actually from banks because they're becoming debanked. Their banks no longer were accepting new businesses, or their banks just ceased to exist. They got consent orders. And I think we really realized that brokerage was a very actually fitting alternative and safer in many respects because it's a segregated account. So it is interesting to see a large traditional kind of finance sector fail in that way and then have to really be forced to think about what are the alternatives that are safer for your investors.
All right. Well, thanks a lot. We're getting to the end, but I'll give you guys an opportunity to give your final thoughts to wrap this up nicely. So what any final thoughts? What's the outlook for this year, for a busy 2025, I guess? And where can people find you?
Yeah, I think 2025 is extremely exciting because the status quo historically has been in the US when innovating digital assets has been extremely expensive. I think over $500 million has been spent on lawsuits. Even the Bitcoin ETF, right, was approved via a lawsuit, and now it's the first ETF to 40 billion in like 200 days. But I think that's the biggest opportunity is most likely getting concrete legislation around it, and that gives a path forward for founders in the space.
Yeah, for my side, I posted back in September the amazing opportunity for market structure change with Bitcoin ETF options. And I actually posted it on Twitter saying that it's going to be a 2025 event to look forward to. And here we are today, where actually it came through even before Thanksgiving. And so the thing that I would mention to everyone is that this is truly like a very unique moment in time to have a financial instrument that's never existed in the world before. The way I phrased it for folks is that this is the first real regulated leverage market where you have a perpetual commodity that is truly supply constrained, right? it's a true perpetual commodity, not in the ways that need futures as a contract management exercise. They don't expire like ags. It's perpetual, and it has a true supply constraint. Think about the implications of what the options market behaves upon those types of things and the kinds of trading patterns you may see. And I think 2025 is set up for an incredible event for Bitcoin.
Yeah, I'll build on what Charlie was saying. I think 2025 is going to be incredibly exciting, not because of the price of Bitcoin, which will probably be awesome, but because for the first time, I think we're going to see ever crypto-specific legislation that makes it through the House and Senate and the president's signature. I think we're going to see for the first time the ability for firms to actually go into the SEC and register new products, whether it's exchanges or trading venues or, tokens or, platforms of any kind. I think we're going to start to see that. And I think all of this is going to culminate for the first time in people feeling like America is finally open for business when it comes to new crypto products. And that has not existed for the last 8 years, really. We've been in pretty much a headwind state, and that's abating very quickly.
Yeah, I'll echo that from a compliance and regulation perspective. I think a lot will change in 2025, hopefully for the better in terms of allowing a lot of innovative new ideas come to play and come into the light. I would say at Atomic, as a kind of brokerage infrastructure, as well as almost now like a compliance as a service play, we're really excited to just help support all those new ventures come to light.
And that concludes our panel. Thank you so much.
Very much to our panelists. Please make your way back to the green room. Thank you so much, y'all. Wonderful conversation. Y'all, we're going to keep it moving. We have a few more pieces of content prior to lunch. If you do not work with Benzinga, first of all, what are you doing in your life? Second of all, we have people upstairs in the hallway to talk about our APIs, of which many of you already probably use. Please do stop by that booth, learn about how you can collaborate with Benzinga. Next up, please welcome managing risk and enhancing returns in alternative asset portfolios. Leading the conversation is Todd Rosenbluth. Give him a warm round of applause.
Check.
Good morning. So we're going to keep this moving. And as mentioned, I'm Todd Rosenbluth. I'm the head of research for TMX Verify. We are an ETF data analytics and indexing company. What we're going to do is just walk through the panel. Initially, what I'd love for you just to do, introduce yourself, and then maybe how you got started in the digital asset space, since obviously that's what we're here for.
Sure. Yeah, good morning, everybody. John Devine from Blockfills. We are an institutional market maker and liquidity provider for dark pooled spot markets, options markets, forwards, lending and borrowing. I came into digital assets. I was a high frequency trader in Chicago focused on precious metals markets and really, had a philosophical thing with Bitcoin. But I crossed the Rubicon when CME listed the Bitcoin futures contracts in December 2017, and I haven't looked back.
Hi, my name is Adam McGurran. I'm the founder and CIO of Hunting Hill Global Capital. First of all, thanks Benzinga for hosting and for Todd for moderating today. We at Hunting Hill have been around for 12 years. We're traditionally a TradFi shop and started to participate in some of the ETFs and futures in 2016 and 2017, along with the closed-end funds that were following Bitcoin and Ethereum. So we had approached the space from a TradFi lens, and it started with 50 basis point position back in 16 in sort of across all of our funds and managed accounts. And today it's about 85% of our business. So we've fully kind of pushed to the crypto space and side of things, and have certainly come to scale with obviously this year, but even in 2017, 2021 when we were participating. So at the moment we're a little over $500 million in assets. The balance sheet is close to $2.5 billion with mostly market neutral strategies that we run. And happy to be here and look forward to the panel today.
Thanks. Anthony?
Hey, my name is Anthony Russo. I've been in the capital markets business for 18 plus years on the buy side, sell side, retail brokerage. solving problems for traders. Currently head of brokerage solutions at TradeStation, leading product teams across all asset classes, building retail trading solutions at this time, providing direct access to multi-asset class trading offering. I've been in crypto. Well, I came across Bitcoin in 2014. Like many, I did nothing then. It wasn't until 2017 where I actually dove deep down the rabbit hole. I've done everything from mining to trading to building out tokenized collateralized solutions to building out a retail trading platform as well as a lending solution. Yeah, it's been quite a ride. It's been some ups and downs, and yeah, it's exciting to be here today and in the state that we're in. Yeah, thank you.
Thanks, Scott.
Hey guys, Scott Osachek here. I'm the Chief Operating Officer of Rex Financial. We're a exchange-traded product provider that includes a couple brands like the M-Sector brand, which is on the back of a lot of chairs out there. That's an exchange-traded note partnership with the Bank of Montreal. So those are like trading exchange-traded notes, like 3 times FANG, 3 times gold, those kind of fun things. We have another brand called T-Rex, which is like our single asset levered and inverse, so think 2 times MicroStrategy, which is a lot of fun. We launched, I don't know, 2 months ago, and it's up like a gazillion % or something. And then we have a sister company.
Not financial advice, right? That was not financial advice.
Yeah. Don't buy and hold forever on that, please. And then our sister company is Osprey Funds, which is a crypto asset manager. So I got introduced to digital assets actually making fun of somebody on my desk at Citibank back in 2012, give or take, on being a Bitcoin miner. And I had no idea what that meant. But once crypto or Bitcoin specifically became a commodity, it really piqued my interest. I helped create some of the first commodity exchange traded products. So just kind of was a trigger moment. And we were in front of the SEC probably by 2015, 2016 about creating an ETF, which obviously we failed at pretty miserably, like everybody else did for a long time.
Well, I guess I'll take the last part of that. My connection to the space is there are ETFs. If there's an ETF, I need to know enough about it to be able to hold a conversation. There's even more ETFs. This has been the year of Bitcoin and crypto related ETFs. That's one, I guess, of the obvious tailwinds. But maybe we can just, you're probably getting a lot of this today, but I want to get our experts on stage to just talk about, guys, just list one tailwind that you see for the industry, just so by the time we get to Scott, he's got something left to talk about.
Well, I can't help but notice that today the options on the IBIT ETF came out. And if anyone's trying to get caught up to speed on Bitcoin options, there is a book on Amazon called Bitcoin Options. I happen to write the book. Yeah, if you're trying to get up to speed, highly recommend. I have a couple copies if you want to come find me after. But that's a massive tailwind, and it happened today. And so let's start off with that one.
Go ahead, Adam.
Yeah, sure. I will get into the weeds a little bit, but I think that for at least in the U.S., the institutional demand has been on the custody side. So SAB 121, which is a regulation that prevents a lot of the banks to provide custody for their clients, I think could be a big step potentially next year if it's repealed or changed in some form or fashion. The Bank of New York did get their exemption somehow before the election, and so they're able to do it. But I think that once, if and when that were to be repealed or changed, then once the banks are coming into the U.S., it's just a massive uptick from flows and the way the space can be institutionalized.
Anthony?
Yeah, I think the FASB rule change really to allow fair market value accounting take place is a huge tailwind. I mean, we're starting to see right now the corporate balance sheets race really to put Bitcoin on their balance sheet is happening in real time. It's something that I think none of us really expected to take as much hold as it did. Now, MicroStrategy obviously is the lion's share of that, and they probably always will be, but they provide a pretty interesting playbook for corporates to get involved and really think about how to put this on their balance sheet. And I think that right there is going to change the dynamic of how people think about Bitcoin and digital assets as a whole. That's going to educate a whole new regime of people in the industry from a business perspective that is going to then open the door for them to think about how digital assets fits in their business outside of just having Bitcoin on their balance sheet. So I think it's a huge tailwind. Yeah.
Scott, wrap it up.
Yeah, no, I think you guys left me with a great one. I get the 250-pound red-headed gorilla that wants to create a strategic reserve for the United States. And
250 pounds?
And there's a lot of talk right now about other countries kind of following suit, but also like some smaller countries trying to be a little more nimble that are seeing this demand get taken off, trying to get in before January 20th as well. So, I mean, there is an incredible amount of upward pressure on Bitcoin price, and it kind of seeps through to all kinds of demands.
So maybe let's pull on a couple of the threads that got discussed. I'm going to hold the options one for a second because the book is next to me and I want to make sure that I say book a couple more times. Let's just talk about what the Trump administration could mean for crypto and even maybe from a market structure standpoint. Adam, maybe let me start with you there.
Yeah, I guess from sitting in the asset management seat, the biggest challenge that we find is just clarity around how and when to participate, and jurisdictionally and compliance-wise, regulatory, who's the body that we're facing. We're SEC registered, so that's like our top of mind regulator, and that's certainly what we abide by and look for. And if it happens to be a change at the top, so if Gensler is out, then who's in and what that means. So, certainly there's no guarantees around that being extremely favorable to crypto, but we'd imagine that it would probably be on incremental difference than what we currently have. So from our perspective, that's the sort of first and foremost trigger, so to speak, that we're focused on, and just want some clarity on how to traffic and face. Kind of embedded in that is sitting in New York, there's New York DFS. So sort of facing off on whether or not we need a bit license for specific strategies that we run. And then, obviously finding the right jurisdiction in either the United States or offshore to scale. And so right now we're obviously here and focused on the US and hoping that we're able to get to certain clarity to get to scale in real ways.
Anthony, from a trading standpoint, I assume this is a catalyst.
Yeah, I mean, it's definitely a catalyst. It's just going to unlock a lot of liquidity for the market in general. I mean, you're going to have a whole new realm of participants entering the space. I think the big elephant in the room was SAB 121 for the past few years that really put a shadow on the overall industry. Adam, he spoke about that, but that hits home to me because, TradeStation was kind of a victim in the realm of that SAB 121. We had to deal with some really complex, challenging times because of it. So I think, really institutions and entities and businesses that didn't want to enter the space before because they just didn't understand or know or were too afraid to now will. I think that they're going to, hopefully provide some regulatory clarity to really allow structures to fall into place here, which will then unlock the traditional markets in a different way as well, because you're going to start to get more efficiencies if you really start to bring in, really blockchain solutions, bringing, settlement times down to T0, using stable coins for settlement. There's a ton of things that we can do for collateral, for, the tokenization of, bonds and so on and so forth. There's so much that's going to happen in this space that's going to really transform how we think about really just capital markets in general. There is a huge, I think, outlook for the U.S. to lead this. There's been regulatory clarity around the world, but I think everybody's really been waiting for the U.S. to figure it out so we can really, step forward and kind of set some global structures and thinking about how to build, global markets in this technology.
Can I just build off that for a second? So one of the things that I think that, at least again, in asset management, what we've seen is the space has been trafficked mostly by speculators and sort of participants that are looking to gain an edge in some form or fashion. And I think potentially what the administration would allow for is a shift in focus to real world use cases and not just speculation. And that could be a handful of things. So it could be tokenization of bonds. It could be facing a user experience through an NFT. And sometimes the user may not even know it is an NFT. It is just using blockchain technology, and that provider is not concerned that it is a security or not a security. There's just clarity on what it is and then trafficking accordingly. So I think that there's just going to be a wave of practical use cases financially in financial services and everyday life. That's what I'm obviously hopeful for, but I anticipate that being one of the big changes.
John, I see you nodding. You want to add?
I'm excited because, I think now that we've gotten a little bit of a shift in the regime here, and there's going to be some more clarity in terms of regulatory standards and guidelines. This is going to unleash this wave of technology innovation. And you know, one of the projects I'm looking at here that's just a good example to kind of get your mind thinking a little bit. It's something called Hive Mapper, and so it's Hive Mapper's competing with like Google Maps. And so, you know, Google went into their balance sheet and they paid a bunch of drivers to drive all over the world and map the world, right? But now we have something called, you know, this blockchain technology where we can go incentivize people in the real world to go, you know, complete an objective. And in this example, the objective is to drive around the world and map all the roads. But what's being incentivized here is that these drivers who are mapping the roadway, they're getting compensated in a token, in a layer 1 token, in what we call Hive Mapper. And so now we're going to see a bunch of competing technologies emerge that kind of busts up some of these monopolies, I'll say, and really opens up the opportunity for entrepreneurship in a much different light than what we've been accustomed to seeing. And that's something that blockchain technology is going to drive home. And I'm very excited to see what else comes out of that.
So I'm going to pivot because the name of the session is managing risk and enhancing returns in alternative asset portfolios. Yes, I can read what's on the bottom of the screen, although your picture is not on there. That's why it's not up for everybody else. But Scott, let me start with you in terms of the ETFs are a way of both enhancing returns and managing risk. You want to just talk about that?
Yeah, so I think, you know, back to, you know, some of the upward pressure that we're seeing or the clarity from the Trump administration, I think as the use cases get used more, as people start using it more, as corporates start adding it to their balance sheet more, get more than one S&P 500 company to allocate, then you start seeing more of this, you know, I don't even know how big, like let's say Bank of America's model portfolio, when they do a 2% allocation to Bitcoin or something along those lines, that's billions more dollars that are going in. So I get excited about more of the traditional asset classes and allocations being used. And as winners emerge beyond Bitcoin and Ethereum, like the Solanas or even Binances, you'll start to see more of the traditional ETFs happen. And then the whole ecosystem of investing starts to unlock for everybody that doesn't want to necessarily buy stuff on a flash drive.
So Adam, do you want to talk about other things besides, I know of the ETF space, but there's so much more that it's in this from an investment standpoint.
Yeah, so from our perspective as an active asset manager, I mean, we have 4 different strategies. So we're out there sort of trying to provide you know, different allocations for the different providers that are looking for that. We have a market neutral strategy. We have an active long only. We have a credit fund, which is a partnership with Kraken, and then a strategic venture arm. And so from our perspective, it kind of covers the gamut, but I think what's most important, since we've been around since 2016 in the space, is managing risk. And we've seen now 3 different cycles, 17, 21, this is another version of it. They're all different. And managing risk for us has been this kind of key component to stay around. So, you know, we have, I mean, being embedded in the space and kind of knowing all the players, at least from a trading perspective, helps that for a fair amount. There's also an element of understanding how risk and margin works in extreme moves where the tail is on the right side, meaning the tail is on the upside, not necessarily the downside. And, you know, it's gotten us to a place where we're comfortable putting on pretty large size and cutting off that tail and, you know, providing the risk-adjusted returns that we can for the investor base and feeling comfortable that we're not going to, you know, slip and fall into a gap. In either up or down, which can happen in this market. So yeah, I think it's very important from the active side when looking at a manager to ensure that there's not just a strategy that's generating alpha, but it's also generating risk-adjusted returns in a healthy and clean way for folks that really understand the space, because it is volatile and it is important to cut off those tails in the right way.
So John, let's come back to options that are out there now for ETFs. That feels like a way to be able to manage risk. There's people who've had very strong gains within Bitcoin ETFs or other Bitcoin strategies. Having options is a way for them to reduce that risk profile, I imagine.
Yeah. So what we're seeing right now in the options market for people who have been long Bitcoin, they're starting to do zero cost collars, which means they're looking at that they're selling call options typically 30 to 45 days out, about 20 delta. call that the 115,000 strike right now. And then they're taking those proceeds and they're buying put options. So they're staying long the coin. They have upside exposure to that short call strike, let's say at 115, and they're going to get a put option at zero cost from the premium earned from the call sale. And that, of course, gives them a right. That gives them a floor. It gives them the right to sell that Bitcoin at the put strike. So that's a big one we're seeing right now. For people who are under allocated to the asset class, we're seeing put selling, cash secured puts, and this obligates them to own the asset at the strike price. So they're saying, maybe I'm happy to own Bitcoin at 80,000 on December 27th, 2024. So they'll sell that 80,000 strike put option, and they'll take that premium and they'll do the opposite of the collar. They'll do the risk reversal and buy call options at zero cost. So that gives them a nice position to own the asset at the put strike with upside because they're getting long calls. That's a big thing we're seeing. Another one I'll give you is this basis trade where people are buying spot Bitcoin and they're selling forward. There's going to be a spread there. And right now on the December 27th futures contract, there's like a 16% annualized spread. So you can buy spot, sell forward, you collateralize that short forward with Bitcoin, with actual coin, and you can take that difference and get assigned call options instead of taking the interest rate. So that gives you like almost a free play to the upside. Buy spot, sell forward, take the difference, buy call options. There's really, it's a very interesting trade for this market.
So Anthony, from a trading perspective, tell me what options on ETFs does that move the needle for you?
Yeah, I mean, it does a few things. It creates a more in-depth market structure for liquidity really to enter the space. I mean, any other ETF that's traded that has options on it, really the options are like 10x the liquidity. So, when you look at Bitcoin, it's really, I think right now, before these options came out today, I think maybe there were, 1% the derivatives were of the entire Bitcoin market in general. So, you start to look at it from a market liquidity perspective. It starts to provide more structure, and it allows for different participants to enter the space and express themselves in different ways. Obviously, there's leverage involved, so there's opportunities there. Leverage cuts, with both. It's a knife that cuts on both sides. You got to be careful with leverage. But I think from a trader's perspective, it's another tool in the toolbox to allow them to express themselves in different ways that provides a more structured market for us to grow.
So Scott, I don't know if you got triggered by leverage cuts both ways. Do you want to talk about that?
Did I flinch that bad? Yeah. So the world of ETFs is pretty great. It makes a lot of these strategies that everybody up here is talking about simple in one wrapper. So there's your regular beta products. That's your IBITs, which funny enough just passed IAU, the BlackRock Gold ETF in assets. IBIT's only been around for 10 months. IAU's been around for 20 years. So I feel like little significant items like that are out there. We're starting to see covered calls come into the Bitcoin space. I imagine it's only a matter of time for Ethereum and then whatever's next on the ETFs, whatever's next become an ETF like Solana or whatnot beyond that. And then leverage and inverse, so to allow for trading for brokerages. It just makes the world pretty easy having it all captured in your brokerage. I will say it's also annoying when trading stops at about 4 p.m. So I imagine that's why one of you guys love trading around the clock 24/7 markets. But yeah, the ETF's all about trying to make these trades or these wrappers kind of very easy to handle.
So you just put your crystal ball forward, and I guess maybe I'll use that as my last question for you guys. Maybe we'll go down the line. You can all see the clock, so let's make sure we get enough time in there. What's the outlook going forward for digital assets?
Well, it's interesting right now with this ETF coming into play. That the question is, in my view, what's going to happen to this in-kind market? And I think to your point here, this 24/7, the ability to trade 24/7 is a big deal for Bitcoin. If you look at the CME market, for example, we see a lot of weekend risk there. Just 2 weeks ago, we had some massive weekend gaps. So I think traders need to be cognizant if they're going to have Bitcoin positions on. Are they going to limit themselves to a venue that caps that time, that access to the market? That's going to be a risk you want to think about. I also think, being able to have, in-kind Bitcoin and collateralize options and futures markets, that's still going to be an edge for some time, even with the BlackRock ETF and others.
Adam?
Yeah, I mean, I'll kind of build off that. So from the way that we view it, it is kind of bifurcated markets, either in kind or cash. So in the U.S., we consider that, let's say, a regulated onshore market. Offshore, unregulated, however you want to nomenclature it, is a different market. And so a lot of the trading that goes on offshore is denominated in coin. And so participants can post that coin to use as potentially margin to leverage, but they also can use it for trading options. In the US, and the ETF is just cash settled. It's dollar denominated. There is right now no in-kind creation redemption. I just think that in the next 3 months, 6 months, 9 months, I'm not sure how long it'll be, that market will start to converge. And so the question is, for Bitcoin holders that are offshore, are they going to come onshore to trade, and vice versa? Or are there going to be participants onshore that are going offshore? And it'll just be an interesting space. There'll be some innovation, just kind of financial services wise, but also I just think that it becomes a 24/7 clock on a lot of these different coins and different exchanges, and there'll be some consolidation. So something to look out for, especially with the ETF, on whether or not it gets converted, all of them, to in-kind process, and if not, how long it's going to be delineated for and what the regs look like.
Anthony?
Yeah, and I think just to add to that before I give my last kind of statements, I think it's important to note too, like retail and institutions have such different access to spot markets and the ability to leverage kind of some of these strategies and thinking, and the access to the counterparties that they actually want to be trading with, because the counterparty risk, I think, is huge in this market. As we saw in 2022, it was kind of the GFC of crypto, I would say, in 2022 when it comes to counterparty risk. So I think that's really important to think about as you're entering the space and participating in the various ways that you want to enter. I would also say that going into the future, I mean, we're going to have a huge tailwind here. It's going to get everybody way over their skis. There is going to be another down cycle. I can guarantee. There is certainty that we're all going to get very excited and people are going to do crazy things with leverage and whatnot. So I think it's important. It's part of the hype. It's part of human nature. This is probably, when I think about capital markets, it's the most exciting thing that's really happening in capital markets, and the structures changes. So people get overexcited. So I would say just, be caution that and think about your risk and how you're managing your risk, and that there are ups and downs. There's going to be a down cycle, whether it's, 1 year or 6 months or 1 day, it's going to happen. So manage your risk properly, and it's an exciting time.
Maybe just to build real quick on that is, once you start seeing unsecured loans in the space, that's when you want to turn around and run the other way. It's not there right now, but people are starting talking about it.
Oh man. Okay, Scott.
All right. So a couple things. One, back on like the trading differentials. Don't forget, New York Stock Exchange put out a note that they're thinking about extending hours to like 22 hours a day, 5 days a week. It's like, it's the next step. Like, NASDAQ will come out with 23 hours and 6 days a week, and SIBA will end up going around the clock or something. But as it relates to crystal ball time, I've spent a little bit of time trying to figure out like what could get in the way of Bitcoin here. I just see, there's all this upward pressure that we've been talking about here. It's all one way, and literally the only thing that I could pull out is if maybe the preferred Bitcoin Treasury Secretary Lutnick doesn't get in. Maybe that's a little bit bearish. But with the president who he is, who's heavily invested now in cryptocurrency and buys burgers regularly with currency, it's tough to see that being a big deal. And then the other part is leverage, like we talked, like you were just mentioning, overextending leverage, and then some kind of small turnaround becomes a big turnaround if people aren't managing their risk properly and just kind of going blind and letting it fly. But the upward pressure is just super. I don't know. I can't really think of much that's been like it in terms of Bitcoin or versus traditional asset classes. Maybe internet stocks in the late 90s is maybe that's it. But hopefully the ending's a little bit different.
Yeah, that didn't go well.
Yeah,
I mean, 20 years forward, it did. I still buy everything on Amazon, so it's still around on it. All right, well, guys, this has been tremendous. We somehow beat the clock with about a minute to spare, but I don't want to take the risk of having them pull us off stage because we went too long. So a round of applause for my fellow panelists. Thanks.
Thanks, Todd.
Thank you very much.
All right, thank you. That was Todd Rosenbluth leading Managing Risk and Enhancing Returns in Alternative Asset Portfolios. Thank you, Todd, John, Adam, Anthony, and Scott. Appreciate you all. All right, y'all, we have, I think, 2 or 3 more pieces of content prior to lunch. Again, Benzinga Connect networking app right there. Please let us know if you need help getting on. Network with each other while you're here. It's a great opportunity to do some business. Next up, please welcome from the Polymesh Association, Graham Moore will be leading our next conversation. Please give a warm round of applause for Graham and our next panel.
Okay, hello, everybody. I'm Graham Moore. I'm the co-founder and head of tokenization at the Polymesh Association, and I'm very excited to talk today about the tokenization and the multi-trillion-dollar replatforming. So multi-trillions of dollars is what we're talking about today. I'm very excited to announce we have John Patrick Mullen, the CEO and co-founder of Mantra. We have Thomas Sullivan, the managing director at SocGen. We have Ioana Nicogia, the head of head of strategy and partnerships for digital assets at Citi. And then we have Anthony Morrow, the CEO of Provenance Blockchain Labs. So to kick things off, I wanted to ask something pretty broad, but we're talking about the multi-trillions of dollars. So what I wanted to know, when are we getting to trillions of dollars? Is it, are we 6 months away? Are we 12 months away? Are we 24 months away? Anthony, I wanted to start with you first because I know you love talking about how many assets you guys have.
Yeah, so the revolution comes asset class by asset class. We don't wake up one morning and there's $1 trillion of things tokenized. Each asset class has its own, obviously securities related issues to come on chain, and each asset class is going to be difficult. So the first and I think only asset class that has scaled materially on a public blockchain, and this is as measured by percentage of the size of the asset class, is in the private credit space, and it's what Figure has done with home equity line of credit. Figure and roughly 20 large originators will do 15% of all home equity line of credit on-chain, on Provenance blockchain this year, to the tune of about $650 million per month is what they're doing right now. And the reason they do it is because it's not anything crypto related or blockchain related. When you go to figure.com or Movement Mortgage or Guaranteed Rate, you don't see the words crypto or blockchain anywhere on it. It's because of the efficiencies of the back office processes, particularly around audit and time to market. That blockchain creates significantly many more efficiencies than the TradFi way of doing it. They save about 100 basis points off the process of origination, digitally native origination to warehouse to securitization. And if you're doing things 100 basis points on the notional value, better than your competitors and also faster than your competitors, soon you're not going to have very more competitors. So what we're going to see is, I think, the home equity line of credit market has been taken down. The mortgage market is next. And the reason that Figure is going after those two markets is they're the 2 largest private credit markets in the world. And then we'll see other asset classes as you get, though, deeper into the security stack. And the reason they work well is they're non-securities. A mortgage and a home equity line of credit is not a security. Once you start getting into securities like equities or funds, the SEC gets involved and it gets a lot more difficult.
Great. John, what do you think? I know you guys launched mainnet recently. What assets are you guys going after when you guys get to $1 trillion?
Yeah, I think it's quite important to have the distinction between public and private blockchains, because on permission private blockchains, I think we're already at the $1 trillion mark many times over.
Absolutely.
Yeah. So talking about the permissionless side, which is definitely Anthony and myself, who are both kind of building layer 1 blockchains that are permissionless in nature. We still have a very long way to go. Thankfully for Provenance and Figure, they're kind of leading the charge there. But we're still only in the tens of billions. So really a long way to go. I think the point that you brought up about these assets being securities, that's obviously a big issue. When you're looking at this on an asset class by asset class, frankly, jurisdiction by jurisdiction basis, it is quite convoluted and challenging. And every single different regulator around the world has their own different spin on things. So we're doing a lot of activities primarily in the Middle East and Asia. So working under VARA and ADGM in Dubai and Abu Dhabi, respectively. They're quite progressive in their ability to allow tokenized real-world assets on chain, both in security and non-security form. So we're excited about particularly the asset classes of fund tokenization actually in the UAE. as well as real estate. So we're doing some work actually in conjunction with the Dubai government, as well as the Abu Dhabi government, to actually tokenize title deeds that are legitimately written on a public blockchain with the Land Registration Authority, which is definitely different than just tokenizing an SPV behind some form of real estate. So we're pretty excited about the opportunity there. It's one of the hottest real estate markets in the world, but still definitely a long way to go.
Love it. And so one of the cool things about this panel is we have 3 layer 1 blockchains represented, and then we have 2 of the largest banks in the world.
Dark side, sorry, yeah.
I'll jump in with a bank
Yeah.
perspective on this question.
And so now we'll get the corporate answers from Thomas and Ioana. Thomas, do you want to go first?
Yeah, so I mean, I think, John, you mentioned it, we use a platform today that's, private permissioned, but we're settling $50 billion a day on it. And the reason why we're doing it is because it saves us money. It's just that simple. We can save $1 million a year using this technology to make our lives more efficient. And in some ways, we don't talk about it enough because it's kind of boring, but it's just, it's true. And we're not the only firm that uses it, that does it. So I think that, maybe AI should be talking about it more, but I think that, the stuff that these guys are mentioning is really more exciting because that's where the future is going. I don't know, you want to?
Sure. What I'll add to what was said already, I think we are hearing increasingly from clients, and that's sort of the sentiment that we're getting as well, that there is a push to become more selective about the use cases that we focus on to be able to reach scale, to kind of your initial question, right? I think also importantly, for example, in that regard, we announced a few weeks ago the fact that our City Token Services kind of digital cash solution, which is essentially interbranch tokenized deposits for the New York-Singapore corridor, US dollar, is kind of live and commercial. So that's kind of a push in that direction. I think the other thing that I'll say is, I think, there's sort of like a need for focus that I talked about in terms of what our clients are saying, but I think there's also a need for kind of the different assets on chain to work together. So for example, like digital cash and digital funds and digital mortgages, I think there's sort of that need before we get to scale. That's kind of my view.
On that digital cash point, are like is Citi, and then I guess I'll ask SocGen as well. Can you touch stablecoins yet with regard to tokenized assets? Is there a plan to maybe start touching USDC and USDT, or is it still looking at maybe internal types of stablecoins or something that's an internal ledger? Are you able to speak about that at all?
So the solution that I mentioned for us, it's essentially a Citi digital cash solution, and it's again kind of interbranch tokenized deposits for this corridor. And that's kind of the space that we're focused on.
Well, Thomas,
so we're a little bit different. So SocGen has a division called SG Forge. It's a standalone, wholly owned subsidiary focused solely on digital assets. So SG Forge actually issued its own stablecoin, a year plus ago. It's on Ethereum. It's permissionless. It's a lot, it's freely transferable. It became MiCA compliant last June. And I know that Circle says they were the first. They were just the first with the press release. But it's, it's a euro denominated. It's not eligible for US persons. So it has some, it still has some limitations in terms of how we can sell it. But once it's issued and out in the marketplace, it can be transferable. So we've taken a somewhat different approach in part because of how SG Forge is structured, and it's ring fenced from the rest of the bank.
Great. And so we're replatforming trillions of dollars of assets. Why? What's the point? Anthony, is it because we're getting rid of middlemen? We're getting rid of people who are taking fees on things? Is it just things are more efficient, cost savings? Are we opening up the door? What's the point? What's the couple huge things in your mind? Why are we doing this?
So all of the above. I like to say cheaper, faster, and safer. And at the end of the day, cheaper, faster, and safer will always win. What crypto doesn't do well is the safer part. What we do well here, everyone up on stage does safer as well. And at the end of the day, if you're removing intermediaries, reducing the amount of time, and saving money, it's safer, right? So, things we still need. You mentioned stable coins. USDC, USDT are not going to be the answer that institutional financial services uses 5 years from now. There'll be an evolution of that. When KKR buys a $20 million tranche of HELOCs, as they do every month from the Figure environment, they don't want to use USDC. Making a loan to the private company that is Circle that issues the USDC is not akin to their risk profile, as you can ask the guys at the banks. when stablecoin, either legislation that comes through, which it may in the new administration, or a new form of stablecoins comes in that is SEC registered, I think we're going to see this market explode and really open up in a way that we haven't seen before.
Great. John, why are we doing this?
So I would just add the idea of composability to everything Anthony just said. So cheaper, faster, safer, but more composable. When you're talking about the ability to use kind of illiquid assets as collateral, even in a DeFi protocol, maybe not in an institutional sense, but even in a DeFi protocol for many market making firms, trading firms, that's a big unlock. Other projects that are holding just in general stablecoins on the balance sheet, why would you not prefer to have stablecoins that are earning some sort of yield on your balance sheet? Like people are going into things like Ondo USDY or other or Hashnote. There's a number of different projects that have tokenized treasury. So all these things are becoming more useful. They're becoming more composable. Once you start being able to leverage, collateralize, and use them in more instances, you have this even bigger unlock. I think that's kind of one of the big things. And then just purely from a retail angle, access. And obviously this strays into security, not security, et cetera. But some of these products that we're exploring and tokenizing, they've never been accessible by retail ever. And that's just an interesting concept where someone in Latin America or Southeast Asia can now get exposure to a BlackRock money market fund with USDC. They've never been able to do that before. They've never been able to do that in their bank or their brokerage, and that's a big thing. So why should people from all over the world not have the same access to some of these different products, as long as it's safer and more
Seems like you want to jump in.
I did as soon as you mentioned composability, because it just resonates so deeply with me. So yes, agree with that, and also agree with you. I think also for me, and this is kind of like my views, I should have specified from the beginning, not necessarily the view of Citi, a large bank, but programmability is the other piece that really resonates. So I used to kind of cover broader fintech innovation before this current role, and I recall like robotic process automation, or RPA, and programmability for me, if you will, is sort of that at order of magnitude higher or on steroids. So that's really important to me, because once you can actually make these automatic connections and pre-program conditions and kind of see that at scale, I think that could become very powerful. And at a very earlier stage, I'm just going to plant the seed. Probably not when we talk about scale, kind of to your question, but still important to consider is the intersection with other emerging technologies, which I think is really, again, kind of early stage, but potentially very impactful as we look long term. So, how does this relate to AI, right? Like very early stage, like ZK/ML as an example.
Great. And so one thing, I got back in the space in 2017, and one thing we were so excited about was getting rid of all the intermediaries. They were all going to go away overnight, and it was going to be, everything was peer-to-peer. You didn't need exchanges, you didn't need transfer agents, you didn't need broker-dealers anymore. I think we're starting to realize that's not the case. However, intermediaries will be augmented in ways. So are there any ways where you have seen that intermediaries are likely to be augmented, whether it's exchanges or broker-dealers or transfer agents or anything like that? Thomas, you want to go ahead?
Yeah, so I think, we definitely, I would say, augmented is one word. I would say streamlined is another word. I mean, you're not going to necessarily get rid of all the intermediaries right away. But one example is, when SG Forge issues securities, it issues them, directly onto a blockchain, builds the smart contract itself, through the team's in-house resources, and acts as a registrar. So the registrar is akin to a transfer agent. It does some of the same functions, but it doesn't do all of that. And it means that you don't, the cost associated with doing it is not nearly as high. So you still have some of those functions that are required in terms of, whether it be with the security, whitelisting the wallets to ensure that you have the right type of investor who's buying the product, things of that nature. But nevertheless, it streamlines the process. And certainly, there are, in the CSDs, DTC, Euroclear, Clearstream have been actively involved in the space, but certainly you can see the lack of reliance on CSDs if you can use the blockchain layer. So that's one obvious place, although I really believe that they have a role in, they have a role to play, although their roles may evolve and change.
John, any thoughts?
I mean, I think where we're seeing it is there's still real world assets are still having the real world connectivity, which make it, frankly, sometimes a little bit more difficult than the crypto side of things. Like creating the token is the easy part. Creating the connectivity with, the banks, the local governmental regulation, legislatures, like all this stuff is challenging. It takes a lot of time, and there's a lot of kind of incumbent infrastructure there that's not just going away overnight. So even just like tokenizing a fund, we're doing this, and it's still, you still need to rely on fund admins. You still need to rely on ComSecs. Like, it doesn't just go away. So while I think over time this can become more programmable, it still does have this interaction with the real world that just creating a token doesn't solve.
One of my favorite things about tokenization is my job between third and fourth year university is I worked in securities administration, and I would come in every morning and I would check our bond fund spreadsheet, and then I would check our custodian spreadsheet, and sometimes the numbers wouldn't match up, and I would have to call someone on the telephone and say, hi, I think this number is supposed to be this number, and then we would talk about it, and then we would figure out the state of the world. That doesn't happen in tokenization. We can all rely on the blockchain as the golden source of truth. So that's one thing that's so exciting, is how we can augment these kinds of players. And so, Anthony, in the HELOC process and for anything else you guys are working on, where have you seen some very major augmentations of those intermediaries?
Yeah, so I spent 20 years at a big bank at BNY Mellon, and they earn about $4 billion a year, probably less than you guys, in security servicing revenue. And I think a lot of that's going to go away over the next probably 20 years. It's still going to take a long time. Paying agent, issuing, all the agency functions, you're not really going to need in a blockchain world. You're still going to need a trustee, someone to look after the bondholders. But most of the other agency roles, I think, go away over time. But there is a big blocker for securities-related issuances right now. The SEC, as far as we know, has not yet allowed a transfer agent to operate with a source of truth on chain. That's a big deal. Having that, and the same goes for a fund admin.
Do you think that could change?
It should change, because why should the SEC mandate the technology that a transfer agent uses, right? If they use an Excel spreadsheet or a blockchain, I would argue that the blockchain is probably better than the Excel spreadsheet at the end of the day. They're just not, they haven't caught up with it, and there's no regulation that specifically addresses it is the issue. It's just that's become accepted practice by the SEC. So do we need legislation to make that happen, or will someone be able to force their way into it? The SEC still mandates a central securities depository settlement mechanism for most funds as well. So that's DTC. Can you settle on a blockchain? Of course. Should you? Probably. But if the SEC mandates DTC to be the final settlement agent, then you got to work on these things. So, we're very hopeful in the new administration. The new chairman of the SEC won't be as hostile. You can technology always moves faster than regulation. Of course, we get that. But for the U.S. to lead, and I think the U.S. will lead in the space, we're going to get there on the legislation as well. So, again, this is why we're focused on non-security assets as opposed to securities to start, right? There's plenty of non-security assets that can scale. And in non-security assets, you can use things like an MPC wallet and a decentralized exchange to really get rid of custodians. If you have an MPC wallet, theoretically, you don't need a custodian. If you have a decentralized exchange, theoretically, you don't need an exchange. So this is the way that crypto leads, and then I think every other asset class follows.
Well, the SEC has also, put their hand in custody as well, so they're trying to force more assets to be custodied. So that's another challenge to hopefully will improve.
I would just add, though, even when you're talking about these decentralized technologies, there still needs to be some level of permissioning, particularly for these type of real-world assets. Because, use an example, if we're tokenizing the title of someone's house and their wallet gets hacked and it gets phished, do they now become homeless? Obviously not. We would need to have some sort of function in the token contract that allows you to burn or seize back that token, or create a new version of that's the real true version of that deed. So these are all things that technically are not purely permissionless, at least in the crypto context. That real world assets, obviously, it's not probably ever going to be one for one.
And so I love that we brought up custody. That's one question that I love talking about is, do we see a future where I can custody my own securities, even if they're on the New York Stock Exchange or the NASDAQ? Do we see a future where self-custody becomes 5%, 10% of the market, even for institutional investors, or is it still going to be 99.9% custodied by a regulated licensed custodian? Ewan, any thoughts?
It's a tough one to answer, because I think what we most see here right now from clients is still a very keen interest in kind of the more traditional custody model, if you will, even when it comes to digital assets. I think there also the other dimension to this, other than just the kind of reliance on the traditional model in the institutions, is at least for now, there's obviously a much larger share of analog assets as opposed to digital assets. And what what we hear is that there's basically a need for not having those bifurcated and basically providing access for clients in an integrated fashion to both the digital world and the analog world. So I think it's difficult to kind of envision that fully given this.
Thomas, any thoughts?
Yeah, no, I agree with that, and I also think about just when people talk about user experience, you're usually talking about an end user as a person taking out their phone. But when I think about that, I think about the user experience of an institution, right? And the institution has many people. So of course now, and I come from, operations. So I ran in operations divisions where there were, hundreds of people doing jobs, just like, comparing those spreadsheets. So hopefully, we're expecting some of those requirements to go away, but you still have people who have to sort of know where the bodies are buried and things like that within an organization. And they have a user experience. And to Ivana's point, when you have multiple assets across multiple places, if there was a way to aggregate that and kind of the abstraction layer, and I think that's coming, and that's to your point about the technology other types of technology catching up, I think that will move the needle. There's still the regulatory hurdle that if you're a 40 Act fund, you require a custodian, and so that I can't see going away anytime soon. But again, really, it's just you think about the user experience, and if you can make the user experience better by self-custody, then it'll happen, and if not, custodians will still be there.
John.
So I would just say that if the institutional user experience is bad, the retail user experience is also bad, because if anyone's done transactions on chain or engaged in DeFi, it's still not a good user experience. And trying to explain this to someone who's never done it before, your mom or your grandma or something, it's very challenging. It's hard. It's confusing. It doesn't make a lot of sense, and it's dangerous. That's why I think it's really important that we do create a better user experience and a safer user experience at the end of the day, because otherwise, why would you move things on chain?
Great. So I want to do something kind of fun where we're going to ask the two blockchains what they think banks need, and then we're going to ask the banks what they think they need. So Anthony, what do you think blockchains and just the blockchain industry in general can do to make it easier for banks to tokenize assets?
Great question. So stablecoins, we talked about quite a bit. Banks need to be able to lean into some kind of a digital currency that is public and not internal. Internals first, it's going to JP Coin, and what Citi's doing, of course, what Goldman is doing, it's going to be internal to start, but at some point it's going to be the public blockchain from a stablecoin perspective. And then two, playing well with others. Like there's a lot of consortiums within the banks, a lot of internal projects within the banks. They need to play well with others at some point. And I think a neutral public layer one is the place to do these things. We at Providence, we have Cosmos, we have a version of private zones that is interoperable with public mainnet. So you can go in, you can build, and we did this with JP Morgan and Project Guardian and Apollo and Wisdom Tree last year, where they operated on a private zone and they moved a whole bunch of alt funds around. And the theory was when they were ready to go from proof of concept to live, they would just flip the switch to mainnet. Of course, it's still proof of concept a year later. Banks move slow. They should move slow. But when the time is right, a neutral layer one public blockchain that's built for financial services, I think wins the day.
John.
I agree with Anthony there. I would just add, they honestly just need to also bank us because
that's very good point. It's very, very good.
Crypto startups still have many, many issues with actually working with banks. And that just means for basic corporate accounts, it would be nice if they would actually bank our companies and let us continue to grow and build businesses and build technology, because without that access to the fiat world, it is challenging, because I can't pay all my bills for the company in stablecoins.
Great. So we've heard a little bit from the blockchains. Thomas, what do you think? What can the blockchain industry do better so we get trillions of dollars from StockChain coming on chain?
So to your point, I wish that we could bank you, and unfortunately, there's the regulatory concern that I go to my compliance people, and I'm always hoping for a yes answer. It's still always been no, but someday that'll change. But I think from our vantage point, one of the things that I was actually on a call yesterday, and somebody talking about like great ideas and great technology, but not making the connection to how things work in the real world. It's like, I have this awesome idea, and there are plenty of great ideas. And, coming to us and saying, yeah, but this is a solution to a problem that you have, and not just like this is a fantastic idea that's going to do something cool. And it's like Meredith is sitting there. I know we talk about this South Park joke, the underpants gnomes, where so okay, people are laughing, right? So it's like I have this idea and something happens, and then huge profits, right? And sometimes that happens, and I wish that we could avoid the underpants gnomes. So.
Great. Ioana, what can the blockchain industry do to help banks tokenize assets?
So I think to your point, like solutioning, right? I think also, so you mentioned, Anthony, interoperability, and I know that people kind of mention that all the time, but it is the case. And just broadly speaking, all of these institutional grade features that you're kind of like seeing in pockets, if you will, but not quite at kind of broad level, I think, around privacy, kind of certain like scalability characteristics. It's getting solved in many areas, but I think these features, to the point of solutioning and kind of converting it not just from like great idea, but actually into implementation.
Great. And so just a couple minutes left here. So a couple rapid fire questions. First one we'll go around, and then we'll go around. So John, what's the area you feel is most underappreciated in the world of tokenization right now?
Real estate.
Great. Thomas?
Tokenized repo.
I have to ask one more question. Why tokenized repo?
Well, and actually, when I say tokenized repo, it's underappreciated because, as I said earlier, we're doing lots of it, and we're just, we're not talking about it. But the other thing I'll just sort of lean into further is tokenized collateral, and I'll make this a longer answer. I'm giving a presentation to the CFTC on Thursday that's making a recommendation that collateral can be used in token form. It doesn't need any rule changes. The wrapper doesn't matter. And the industry, both TradFi and crypto natives, are fully on board with this. So that's something we hope will happen. With collateral will really move the needle.
Great. You want a most underappreciated area in tokenization right now?
I'll go with feature rather than product, programmability still.
Great. Anthony?
I'd say nothing. This industry is so overhyped.
Fair, very fair answer. So very, very last question. One final comment from each of you. What is something that anybody in the audience should Google when they go home? Maybe it's just your website, maybe it's, check us out, or maybe it's something you read recently, a great paper, research report, something coming soon, anything that the audience should Google when they go home. John?
Mantrachain.io.
Love it.
Self-plug.
Love it. Self-plug is always good. Thomas?
I'll say wait till Thursday, but Google the paper that we're releasing.
There we go. Ioana?
My last Google was semi-fungible NFT, semi-fungible tokens. So, that was mine.
Great. Anthony?
The thing I'm most excited for is a product that Figure has coming down the pike, a yielding SEC registered stablecoin. Working title is YLDS. But again, if you had a yielding stablecoin that you could trade peer-to-peer and it was a security, it starts to change the problem that I mentioned at the beginning, where KKR isn't comfortable using USDC or USDT to buy $20 million of securities on chain. If we can solve stablecoin, the industry explodes.
Love it. Anybody? We have 1 minute and 16, 15, 14 seconds. Anybody want to steal the mic for 1 minute and go on anything? Everyone's very polite up here. No, Thomas, he's going to do it. John's going to do it. John.
Okay, I won't do it for a minute, but I do think it's interesting that we're having several layer one blockchains and banks on the same panel. Like that just didn't used to happen. Maybe because the banks wouldn't let you go on panels with us, but that's changing. I think it is interesting because obviously Forge has separated out, it's wholly owned. Laser Digital, another one which is owned by Nomura, is one of our investors. Goldman Sachs just announced that they're spinning out their digital asset arm, which is also exciting. So you can start to see this separation between banks and whatnot. But I think that needs to continue, and hopefully we'll continue to kind of bridge the gap between our different worlds.
Yeah, I think that's a great point. And I think collaboration is the big thing that's going to really happen to move things forward, whether it be between the blockchain folks and banks, and Ioana and I are working collectively with a group called Global Layer 1, where it's just you're seeing the groups come together to say move the needle forward and have that real collaboration, and that's something that hadn't happened in the past. So that's what we're looking forward to.
Anybody? 5 seconds.
3, 2, 1.
We're good. Amazing. Thank you to our panelists. Everybody have a great rest of your day. Thanks.
Hey, ladies and gentlemen, thank you so much. We do have a couple more pieces of content. Really appreciate this panel joining us. Fantastic discussion. Thank you, Grant, for leading a great conversation. All right, we do have two more firesides, the first of which we have Prometheum joining us with Aaron Kaplan, moderated by Leo Schwartz. Once again, please make sure you check out these slides, scan the QR code, learn about Benzinga APIs. But next up, please give a warm round of applause for Leo Schwartz from Fortune, Aaron Kaplan from Prometheum.
Good morning, everyone. Thank you so much for joining us, and thank you, Aaron, for being here. Always good to chat.
Good to see you, Leo.
Nothing been happening the past couple weeks, I think, so I don't know what we're going to talk about.
Sleepy times.
Well, I think the elephant in the room is Prometheum has been one of the only companies in crypto, blockchain, digital assets, whatever you want to call it, to really try to go for a compliant path with the SEC. You were the first firm to get a special purpose broker-dealer license. Still only been two who have gotten it, and maybe we can talk about what that is. But now, obviously, with Trump being elected, it seems like we might be entering a new, euphemistically uncompliant era. I'm curious, are you worried that all this work that you've done is going to be blown up?
I think there's a need for a history lesson. It was actually Chairman Clayton, who was appointed by President Trump, who introduced the special purpose broker-dealer regulation, which became law. And when we look at what occurs in terms of this new administration, I think that it's very positive because it'll increase the rate in which we go from electronic to digital markets. And Prometheum is really a leader in regulated digital markets.
Well, I guess the question is, during the last administration, obviously Trump had a slightly different view on crypto. I think he called Bitcoin a scam as recently as 3 years ago. Since then, has embraced it. Obviously, Gensler after him took maybe a similar approach to Clayton, but to more of an extreme. Do you basically think we're going to be going down the same path, or are you anticipating any sort of change with how crypto and blockchain is going to be treated in the US by regulators and by the government?
So crypto, we'll see how that plays out, whether it's commodities, securities, new laws or existing laws, time will tell. But our business is really digital asset securities. And digital asset securities is really an expansive concept. It's equities, debt, options, structured products, money markets, treasuries, and investment contracts, which is the catch-all for crypto on chain. And regardless what happens with crypto, I think that the biggest trend in 2025 is going to be securities on a blockchain. And in order for that to occur, you need a market infrastructure. And that's what Prometheum provides through our ATS and our special purpose broker-dealer that allows those assets to be publicly traded, cleared, settled, and custodied.
So maybe you can explain briefly what this special purpose broker-dealer license is, because it really is so important for crypto and blockchain moving forward. And like I said, only two firms have gotten it. The second pretty recently. Prometheum was the only one for a while. I guess one potential concern is, until now, it seems like it's been a fairly rigorous process to be able to get one. Under a more lenient SEC, maybe companies like Robinhood and Coinbase, who have complained previously about not being able to get one, would be able to get in through that front door. How do you think that will impact you?
So the special purpose broker-dealer is the mechanism by which companies can compliantly custody digital asset securities under the federal securities laws. And the special purpose broker-dealer is important because it's really the means by which distributed ledger technology and cryptographic assets can be integrated into the larger financial markets. I think that it's really the crux by which, in theory, crypto could be introduced, but also tokenization and just securities on a blockchain. Now, in regards to other people getting a license, I don't see this as a sort of famine mentality that, we can only, because we're the only one or two, it's bad if other people get it. I think what's going to happen is you'll see a development of a national market system for digital assets, and that requires lots of different special purpose broker-dealers, lots of ATSs, and basically it will follow a pattern similar to how the national market system for equities emerged.
Last question here. Do you have any, and I'm sure I know how you're going to answer, but any guesses who the SEC chair might be? And I asked that because one of the candidates is Dan Gallagher, who's currently at Robinhood, who famously stood, or sat, I should say, in front of a congressional hearing and complained about the special purpose broker-dealer and that Robinhood wasn't able to get one. So it seems if someone like that were to become SEC chair, that could mean some trouble for Prometheum.
We've always worked with the current SEC, who's ever the regulator is. We will continue to work with them. From our perspective, regulation is our strength, and a change in regulation provides opportunity for us to sort of maximize our strength, because we've been the tip of the spear when it comes to regulation and implement distributed ledger technology into market infrastructure. And as that changes, we'll evolve with it.
So you don't think it's going to be Dan?
Time will tell.
You've already today, and I know in previous conversations, have made this distinction between crypto and then between digital assets, or what tokenized securities might be. Can you explain what that distinction is and how you view it? Because I don't know how widely felt it is in the blockchain industry, where it's become a lot more collapsed in recent years.
So crypto is the methodology by which someone determines if crypto is a security is whether it qualifies as an investment contract through a Howey test analysis, right? That's one sort of element or class of securities. If that is no longer a security, whether it's a commodity, security, new laws, existing laws, it provides opportunities for us to continue to maximize on our ability to understand regulation and move forward as these regulations change. But if you look at it from the crypto space, assuming all the major big players are in the space, the Coinbases and the worlds, the Krakens and the like, that's a pretty sort of densely populated area in terms of different crypto companies providing different crypto services. But there's very few people who could actually do digital asset securities. And digital asset securities is basically all securities on a blockchain. And you need to have specific licenses to be able to trade, clear, settle, and custody those assets. And that's not what those crypto licenses allow. So as securities migrate to a blockchain, as digitalization occurs, Prometheum is really in prime position, as we are the market infrastructure that allows the major institutions that are creating these tokenized assets to be able to then publicly trade, clear, settle, and custody them. So we empower those assets once they're created. And as securities migrate on chain and the $100 trillion securities market comes on chain, Prometheum is there to take market share.
So we've heard a lot about tokenization, especially over the past year or two, I would say. One of the newer big buzzwords in crypto, and you've seen some huge players move into the space, like BlackRock has a tokenized money market fund. I know Franklin Templeton is in the space as well. Do you view what those bigger firms are doing as part of your vision to have these tokenized securities on chain?
So the bigger firms are focusing on the creation of the asset. And the two money market tokens you mentioned with Franklin Templeton, the Benji, and Biddle and BlackRock, they're an interesting sort of application, but they're limited because they're not ubiquitous, meaning they're not publicly available to be bought, sold on the general market, right? And the reason that's not occurred is because there's not the infrastructure, meaning they don't use a public market infrastructure to be able to publicly buy and sell those, clear, settle, and custody them thereafter, because they sort of go hand in hand. And that's what Prometheum creates. So we work we're very complementary to all these different sell side and buy side asset issuers and buyers who are looking to sort of take advantage of tokenization to pass on cost savings, unlock additional value of collateral, et cetera. So as more assets move on chain, we're there to hopefully service it on the on the trade side and then on the post-trade side.
So I think Prometheum made a lot of headlines, maybe in Fortune as well, for saying that it would custody Ethereum, having the view that Ethereum is a digital asset security. Obviously, there are these big, very buzzy ones, but can you talk about what some other digital asset securities might look like in Prometheum's roadmap?
So let's leave crypto over here and let's focus on the other sort of asset class that's moving on chain. So you mentioned Franklin Templeton and BlackRock. That's money market tokens moving on chain. There's advantages to that. You have quicker settlement, you get more value out of your collateral, et cetera, et cetera. There's actual advantage to that, right? There's treasuries moving on chain. There's been a lot of discussion of that. There's structured products moving on chain. What we've seen so far is they've wrapped a 20th century ETF around a 21st century asset when it comes to the Ethereum ETF, right? But the reality is it's an inefficient process because you have a 20th century wrapper that settles T+1, initially T+2, but now T+1, and it's wrapped around an asset and underlying that settles instantaneously. So you already have slippage there. So there's a wonderful use case by having a smart contract which represents an ETF that holds the underlying that settles instantaneously for an ETF to be on chain as well. I mean, it's not ubiquitous. It's not like a panacea for all securities. It's more of a question of, is there a use case that allows for efficiency, meaning cost savings from what occurs currently? And what we saw historically on the street is like, why did trading go from paper to electronic? Because it was just more efficient and it saved money, right? The same thing will occur here for the different sort of sub-assets within securities as an asset class, securities in general, as they move on chain. Will it happen with equities initially? Equities work pretty well. Might there be certain use cases within equities? Sure, but there's so many different assets within the general securities umbrella that make sense to move on chain, whether it's from by allowing instantaneous settlement, reducing broken trades, making it more automated, eliminating the resources from a human standpoint, or the ability to just unlock additional value from a collateral. I mean, the world is very expansive.
What do you think is the biggest roadblock to that happening right now? Because again, this is a vision that I think we've heard for a few years now. It doesn't seem like any of these products are happening outside of pilot use cases. Obviously, you know, Prometheum was one of the first companies to be able to launch products like this, but has the main roadblock been a technological one? Do you think it's more regulatory? Do you think it's companies being afraid to move into this space because there hasn't really been clarity on whether it's legal or not?
I think it's been an issue when it comes to infrastructure. So in order to have a public market, you have to be able to do the post-trade side, the clear and settlement custody. And Prometheum launched its special purpose broker-dealer, Prometheum Capital. We went live 3-4 months ago. And that's just the first part, because now you can do the post-trade side. But once you can launch trading, meaning a public market, now you have the full ecosystem, the full infrastructure to allow for the life cycle of that asset to take hold and to blossom. So we have the buy and the sell side issuers, the sell side issuers basically being ready to issue these products. You have the buy side looking to purchase these products, but there hasn't been the infrastructure for that to occur. And when you think about it, Prometheum is really, when you think about it, the Prometheum infrastructure is really where the buy and the sell side could come together for a tokenization party.
So we have a couple minutes left. I'm curious about what the future looks like from Prometheum. When do you think we're going to start to see these products actually launch and become available for institutional use?
So just to clarify, Prometheum's the infrastructure. We're just the place where it's trading, clear, sell, and custody. The institutions are looking to issue these products, or they're looking to purchase these products to basically have some sort of cost savings or to get additional value out of their existing sort of assets, collateral, capital, whatever it is. And there is a lot of attention and a lot of focus there. There's been major reports, I believe, from Citi talking how it's like, you know, a multi-trillion-dollar potential opportunity. And Prometheum can be the infrastructure where all that occurs. So basically, we see this as being the biggest trend of 2025. And we see as more securities move on chain that we'll be able to service them.
When do you think that'll happen?
Q1.
Q1? Do you think trading, launching of these new products, that's Q1?
You trying to get me in trouble, Leo?
Make a little news.
I would very much hope so. I would anticipate so.
And do you think having an SEC and regulation more broadly being more open, it seems like, to experimentation, do you think that's a bullish thing for tokenization?
I think having institutions who are feeling positive from a business standpoint, looking forward to integrating and taking advantage of different innovations and not feeling concerned that they're going to get a letter from the regulator will sort of supercharge that process, which hopefully we'll be able to capitalize on.
Any other products on the roadmap?
You know, there's been a lot of discussion about how staking as a service is a securities-based activity. And it would seem that in order to do that activity would be a good business line for a special purpose broker-dealer. You know, without saying anything, I think there's lots of different opportunities for us going forward.
It seems like maybe staking as a service is coming.
Maybe.
All right, I think that's all the time that we have here today. Thank you so much, Aaron. Really appreciate the conversation.
Thank you, Leo.
Aaron, Aaron and Leo. Really appreciate you all being here. Wonderful conversation. Thank you, Aaron. Thank you, Leo. We do have one more piece of content, and then right after the next piece of content, we have something very exciting that we're very thrilled to present you all here on this stage. But please, without further ado, welcome Mackenzie Salagos and Anthony Pompliano to the stage. Give them a warm round of applause.
Hey guys, I'm Mac, a tech reporter at CNBC, here with Anthony Pompliano, Mike right there. We have 14 minutes. I'm going to get right to it. We're talking about clear shifts in the market post-election. I'm going to treat this like a speed round. We're going to go through a lot of different topics here, starting with the fact that Donald Trump has won. There's been a red sweep of Capitol Hill. And my question to you is, what can the president really do here for the crypto market? Is it a new SEC chair? Is it a strategic Bitcoin reserve? Like, where can he actually make a difference? Because he has pretty much unfettered power with a red Capitol Hill.
Buy Bitcoin and chill. Just do what everyone else does. Just buy Bitcoin and chill. It's not about individual policy. I think it's all about the signal that, hey, we now are changing regimes, and the new regime is pro Bitcoin, crypto, etc. And there's no single kind of high signal like just buying the assets for the United States.
How realistic is it to get a strategic Bitcoin reserve, an SBR or crypto, reserve in place? Because I hear a lot of people are planning 100-day agendas behind the scenes, and that seems to be the one where there's the most sticking point.
I have a piece coming out in 2 hours that I think the United States should buy $250 billion worth of Bitcoin on day one. Where are they going to get the money? They should literally print it. Just print $250 billion on day one and buy Bitcoin. I think that it'll push the price up. As the price goes up, let's say the average purchase price is $150,000. That means that we'll buy about 1.6 million Bitcoin. We already have 200,000. That's 1.8 million Bitcoin. We'll be the largest holder in the world. $250 billion sounds like a lot of money. The national debt increased by $850 billion in the last 90 days. It's a rounding error. And so if you say $250 billion is kind of our expense, but the upside is to be the largest holder of Bitcoin in the world and potentially protect our future, it's such a no-brainer that if you advocate against it, you actively are trying to hurt the United States because you're advocating for the United States to continue to hold assets that are guaranteed to lose value over time.
Okay, after a multi-year dormancy, we saw Stripe announce that it wants to buy Bridge for $1.1 billion. Is this a sign that M&A activity is back for crypto, or that stablecoin, that sector of the industry in particular, is where it's at?
I'm not commenting necessarily on that specific transaction, but I think that M&A is coming back because most of the companies aren't sustainable. There's a lot of people who have built cool products, but they haven't built businesses. And so naturally, the companies that do have defendable, sustainable businesses, they want to get technology, and so it's just an R&D expense to them. If you look at, how many great businesses in the crypto industry exist, we could probably name 15 or 20 of them. There's thousands of companies. And so the real secret is that most of the companies are not good. The coins have been where there's been a lot of value created, but the coins also are bad businesses in the sense of they have these treasuries, but they don't actually have more revenue than they do expenses. And so crypto generally has been a technology experiment. It has not been a very good corporate exercise. And so the M&A happens when people are able to build products, they're able to gather users, but they can't build a sustainable business. And so rather than shut down, there's no path to IPO. And so they sell their business. But I always tell founders, if you got a great business that is defendable and is going to continue to grow, why would you ever get rid of it? Right. And so usually it is the people who are kind of stepping off the train saying, hey, I've taken this as far as I can, but it's not something that's going to be standalone, valuable in the future.
Okay, you've got the SEC greenlighting CoinCheck, which is a Japanese centralized crypto exchange, to list in the U.S. via SPAC. I believe this is the first time since Coinbase that we've had, crypto native exchange actually list. We had Robinhood and Block add that functionality once they were already public. My question to you is, one, is this a reflection of like Gensler already being halfway out the door? Two, is this a sign that suddenly, coming to the public market is again a thing for these crypto firms? And then, I guess, three, to the point that you were just making, with CoinCheck in particular, is this a sign that centralized exchanges are kind of, well, one, are they back, because like, with these ETFs coming online, I think there's this question as to whether or not like there is it's undermining their business model and sources of income. So let's start with public markets and seeing this door open.
I think one of the big lies of the last decade is that an entire generation over-rotated into private illiquid markets. And so if you ask most young people in technology, what do they say? They want to be an angel investor. They want to build a startup. That's all illiquid private stuff. And so if you go and you look at the return profile, the marked to paper returns of venture funds. So that's the most, kind of positive light you could look at these venture funds. The average venture fund returns 17 to 18% per year. So you say, okay, that sounds pretty good. Well, QQQ is up 13% per year. So it's about a 400 basis point difference. That's if you give the venture capitalists credit for whatever their paper marks are. The truth is it's much lower, but let's just use their paper marks. So you get paid 400 basis points of outperformance if you're illiquid for 10 to 12 years. Well, as more capital has flowed into the private market and all these people are going into alts, now all of a sudden you have more capital chasing the same number of good companies. And so that return gets compressed. As that return gets compressed, let's say it gets down to 200 basis points. Is 200 basis points of outperformance really worth being illiquid for 12 years? Probably not. And so I think that there's going to be a renaissance of public markets. Right now, we used to have 8,000 public companies. Now we have 4,000. There's more companies going private every year than there are going public. And so that's why you're getting that drawdown. But I do think that crypto, in a weird way, is going to inspire that public market renaissance, because crypto is all about liquidity. People like investing in crypto because it's like venture capital returns with public market liquidity. And so now you have an entire generation that realizes the value of liquidity. And I think that as they begin to get more and more successful, the capital pools get bigger and bigger. They can't actually allocate exclusively to crypto. You're going to see them start to spread more into the public markets. And so I think that the progression into public is going to happen for the industry in general. In terms of regulators, I just think that, everyone's just kind of exhausted. Right? I mean, like, how many of you are exhausted from kind of the regulatory situation? I actually think the regulators are exhausted, right? Imagine going to work every day and you're like, dude, every day there's like some other, whack-a-mole that's popping up somewhere. I got to go figure out what they're doing. Like, there's these kids online who are just figuring out whatever the latest, greatest thing to invent is, and we don't even know how it works. Right? Imagine telling somebody 15 years ago, we're going to create a decentralized exchange with an automated market maker. Regulators be like, what the fuck are you talking about, right? But today we got to figure out, like, what is the rules? What are the frameworks? What are the jurisdictions? How should people use this stuff? Should it be accredited investors, not accredited investors? Like, there's all these questions. By the time you figure out the answers to that question, there's 6 more things that have popped up, right? Like, think about this. Imagine going to work every single day as a regulator trying to figure out what to do about meme coins. You're like, dude, what are these kids doing? They're launching coins, but they're not raising money, and then they're ending up being worth $50 billion. And because of the way they're launching them, we can't stop them through securities law. Jeez, like, all right, well, how we got to go figure this out? So like, say every single day. So I think that they've gotten exhausted, and I think that the industry's gotten exhausted. And so the path forward here is everyone kind of coming to the table and saying, what's the common ground, right? Where do we actually agree? Let's get some frameworks in place. Let's go forward. And so companies that are trying to go public right now, I think, are just kind of benefiting from good timing and going to be able to eke into the public market.
What about Circle? They've been wanting to go public for a long time.
I think that Circle is a great business, obviously, second largest stablecoin. I think the kind of long-term question for Circle is, if you become the dominant regulated U.S. stablecoin player, does the national government have an interest in nationalizing you over time? It's a very un-American thing, but at the same time, we do know that central banks around the world are interested in these central bank digital currencies. I don't have a lot of confidence in the central bank or the government to build technology that's used by consumers, especially when it needs to be fast and cheap. But if an external firm does that and it's related to the US dollar, I do think that there becomes this kind of weird dynamic where the US is almost dependent on Circle if we continue to see the kind of adoption of these assets. And then you have Tether, which, by all means seems to be following the rules, seems to have, the reserves, kind of all the things that you would want to see, but they're outside the United States. And recently I was talking to some people who work there, and they're like, we're not even focused on growing in the US. We're focused on the emerging markets. We think that's the bigger opportunity. So in a way, you're getting a bifurcation where Circle wants to win kind of the US, developed nation markets. Tether wants to win in developed markets. So when you see those two things happen, I think that, Circle, on one hand, the positive is, hey, they're going to go public and they're going to become really important. And that's probably going to mean that they're going to be more valuable. On the other hand, can you get too big right? And does that mean that at some point, there's some sort of conversation with the government that needs to be had?
Real quick, is Coinbase still a good investment? Yes, they are the custody partner for a lot of these spot Bitcoin ETFs, and we've seen this huge surge post-election.
I'm a shareholder, so I guess on one hand, just yes, because I'm holding. So maybe watch my actions, not my words. But I think that Coinbase actually has something that can't be bought, which is they have trust. And trust can be lost, but you have to become the leading brand. You have to constantly do right by people. You have to have a product that people love. And really, trust equates to word of mouth. And so, Coinbase is now the #1 app in the App Store. Well, how does that happen? It's because interest in crypto is coming back, and you ask your friend, "Hey, I want to buy crypto. Where do I go?" Say, "Oh, go download Coinbase." And so I think that anytime you have brand like that, it's very, very hard to break that trust, but it can happen. And I would argue that Apple is another version of this, where people want to buy the Apple product because it's cool. Like, is the Apple phone actually better than every other phone on the market? Probably not. There's probably other phones out there that are better from a technology standpoint, but there's something about the connected network, right? Being able to use the iPod, your computer, sync them all up. The fact that it's got the Apple logo, it says something about you when you buy it. You're kind of in the Apple family. All that works together. I think Coinbase very much is building a family of products with a brand that ends up probably being pretty valuable.
Okay, institutional money getting into crypto. We have options starting to trade on the NASDAQ and NYSE this week. You've had a lot of trading activity in the CME derivatives exchange already. There's, people have already baked in that SAB 121, that accounting rule that's made it very difficult for banks to custody crypto. That will go away under a new SEC chair. Crypto market framework bill. Essentially, you have this trifecta of good things happening that could open the doors to institutional money coming into crypto. So, what does that look like in this next phase? And because it seems like there are pretty tepid flows right now in terms of spot Bitcoin ETFs, there's still a lot of pent up demand.
Yeah, I don't think you've seen anything yet. Pretty much in January of this year was the start of the institutional kind of true participation. What we have seen is Bitcoin go from $40,000 to $90,000 in a year. Pretty good. If you think about Bitcoin, it is the only asset in the world, the higher the price goes, the less risky it becomes. And so it used to be these large pools of capital couldn't allocate to the asset. Now they can. And so Bitcoin was already adopted by the individuals. We've now pushed up to corporations and financial institutions. Eventually we'll get nation states. And so as those larger pools of capital deem Bitcoin to be less risky, they start to allocate. Those are very large pools. So 1% is meaningful. It pushes the price higher. And so it creates this very reflexive nature to Bitcoin. And then remember that institutions are subject to FOMO as well. I saw a joke, not my comment, but I saw on Twitter that Goldman Sachs was thinking about spinning out their digital assets business. And somebody quote tweeted it and they said, every single cycle, Goldman Sachs starts a crypto division and then shuts it down in the bear market. And they do it again. And so they're human, just like everybody else. And I think that that FOMO leads to not only capital allocation, but also them building. And to me, the final boss of the institutions is going to be when they can custody. And so if you go talk to any of the private banks, if you go talk to large institutions, the day that they can take those clients' assets and put them in their bank, crypto is going to have successfully infiltrated the kind of financial system. And I do think that that's probably going to happen in the next 24 months.
It feels like nobody is talking about sanctions hedges, newly very important under a Trump administration. Talk to me about what this means for the crypto industry.
I wrote years ago, every global reserve currency was put in place after there was violent conflict. So usually what would happen is somebody has the global reserve currency, they've got the most powerful military, another military shows up, they go and they kill everybody. They say, now we're the most powerful country, we're going to put our currency as the global reserve currency. I think that Bitcoin will continue to rise and eventually will become a reserve currency, but do it without dropping any bombs or shooting any bullets. And so it's this idea that in the kind of analog world, it's all about offense. Whoever has the fastest ships, the best weapons, etc. In the cyber world, it is all about defense. If you can keep people out, you are the strongest. And so Bitcoin has this very unique element where it is the strongest computer network in the world. It provides the best defense. Now, what is interesting to me is everyone is talking about country and kind of sovereign wealth fund adoption from an offensive standpoint. I was just talking about America should go buy Bitcoin and do it because it's going to go up. It's going to protect us. It's going to do all these things. But there's a lot of countries around the world that see Donald Trump coming back into office and they say, hey, this guy, he kind of shoots from the hip. One day he's your friend, one day he's not. actually that makes it really difficult to calculate what exactly is the American policy going to be 6 months from now. And I've seen that America now is willing to take the sovereign assets of another nation or citizens away from them in conflict, which we did to Russia. Okay, maybe I should buy some Bitcoin as a sanctions hedge rather than as an offensive tool, because I want to be able to protect what I have as a nation state. And so that's something that has not really entered kind of the lexicon yet, but I think it will, is this idea that Bitcoin can really protect countries from adversaries using sanctions to kind of attack them.
Anthony, thank you. Before you leave the stage, I want to invite Benzinga up for a special presentation, so stay put.
You want to do what?
Thank you, Mackenzie. Thank you so much. Wonderful conversation. Anthony, thank you. In the spirit of today, this is our 10th annual award show for the fintech and digital asset space, right? So we wanted to make sure this is a theme throughout the day, and we can think of no better way to start this off than right now. Renato, a few words, if you would.
Yeah, so thanks for coming. Thanks for coming, everyone. Really appreciate, Anthony kind of joining us today. I know he's got a busy schedule. I've been following you for years, and I first met you last year with Kevin. It was interesting conversations. But one thing, every year we give out awards to people that, we feel that are deserve respect and deserve recognition for the things that they've done. And I think your career kind of is outstanding, and it's interesting. It's how you have your podcast, and now you have your book, and how you always remain humble, and you kind of go out there and you learn and you teach it to other people. And I think there's no better way to learn and become a practitioner than getting these amazing speakers to come out there, to come on your podcast or whatever it may be, and to engage with them and learn yourself, and then distribute that content, and then move further in space. Now you're investing and so on. So we wanted to give you this award, and
thank you guys very much.
Ladies and gentlemen, this is a Lifetime Achievement Award for Anthony Pompliano. Congratulations. Well deserved. Well deserved. Thank you.
I should bring you guys everywhere I go. You guys are really nice. All right. Thank you guys so much. I appreciate it.
Of course. All right, y'all. Let's eat. It's lunchtime. We'll be back on the stage at 1 o'clock Eastern. And thank you again, Mackenzie.
Ladies and gentlemen, welcome back. We hope you enjoyed your lunch, generously sponsored by TickBlaze and Apex Trader Funding. We trust you had a chance to network with your fellow attendees. As we continue with our exciting agenda, please make your way back to your seats. Our next session will begin shortly, featuring insightful discussions and presentation from industry leaders. Thank you for your prompt return, and let's get ready to dive back into the world of fintech innovation. Please welcome Elliot Lane, our MC, back to the stage.
Thank you very much. Appreciate you coming back for some more content. We have some great education so far today. If you missed anything from this morning's session, you can see it online on our website, the Benzinga Digital Assets page. Just go to benzinga.com/events for all our future events, all our current events, any editorial content, blog content, educational content from this session that you missed. That said, we're going to keep it right on along rolling. Make sure you scan the QR code to learn more about our APIs. Get on Benzinga Connect. Make sure to network with each other in our networking hall upstairs. But please, welcome to the stage Paul McCaffrey leading a discussion with Jan Van Eck.
Welcome, everybody. It's really interesting. Literally, as we're walking on stage, we both realized that we have kids in the same high school in the same grade. So it's pretty amazing that you have to come all the way here to figure that out, but that's awesome. So I'm very pleased to be here with the CEO and founder of Van Eck, Jan Van Eck. They have a very different approach to asset management. They take a global view. And while we're here to talk about digital assets, we just had Pomp on stage right before lunch. We're going to get into digital assets, but I figured it would be more interesting to start off, since this is building robust portfolios, to hear more about the macro view and what are some of the themes and trends that you're focused on as we go forward to build a robust portfolio.
Yeah, well, first of all, everyone, thanks for being here, and maybe we can get some questions going because it's an intimate crowd. So macro-wise, the way we look at the financial markets to see all the big trends that are going on, and then look at our portfolios first and foremost. And generally, we spend our 90% of our days saying, stay invested in stocks, stay invested in bonds, have a diversified portfolio. There's maybe one time where you want to take risk off, and that's when the central bank is tightening money supply in a dramatic way. So we don't have that to deal with the Trump presidency. But to me, the interesting thing that's going on is fiscal policy. So I'll give you Jan's crazy theory on fiscal policy. I'll give you two scenarios. Scenario one is no cut in fiscal spending. And if you ask any Washington lobbyist, they're like, yeah, there's no way. I don't care what Elon says, Vivek says, there's no way they can cut spending in Washington, right? And then I'll give you my different scenario, which is the one I favor, which I'll go with Vivek, who said we can cut $500 billion out of government spending. And he said this in a tweet a couple of days ago. And he said, he gave the recipe for how to do it, which the Washington lawyers didn't really think of, which is there's 1,200 programs that are beyond their authorization period. So arguably, under recent court law, you can just say they're unauthorized and shut them down. It doesn't require an act of Congress. So that's your bid ask in the market. And I think the markets don't know what you're getting under Trump 2. What you're not getting under Trump 2 is the fiscal stimulus that you got under Trump 1, which is tax cuts, because the Senate is not going to go for tax cuts under our dire fiscal circumstances. So that's it. It's either no cuts or a lot of cuts. And I think no cuts at all. I don't think the financial markets will be very happy. Own more gold, more Bitcoin, and watch out for 10-year bonds.
All right, great. I'd love to dive in more on the crypto side of it and the Bitcoin side of it with this financial reckoning. What are some other trends globally that are investable, knowing that you can make a decision anywhere in the world? Where are the markets that are interesting to you?
So what's going on in the world? I think there are two things internationally that are multi-year trends, I think, that are very, very interesting. One is the emergence of India, which is the best macro story in the world. So you probably don't know this, but the Indian stock market over the last 10 years has matched the returns of the S&P. And over the last 20 years, it's passed the returns of the S&P. So it's a pro-equities country, and it's a free market country, and it's got the best macro setup, I think, of any country looking forward. You've got demographics, you've got pro-business climate, and you've got digitization, because they made cell phones so cheap, a couple of bucks a month, that now basically it's affordable to the entire population, and they've made payments, identification, and other government papers all digitized. It's basically probably what Elon wants to do. So I think India is a tremendous setup. People say the stock market is overvalued. I still think you got to own some India. And the two mobile phone companies that are the survivors, I think, will be the gateway between the consumer and the internet. And those companies in the US and globally have always been the ones to make a ton of money. So that's my, internationally, I don't think you should look at indices, you should overweight India.
Okay. Avoid India. It's one of the major superpowers, right? Emerging superpowers. Of the existing superpowers, besides the United States, is China investable?
I don't know. That's tough. What I'd like to say about China is, first of all, pre-Xi, China and the U.S. solely, those two countries drove basically 100% of global economic growth. And China's clearly slowing down for a number of reasons. The narrative, I think, that we're getting from the press is really, really misleading, because all you hear about is the property crisis in China, right? Anyone hear anything else? I think what we're missing is that they are really trying to be competitive in many industries, and they are coming close to matching us. Electric vehicles, they've beaten the US and China, and Germany, excuse me. You have solar panels, you have high-speed trains, they're building nuclear plants at a fast pace, they have AI compute centers, even though we think they don't, because we think that we don't sell them any NVIDIA chips. So to me, the narrative about China is this property cycle will be over, but we do have an economy with industries that are leading the world and are going to be tough competition in a lot, and are tough competition in a lot of areas. To answer your question, I do think, you want to own some Chinese equities that are not vulnerable to the tariff narrative. So some local healthcare companies, biotech, some of the tech platforms, I think you don't want the exporters, I don't think, over the next 3 to 6 months, because it's just going to be too volatile.
Interesting. And on the tariff point, I guess that will potentially factor into this last part, the financial, the fiscal reckoning that you were mentioning. It could have an impact on inflation. We'll see. Maybe it's just negotiations. But I'd love to dive a little bit more into the fiscal reckoning, because that, I guess, is one of the ways that it's relevant for this conference here, right? Because of the investing in Bitcoin and other cryptocurrencies. How do you make this decision? Gold, Bitcoin, et cetera?
Yeah, listen, my first point would be that our budget deficit is the elephant in the room. And I think it hasn't been reflected in our financial markets. I don't know why, but it's going to be crazy when you look back, when our kids are older and they're talking to each other. They're going to say, why was the US spending so much money when you had full employment? That's just unbelievable that we're putting that debt burden on their generations. Any economist will tell you, at the rate the US government is, our fiscal deficits and debt levels, every country with our profile has gone bankrupt. Okay, it's that bad. Now, I think it's been masked by our great equity markets. Government spending has helped it boost the economy in the short term, but I really think it's the elephant in the room. Having said that, it's very hard to time financial markets, right? So, generally, I would say, if you're ever going to own a hedge like gold and Bitcoin, and I've been saying this for a year and a half, own it now. I own a lot personally, and have that be your hedge to the kind of uncertainty that we're facing.
But why not just gold? I mean, your father back in 1968 saw this thesis, right? So why is it not just gold? Why Bitcoin?
They're complements, and we can see even this year. And I say, listen, if you take a step backwards, gold and Bitcoin tend to move together. Like, they made all-time highs this year, right? They started rallying about the same time a year and a half ago. So in general, but if you look on a day-to-day basis, you're like, these are completely different animals. Like crypto rallied last week, and gold was down. So I think if you combine them, they work really well together, and the overall narrative is the same. Obviously, the drivers are entirely different. This past month, you've seen kind of the most extreme change in regulatory posture for any industry ever, from choke point 2.0, 3.0, whatever, to complete acceptance and your clients wanting to do a deal with Donald Trump's SPAC. I mean, it's just unbelievable, right? So that's helped crypto. Gold, I think, sold off because markets became a little less worried about budget deficits, but I think that's a temporary reaction.
And I'd love to talk about the demand side and how that could evolve. But first, let's just go back to gold again versus Bitcoin. How do you get over, because I'm getting this now that Bitcoin's approaching 100,000 and a lot of friends who are coming out of the woodworks, hey, Paul, should I be buying Bitcoin up here near $100,000? I just don't get it because it's not physical. How do you get over an asset that's not physical? It's intangible. What's the argument for value for an intangible asset?
I mean, the beauty, I mean, I probably don't need to tell this group, but the beauty of Bitcoin is limited supply, right? I mean, and so that's the appeal. And they say, well, it's not real, I can't touch it. I mean, everything in our life is digitized almost. I mean, not our friends, but our friends are becoming digitized too, almost. For some kids, they are. But, you know, music is digitized, right? We don't have carry records around or 8-tracks or whatever. So I think that argument is not the one I hear the most is just the volatility of the asset and how people allocate to it.
Got it. And now shifting back over to what you had mentioned about the change in DC, it's kind of almost like the coast is clear. How do you see this playing out from new people coming in, new institutions? What is that migration that gives you comfort that there's going to continue to be increased adoption? How does that play out?
So in a way, our base view is you haven't seen the breakthrough application for crypto yet. Okay, you have Bitcoin. But what other app is really used by 100 million people a month? Nothing yet. However, our premise is that there is a breakthrough use that's right in front of us and is happening this second, which is the use of stablecoins. Put another way, the global payments system is being rewired as we speak, and people are using stablecoins as the backbone. You have bank accounts into stable coins, into FX transactions, and a lot of companies are now using that, again, starting with the emerging markets, but that trend is really happening. And I think it's a little bit invisible to Americans because we'll probably never be sending, kind of stable coins to each other. But in many countries, that's the case. The volume of stablecoin usage, which is what I think is more important than AUM, is approaching twice that of Visa. And then you saw this Stripe acquisition of Bridges, right, which for $1 billion, which got a lot of people's attention. So to me, the emergence of stablecoins is the thing that's happening going forward, and we're investing in the software companies that will make it useful. I was at a conference, maybe this is helpful, but a client says, well, when am I going to be able to take stablecoins into my client's accounts? This was an RIA. I said, well, that's a good question. Probably Schwab. Our thesis is Schwab's not going to build that capability to take USDC themselves. There'll be people that will provide that rails for them, but they're going to want it. I mean, can you imagine last Monday, we had Veterans Day here in the US and no one could send money to institutions in the United States? That just doesn't make any sense. And that world is going to be gone in 3 to 5 years.
And it sounds like that's one of the things high on the agenda for, in a bipartisan way, that we should see something coming next year. Do you think as they go through this, is it going to be trying to bring the stablecoin issuers into the system? Because it sounds like a lot of the politicians really want to see it part of the banking system in the U.S. And I mean, I guess that's the first part of the question. Does it get more embedded into the existing financial ecosystem here in the U.S.?
I mean, I look at the structural fight over crypto is between the banking regulators, the security regulators, and the commodity regulators. And it's unbelievable that the SEC has almost fumbled this asset class so bad that it'll be the commodity regulators that take jurisdiction. But I personally am absolutely rooting against legislation because in my view, the way Washington works is we'll all go to sleep and at 2:31 in the morning, you know who's going to come out with their knives? The banking lobbyists. And they're going to make it so you have to be a bank or something crazy like that to use stable coins, and they'll just make it bad because they love control. Jamie Dimon loves control. The banking regulators love control. So that's my nightmare. So I don't sleep that well. If the ball is bouncing in DC, I prefer them to be completely passive.
Got it. And early adoption of Bitcoin happened in a lot of places where they just needed to protect their wealth because their own currencies were devaluing and they didn't have ready access to the dollar. But now these stable coins are offering a stable option versus their own currency. Is there a little bit of a crowding out effect for Bitcoin because of that? How do you think about that in terms of the competitive dynamics that stable coins create versus Bitcoin?
Yeah, I don't think so. I think the crowding out is really by providing more, let's call it dollar access to countries of, let's say, like Argentina. What that means is that it's more pressure on the Argentinian peso than it is on Bitcoin, because I think because of the volatility of Bitcoin is kind of a different story. But what is so deeply embedded into me is the younger demographic. I mean, that's the thing that screams out to me is how, and I'm not the first person to observe this, right? But it's just so unbelievable. The younger generation is so crypto friendly, regardless of these crazy bear markets.
Yeah. And it could be someone in Argentina may prefer a dollar, but the reality is, as we just saw with Ukraine and Russia, we took $90 billion of treasuries from Russia and gave it to the Ukraine, so we canceled those dollars. So on the other side, is there a factor, going back to your thesis on China and India and global powers, is there a de-dollarization factor that weighs into sort of your view of Bitcoin?
100%. I mean, I think that single act and the fact that these are sovereign countries that don't want to be part of some dollar ecosystem, like India, for example, I think it'll be consistent. Why is there demand for gold? Because there's no alternative, right? Who wants to sell dollars and buy euros? Anyone here? Anyone want to buy renminbi? So what's your choice? And that's what all these central banks are doing. They're buying gold.
So Michael Saylor just did $7 billion of an ATM to buy gold through equity issuance. Last night he did almost a $2 billion convert. So already well through the $42 billion announced plan that was supposed to take multiple years. So are you going full Saylor? Is this all Bitcoin? Or are there other assets within the ecosystem? How do you make that decision of, should I have some Solana? Should I have some Ethereum? Should I have some of these other utility tokens? Like, how do you make that decision as you're building a robust portfolio?
Listen, I think blockchain is very different from Bitcoin. And I think it's probably even too early to know what's going to be the blockchain winner. I think one thing that was really positive for the ecosystem last year that we were talking about is the fact that prices became low on blockchains and predictable. Right? What was the problem with Ethereum and Bitcoin? Transaction fees were incredibly volatile. No business or real organization is going to build on a blockchain or use any product when you don't know how much it's going to cost you. Right? If you showed up at the Benzinga conference, you think it's $100, and it turns out to be $10,000. Like, it's completely unpredictable. So you can't have that. That problem was solved with Solana and the layer 2s. But we think if you don't understand the full dynamics of, I call it like Ethereum's market share and its revenue model and how that's been changing over the last 24 months, then you shouldn't be picking crypto, and you should be giving it to a manager or staying away. Okay. So even though I think that stablecoin usage is going to explode, it's not clear to me what other tokens are going to be the clear winners. And we talk about the risks.
Got it. And I can't let you off stage without giving your a price prediction and for Bitcoin. What is the Van Eck price prediction?
The Van Eck view. Well, Matt Siegel's our head of strategy for crypto, and he's actually combined our views very nicely. So he says this cycle maybe 150 to 160, and then just based on the halvening cycle, that would be a 10x move about from the bottom, 180. And then there'll be some kind of correction, and then the next cycle, about $400,000 of Bitcoin, which just makes me happy because I've been saying for years I think that Bitcoin will be about half the value of gold outstanding. So that would be about 400,000 these days. So who knows? Then he goes hyperbolic and thinks that everyone's going to adopt it. And I'm like, I don't know.
Well, given
I'm not going to even repeat that.
But given gold is one of your the assets for a robust portfolio, there's potential that the gold appreciates. So is the concept that even your 400,000 price target could move if it's a percentage of gold, as long as gold's appreciating versus the dollar, which it probably should, then hypothetically your long-term target on Bitcoin could appreciate significantly.
I mean, are we going to blow up our financial system in the U.S.? You need a hedge. I would certainly say that. My father would say no paper currency has ever survived in the history of, in recorded history. So, the Warren Buffetts hate gold, right? They think, U.S. equities are the only way to invest. And even in an inflationary cycle, equities will be fantastic. I don't know. But then it's a matter of time frame, right? And people say, look at Japan. Japan could do yield curve control. They're 20 years delay in their fiscal reckoning. It's possible. I don't know if we're that competent here, and we have much more open system.
It sounds like we're all relying on Elon Musk and Vivek to get something done at the dog agency, the Doge.
I am of that school. I know it's hard to see now, but yeah, pounding the table on that.
Excellent. Well, thank you so much.
Thanks, Paul.
Thank you, everybody, for showing. Thank you.
All right. Thank you very much, Jan Van Eck. Appreciate you being here with us. Thank you. All right, y'all. We have a wonderful panel coming up next, moderated by Benzinga's very own Renato Capelge. Please give him a warm round of applause. We'll let him introduce the next panel on innovations in staking, mining, custody, and beyond.
Okay, so I am actually filling in for a absent moderator, and I'm going to preface this by saying that my understanding of some of these things is a little naive. So, but these are the experts, right? So they'll be able to answer my questions. But before we get into it, just want to introduce myself. My name is Renato. I basically kind of help put together this event in terms of the agenda and the content, and today, we're talking about building the digital asset securities ecosystem. So I'm going to let these folks introduce themselves, starting off here at the end.
Hello, can you hear me okay? Hi, Kevin Maloney, iTrust Capital. Our platform started in 2018. We allow individual retail investors to access digital assets through a non-taxable IRA. So we've got 55,000 people on our platform, about 4.2 billion in assets, and we've done about 10 billion in transactions. We work very closely with a few qualified custodians, liquidity providers, and storage providers. Thanks for having me.
Hey everyone, Ben Spiegelman here from Figment. Figment is the largest global institutional staking company. So we run infrastructure on about 40 different blockchains, Ethereum, Solana, and many others. We have about $15 billion on assets staked to our validators, typically from large custodial partners, exchanges, VCs, token holders across the space.
Hello, my name is Paul Giordano. I'm the VP of Digital Asset Management at Marathon. We are the largest public mining company, Bitcoin mining company. We have about an $8 billion market cap, and we hold about 30,000 Bitcoin currently. And we are involved in other technology stacks on top of Bitcoin mining that we can get into in more detail.
Hi, I'm Robert Murphy. I'm the chief economist at Infinio, and big picture, we're taking life insurance and putting on the blockchain. We have about $252 million on chain currently. For relevance of this panel, one of the things we're developing is the ability for life insurance policyholders to pledge their cash surrender value as collateral in order to mint a stable coin that we think is very unique.
Got it. Thank you all for joining me. So if I kind of recall when we were doing the prep call, we were discussing a lot about in terms of like innovations in staking, mining, custody, and beyond. So I want to start at a high level, and since some probably the least prepared for this, I'm going to let you, whoever wants to pick up and answer that question, and then we'll kind of bounce off each other. But at a high level, can we talk about what staking is and why there's such a difference between, you know, the sort of staking that you have maybe on an Ethereum network and a Bitcoin network?
I'm happy to do that. So for most people who don't know anything about staking or mining, there's sort of like two different primary consensus mechanisms that power blockchains. There's proof of work and proof of stake. Obviously, the first one with Bitcoin was proof of work. And the idea here was the more machines, the more servers you throw at it, the more likelihood you have of proposing the next block. And as so, you would get Bitcoin as reward. And with Bitcoin, we saw that that was potentially not the most economical procedures, environmentally taxing. And so in the next iteration of blockchains where we wanted to be able to use smart contracts, be able to be more useful, this open world computer where you could have hundreds of thousands of transactions per second versus where Bitcoin is much slower, there was this new invention called proof of stake. And this invention was less about the actual idea of throwing more servers at it, but the idea that you actually make the users who actually hold the underlying asset, Ethereum, Solana, et cetera, pledge those assets to the protocol as collateral to help approve the next transaction. And so I think that's sort of like initially how staking got started was you pledge your assets to the protocol as such for locking those assets up. You then help make the chain work from one block to the next, et cetera, proposing those transactions. And as a reward, you receive more. And so that ends up looking like yield or rewards to the protocol. And over time, I think as the market matured, people that had the largest amounts of tokens were institutional holders. And so those institutional holders didn't really understand the idea of actually running the Solana network or the Ethereum network or the 30 other chains. And so they typically have delegated those assets to providers like Figment to be the experts to run those chains. And so we take a small fee of those rewards, and the provider in a very seamless way can be able to hold their tokens, help secure the network that they're actually supporting by staking those assets, and then receiving an economic reward for doing so.
Got it. Okay. So what are the levels of, you know, staking you might have on an Ethereum network versus, you know, Bitcoin?
Should I do that one again, you think, for the staking guys? So there's been no staking at all on Bitcoin up until like the last probably 6 months or so. And it's just been this new paradigm that's come around, is how do we make Bitcoin more like the other networks? Because that's what we do in crypto. We're just copycats of everything else that's worked and made people money. And so for the staking world and Bitcoin, it's a new iteration, right? It's not necessarily about staking the underlying Bitcoin that's on the protocol, because you'll hear from Marathon and others that it's still mining is powering the Bitcoin protocol, but it's layer twos. So it's other networks on top of the Bitcoin network that utilize the Bitcoin security protocol to be able to do more efficient things with the Bitcoin network, right? So lightning payments or other use cases to leverage the Bitcoin network are being built on top of Bitcoin, just like it happened with Ethereum, where we saw Arbitrum and Optimism and Polygon and all these L2s that were built on top of Ethereum to make Ethereum more efficient. The same thing is happening with Bitcoin. And now those L2s are actually having staking in them. And it gives Bitcoin holders the ability to actually earn Bitcoin rewards by staking those other layer twos. So it gets a little bit complicated. It's still very, very early. It's just sort of the very early days of this. There's opportunities like Stacks and Babylon and Core are some of the early leaders that we're seeing evolve from this next iteration. But I think it's probably something that we'll look forward to more in 2025 and 2026.
If I could add just one bit, and that's very well said, but as far as from the Bitcoin mining side, we look at the staking as really only an opportunity on the L2s, as you mentioned. We think real world assets will want to be tokenized and will want to be on the most secure network, which is the Bitcoin network. So we're a long way away from that. We're not fans of staking our Bitcoin and getting some sort of token, and hopefully that token will have value at this point. So we're still very, very far behind in turning sort of a store of value, which is Bitcoin, into a store of usage, as you mentioned.
Thank you. also, right, part of the conversation in terms of like mining and sustainability. One of the big things we talked about, or like the phrase that was thrown around, was Bitcoin mining being described as kind of like a load balancer. So what does that mean, and how can the mining industry further align with sustainability goals and contribute to the energy ecosystem?
I guess that's for me because I'm the miner up here. Okay, so there's a number of different ways to look at load balancing. When you're looking at a large utility, so it's like ERCOT in Texas, it's a public market, so the price of electricity goes up and down on a daily basis. And if you add Bitcoin mining to that stack, we can reduce our demand by turning off our computers when the energy demand is high, and we can turn them on when energy demand is low, which gives the utility a more stable cash flow. In the world of alternatives, we can put our mining equipment in harsh places like North Dakota next to a wind farm, or in Arizona next to a solar farm, which really only draws energy at certain points of the day, and that might not match up with the demand in the local area or connectivity to the grid. So that's a way that Bitcoin mining in a very short period of time can add a balancing effect to utilities and to the renewable energy space.
If I could just jump in, I used to work in energy economics before I joined Infinio, and just to piggyback on what he's saying here, that part of the issue to keep unit costs low, ideally you just want to have like the capacity being used throughout the day. But of course, like, between 9 a.m. and 5 p.m. is when the people in a busy city are using electricity, and then they don't use it as much as night. And so that's why, they want to have so-called smart pricing and smart meters to give market pricing, to get people to like plug in your electric car at night whenever, the load's low. So that's why to have Bitcoin mining as being this big draw, which can be done at any time of day, it doesn't really matter. That's really great in terms of the planning for the infrastructure for the grid.
Yeah, if I could add one more thing, we're doing a joint venture in Kenya next to a hydro dam that is not connected. The electricity lines are not built out to the local villages, but they don't have the money to build those out. So we're able to put Bitcoin mining machines there, pay for that stranded energy so that they can build out the community web.
Got it. Now, when you're going through, you mentioned North Dakota, and when you're going to these different places or whatever, what is there? What sorts of conversations are you having maybe with policymakers or people who are in charge, and whether those states or even countries you may be trying to operate these sorts of things in? What are the sorts of conversations, and how do you educate them on how this actually works, and try to remove like the negative associations with it?
Yeah, it's all part of the educational process of being this load balancer, as we call ourselves. And so, the utilities like us because we can add to that flexible load. It's kind of like offering an airliner the ability to buy every empty seat on a plane. The plane's already flying, and every incremental dollar matters to them. So we can be that incremental dollar to the utilities. We need to be a good neighbor to mining machines make noise, and that has to be controlled and worked with the local community. So it's an ongoing, not only national lobbying effort, but like a local community lobbying effort of where we are and how we can help in both situations.
And how is that the narrative and the understanding changed in the last couple of years, and how do you expect it to change given maybe this new administration and so on?
Well, finally, it looks like we're going to have some sort of regulation, and it's a lot easier to operate a business under even strict regulations rather than to receive a Wells notice. So I think overall, no matter whoever runs the agencies going forward, it's going to be a lot more open-minded than previously. So which we're happy about. But again, it's an educational process up and down the stack. To make sure everyone knows how Bitcoin mining doesn't take away from local communities, it adds to them.
Got it.
Just to chime in on that as well, that just a lot, as the incoming administration, there's a lot of people that are going to staff the agencies that are more market friendly, let's call it. And that's really important. Many of you are probably familiar with like the alleged deregulation in California years ago, and people say, oh, the markets don't work when it comes to electricity. Economists knew ahead of time that wasn't going to work. They basically freed up prices at the wholesale level, but not the retail level. So clearly it's not going to work. So hopefully, we get people in there that understand how markets work and at least give some regulatory clarity, as he's saying.
Got it. I want to move a little bit into custody. And so explain to me, what is custody and why is it kind of like a cornerstone in digital assets? And how do you balance the demand for self-custody versus, the need for institutional grade solutions?
I can jump in there. As I mentioned at the beginning of the intros, we have about 55,000 people that are entrusting us with their digital assets. We use qualified custodians to store and hold those in their name. The custody is super important. Most of our client base are sort of like guys like me, soccer moms and dads. They're crypto curious. They're not necessarily fanatical experts. So they don't understand or want to take the risk of holding their own keys. And so we use 3 different custody providers in Fireblocks, Fidelity Digital Assets, and Coinbase Prime Institutional. And that hybrid approach of cold versus a little bit of warm with MPC, MPC, multi-party computation, allows us to store most of our assets, our clients' assets, in cold storage offline, very secure, with a little bit of access to assets that are needed for withdrawals. We have a lot of clients coming in and out every day, 55,000 people, self-directed 24/7 coming in and out. So the safety, security, and peace of mind we give them for those that don't want to control their own keys, it works really well for us. There's been a lot of innovation in that area. We can get into that later, but I'd love to hear from others about others that are using custodial providers and having access to keys, etc.
Gotcha.
Yeah, maybe I just chime in just a tiny bit here. So I think in terms of crypto, like in the traditional world, you think of custodians as being like Bank of New York or State Street, where like the end retail user is not typically facing off against them. But it's changed a little bit in crypto because it's just so imperative to the actual technology. Like wallets are the #1 base level thing that you must be able to understand, or you have to use a platform like you guys where you abstract that away and make it even easier for the user, right? So there's sort of like either you go to a platform where you trust it, whether that be Coinbase or through an IRA platform, or you actually can then have, sort of like some of the ethos of crypto to some extent, which is this like self-custodial model, which is where a lot of people started very early by buying ledgers, being able to manage seed phrases, but that comes with its own type of risk, right? If you lose that, then you actually lose the underlying assets because it's a bearer asset, right? So if you lose the actual fundamental amount, you are going to lose that asset and never be able to recover it. Very differently than if you use a platform where you have a percentage of the overall pool of assets, or if you go log into your checking account, right? You may see you have $100,000 in your checking account, but they don't actually have $100,000 marked with your name on it. So it's just a very different paradigm, and wallets are the core of what actually makes digital assets key to each individual person to make sure that like it's a very different model. It's a little bit more of like a sub-custodial model than it is in the traditional markets.
Got it. How do you define trust in custody? And what sorts of standards or have emerged or exist to that kind of allow participants to understand what is trustworthy and what is not, and what is a standard?
Yeah, there's varying divergencies of people's definition of trust and around crypto. Ours is really the framework is just transparency and access. And I think there's a lot of innovation that is going to be forthcoming over the next 12 to 24 months. We met with Hester Peirce, Commissioner Peirce from the SEC at our office for 2 hours earlier this year. They don't regulate us. The SEC does not regulate iTrust Capital. However, we act like a regulated entity with a lot of transparency. And we talked about ideas, challenges, regulatory clarity, education, and a lot of transparency. I think that giving people transparency and proof of reserves that your stuff is really yours, even if it's in a sub-ledgered account with an institutional storage provider, is super critical. And I think we're going to see more of weekly or monthly spot check or attestations, not annual audits that are stale the next day where you can shift things around, but weekly spot checks where people can go in and see your client's cash position, see their crypto position, see the wallets. Now they can view but not transact. And I think that's going to further validate and give transparency to the space because people want to see it given what we've been through. There's always bad actors, there always will be, but I think that we're going to see a lot more regulatory clarity. We're going to see a lot more transparency and requests for that. And that's going to give more comfort to the masses as this new administration, and I don't think it's all hyperbole, will continue to have a little, wind at our back. And I think that when the masses come on, they're going to want to know, is this real? Can I have access? And is it safe?
Got it.
Yeah, just to add to that, I think custody is an underappreciated risk in this industry, and I think there's been a lot of improvements over the past few years, and it seems like going forward, some of the larger banks like State Street will be able to custody Bitcoin at least, and other assets going forward. But as a public company, we are audited very, very strictly, and so to be able to have a federally chartered bank, we use 4 different custodians. To have a federally chartered bank holding these assets, which are viewable to our auditors, viewable to their auditors, and all at the same time, without us having to be involved, takes a big risk out of our HODL strategy of holding Bitcoin.
Yeah, so what we're doing at Infinio, again, is allowing people to pledge the cash surrender value of their permanent life insurance policies. If you're familiar with that concept, is like the collateral that you can then either borrow against traditionally or issue stable coins. And so, yeah, as far as the trust, where it's a fine line, because somebody who, they don't want their life insurance policy details, like their health rating and name, to be on the blockchain, obviously, but yet the people need to know when we tell them these coins are backed up 100% by cash surrender value. So that's what we're trying to do, I think, in line with what the other panelists here are saying, that a level of enough of what you need to be able to be sure that, yeah, there's cash surrender value backing these coins up, but at the same time protecting personal information. And as far as, again, we're building it on the front end so that if a client doesn't want to deal with a wallet and doesn't know what that is and they're afraid of losing their passphrase, then we can just do it ourselves. Or if they really want to hold the keys, then they can do it that way as well. So we're trying to cater to both.
Yeah, I mean, a lot of the risk that happened in the last cycle was not really about like someone hacking the MPC technology or the wallet technology, the largest custodians, right? It was bad actors who were rehypothecating assets and doing sketchy things, right? It was about exchanges and aggressive market makers and trading firms that were doing things that were illegal / sketchy. It wasn't like all of the major custodians got hacked with their wallet technology and stole, lost billions of funds. And so I think that like the industry, although like everyone gets worried about digital assets being stolen, but it's actually been more about rehypothecation of assets and mishandling those assets in nefarious ways has caused the bad actors. But the custodians have been doing this for a very long time. BitGo, Anchorage, Coinbase, Fireblocks, Fidelity, like most of these players have been doing this anywhere between the last 5 and 10 years, which isn't 100 years, but it's been a pretty good system for a long time and haven't had any major concerns. Not to say that there are no risks at all, but I think that they've really done a very good job of having parameters in place, both traditional methodologies and also crypto like security measures, to make sure that like it's not going to be the wallet that's bringing down this industry. It's going to be bad people, and so we just have to all hold each other accountable to make sure we're being transparent, we're being truthful, and all that stuff to make the next billion users feel comfortable coming in and having crypto wallet and participating and working with games and DeFi and everything else that will help make crypto more than just a store of value of what it is today.
Gotcha. When you say the word rehypothecate, what exactly are you referring to?
Yeah, so rehypothecate is more about like you have an asset doing one thing and then you're using that as leverage to go use it somewhere else, which is a very traditional finance use case, but if done appropriately can create more liquidity and more opportunity in the space. But when it's done 1, 2, 3, 4, 5, 6 times, and then you start creating leverage without actually collateral underneath that asset, becomes a little bit like a house of cards, and you create a bloat in the system. And so when things go down 1 or 2% and you don't have the reserves to back it up, there start to be massive redemptions across the space and liquidations, causing prices to drop dramatically. And then it's just a spiraling effect. So not trying to give the doomsday scenario here, but that's, I think, again, as long as you're dealing with trusted counterparties, they're typically going to tell you exactly how they're handling your digital assets or purely letting you be the user to handle your digital assets in the way that you want.
Yeah, and the banks obviously can loan. The trust companies cannot. And the qualified custodian, typically the definition is either a credit union, a trust company, or a bank. The trust companies that are custodying our assets cannot loan, lend, rehypothecate, pledge them as collateral anywhere. And if they follow those rules, it actually works really well.
if I could just jump in more generally, I think blockchain and smart contracts really do offer the promise of helping to stop some of these boom bust cycles. Like after the '08 crisis, I just called some of the people I knew, like at the ratings agencies, to say, how did that happen, you guys, that you were so off on these mortgage-backed securities? The one guy leveled with me. He said, we didn't even know we're in these things. There were some physics PhDs down the hall that said it's AAA, so we believed them. And so, that someone really, they were talking like that. So I think the promise with these guys are working on, what we're doing in Infinio, is to allow more transparency, so at least the ultimate investor can go through and see what exactly am I buying, what's in here.
Got it. Thank you. Looking forward, we've got about 5 minutes, but how do you see collaboration across staking, mining, and custody providers influencing the adoption of digital assets? So how does it all work together?
That's a long question. Yeah. Sort of how are those things all coming together? You think long term? Yeah, I mean, I think what we say at Figment, to some extent, like wherever there is custody, there will be staking. That's sort of like our mantra. Like where there's wallets, you want to be able to participate in the underlying protocol. To give you examples, right? Some of these proof of stake chains like Solana and others that have been around for 2 or 3 years and natively were proof of stake are about 75% of 80% of the entire market cap of those assets are already staked today. Ethereum, which newly came to proof of stake in the last 12 to 18 months, it's about 30% of the network. So I think those numbers will continue to increase. And it actually, the one part that I haven't talked about a ton is that as more assets are staked, it's much harder to attack the underlying protocol itself. So people have heard about the 51% attack with Bitcoin. With proof of stake, it's 33%. And so when those assets are staked, and a huge percentage of the market cap is staked, it takes a much longer time to be able to actually attack the network to get above that 33%. So I think what we're actually building overall with having higher utilization rates of staking is you actually decrease the risk vectors for people coming in, buying a huge portion of the network and being able to attack it. So I think just we'll have safer networks with more trust, and hopefully over time, like more real world assets can be put on these public blockchains where you believe in true settlement and finality of these networks to finally actually get you to where you want to go.
Yeah, and I would say the ecosystem is critical. I mean, the 55,000 people that we have entrusted us with their assets on the platform through our custodians, the ecosystem is critical. We don't do the federally chartered banking. We have 4 different banking partners there. We have 3 different custodial partners. We have multiple liquidity providers, many of which are here in the audience or attending today. We also look to our clients to give us feedback. What do you like? What do you not like? And so that helps guide us for products and services. We did some beta testing, some on staking, and it went phenomenally well. We weren't super comfortable with sort of where the regulations were going and the inquiries we were getting from various states. This is a few years ago. So it was a short beta test. We didn't lose any money. Everybody got their money back. We learned a ton, and then we said, we'll sit on the sidelines until it starts to get a little bit of wind at our back. This new administration could open the doors for the masses. And I think in that ecosystem, if everything's doing the right thing, being transparent, getting regulatory clarity, we need the regulators, giving access to educational tools and resources, and there's upside, I think the ecosystem drives mass adoption through the next 12 to 24 months with another billion participants coming in. But it really does come down to all of us delivering measurable value with a lot of transparency, and that's security all day long.
So the promise that I see here is just giving more options to the end user. Just to give a quick example, when Silicon Valley Bank was in trouble, people were like, "Oh yeah, tech bros, haha, getting what they deserve." But there was a school that they said our teachers' payroll was with them, and we didn't have it parked there because we were looking for yield. Where we have to put your payroll in the bank. What are we supposed to do? And they weren't investing in risky assets; they were sitting on treasuries. It was the interest rate risk, right? And so it goes back to fractional reserve banking. And so the promise here is for people who they're not looking for yield, they just want to know my money is there, and I know they didn't lend it out to somebody else. As we're saying with the rehypothecation, like we're giving more options like that, so people can just truly hold the type of asset they want, something that's near certain to like cash in the bank that really is sitting there waiting for them. So anyway, I'm just excited about just giving people new options in terms of their risk appetite and what they want to hold.
I don't know if I can add really very much to what's been said on this topic, except the fact that I don't think everything comes together and converges. I think it's all driven by use cases. There are going to be people who are looking for smart contracts. There are going to be people looking for utility, people looking for store of value. And that's where the growth of the industry is going to have. But it will definitely be more participants going forward, better regulatory guidelines for us to all deal with, and then large players. I mean, BlackRock has almost more money in the Bitcoin ETF than they do in their gold ETF. I mean, and that's only been around for about 9 months or 10 months. So the adoption is happening. It's going to be use case driven, and I think it's going to be very interesting.
Got it. Thank you so much, everyone. Please give them a round of applause.
Wonderful discussion. Thank you so much. Really appreciate it. As you all leave the stage, just remember there are a few things you can do here to maximize your time at Benzinga's 10th annual FinTech Deal Day and Future of Digital Assets. One, you can still download the app, Benzinga Connect, and connect with each other. We have tables upstairs designed for this. Two, you can connect with Benzinga. Our API table is upstairs. Benzinga has been situated there all day and will continue to be all day. So please make sure you connect with us. We are anxious to talk to you. That said, we're going to keep the content rolling for a few more hours here. Up next, we have Building the Digital Asset Securities Ecosystem, moderated by Fireblock's very own Jason Allegrante. Please put your hands together and welcome them to the stage.
Well, thanks everyone for joining us after the lunch hour here. I'm Jason Allegrante. I'm the Chief Legal and Compliance Officer at Fireblocks. As an infrastructure provider, the tokenization of assets is something we think a lot about. From my perspective, it's something we think about as an ecosystem. It's not just about finding the asset, tokenizing it per se, but how do you build out the infrastructure? How do you build out the regulation? How do you find the market participants, secondary, the purchasers, et cetera? And how do you package all of that into something that's going to be viable? So I think we're going to address all these issues today. We have a great panel here. If I could just have each of you guys introduce yourselves, starting with you, Colin.
Yeah, thank you very much, Jason. I'm Colin Butler, Global Head of Institutional Capital at Polygon Labs. Polygon is a blockchain that provides a suite of Ethereum scaling solutions to scale the blockchain.
Hello, I'm Reba Beeson. I'm General Counsel of AlphaPoint. AlphaPoint is a digital assets software technology provider. We power crypto exchanges and digital asset platforms around the world.
Hi, I'm Andrew Schupek. I am the America's Head of Digital Assets and Financial Markets Innovation at Northern Trust. We are a large institutional bank that provides asset servicing, asset management, and wealth management, and currently custody about $17 trillion worth of assets in traditional products, and continue to grow out our business for digital products as well.
Andrew Murphy, I'm the head of legal at Talos. At Talos, we provide software and other solutions to help institutions trade and invest in digital assets, from smart order routing to portfolio management. We provide all the technology infrastructure that institutions need to interact with the digital asset ecosystem at scale.
Yeah, well, I mean, what I love about this group we have assembled, right? I mean, we're basically, for the most part, institutional focused, perhaps not Polygon, but we also have representatives here from, TradFi institutions like Northern Trust, as well as the digital asset community. I'm curious, from each of your perspectives, if you could just get us started, what is the biggest challenge to tokenization? There seems to be so much demand for it across different asset classes and a lot of talk about it for many years, and yet we still don't seem to be any further along.
It's hard to align on what the biggest challenge is, because I think that there's a few that spring to mind. One, I think, obviously is regulatory. I'll let the folks from legal more address that one. Another is cultural. A lot of the big banks just don't have a culture of people that are used to interacting in the way of blockchain interaction. They're not comfortable with being on chain. I think that they fear a lot of potential disruption to their existing business models. And when you are sending trillions of dollars around the world in the global financial system, you don't want to make changes quickly. So culture is a huge issue, but I do see that shifting substantially, especially in the last couple of years. And then the final thing I would mention is actually technology. And the tech, I would argue, just hasn't been there to date. You don't have unlimited scalability and unified liquidity. We're working really, really hard to address those points by creating what we call the aggregation layer, essentially connecting all the chains and giving people the ability to move assets across chains very seamlessly in a way that you don't know you're moving across chains. So the world of Web3, as we call it in the business, looks a lot more like the world of Web2, where you're just using it and you can do essentially whatever you want with it, transfer things wherever you want, in a way that is very customer friendly, and the user experience is much better than it currently is. And I think we're actually pretty close on that side.
And I would just add to that to say one other key component is liquidity. So once an asset is tokenized, what do you do with it? So what Alpha Point has been doing is helping to build platforms to facilitate the transfer on-chain, investing and trading in tokens. So one of the use cases we have is with GreenX, which created a tokenized platform for its user base, and it's based in Malaysia. In addition to that, we have collaborated with other parties within the ecosystem so that we can build out fast and furious and use the best components of what everybody has to offer. So one of our partners for that collaboration is Polymesh.
Yeah, I think from a traditional institutional angle, I think we're looking at a few challenges. And first and foremost, it's really about tying infrastructures together. You know, who's going to be out there to support the traditional infrastructure and the digital infrastructure? Because you can work one and you can work another, but if you're not supporting both and aligning them and integrating them in some fashion so that traditional clients can access digital assets, so digital clients can maybe access an arbitrage into a traditional asset, and allowing a common portfolio view. How do you do that? How do you align? You talked about infrastructure, Colin. And for us, thinking about that infrastructure is how are you bringing all of that together in a common view? And then the other part I really touch on is we could talk about regulatory challenges, but the key to that is how are we aligning views with regulators? Especially as a traditional regulated institution, we have to work with the regulators, can't work against them. And we have to explain to them why we're working on these types of projects, and we're on a number of different projects. We recently launched a carbon credit tokenization platform with review by our regulators because we walked them through it. So it's very much a process of we have to align with them and listen to what their concerns are, because if you really want to get the power behind the all assets types, you have to get traditional and digital clients to both participate at once.
Yeah, I'll just echo Reba's point around liquidity. You know, at Talos being technology infrastructure that sees a lot of flows on the trading side, you really need to have a whale come in and drag everyone else along, kicking and screaming. We'll talk a lot about regulatory, and I think that's part of the picture, but I also think people use regulatory as an excuse, and Colin and I were just talking about this before we got on. You can probably do more than you think under the existing structure. It may not be as efficient as you want it to be, but having that first mover, having that giant whale come in that forces all the counterparties to go onto tokenized rails, we haven't seen that at scale yet.
I'm struck by this idea our middle Andrew brought up of this. We talk about interoperability, by and among and between chains. But what I think you were talking about was interoperability of the traditional financial system with the infrastructure being created in the digital asset tokenization space. And I want to use this concept as a bit of a through line to maybe get to some of that regulatory conversation, because when, for example, we look at tokenization workflows, right? If you want to do like a simple security token workflow, you have to, according to SEC rules, have a transfer agent within the flow, right? Now, the purpose of the transfer agent to record ownership as the security goes through the course of commerce, right, is largely subsumed by the blockchain itself, right? So there are these tension points there, I think, already baked in. And I think it is really worth thinking about. So again, the way I look at it is that there's probably at least three things that need to fall into place: a regulatory layer, an infrastructure layer, and a market layer, which is to say the market participants, the buy side, et cetera. All of that kind of need to fall into place. But let's maybe have a look at the regulatory and the interoperability here.
Yeah, and Jason, I think, and that's a great point, and that's part of what we think about how we aligning all this and how we working with to integrate all of this. You talked about it, right? Transfer agent, a lot of that duty could be subsumed into the chain, depending on what kind of chain you're working on, who's validating, how you're using nodes, how are you guaranteeing that a custodian has full view and ownership of keys for a client. There's a lot of different questions from a legal and a framework type of build. I'm obviously Ruby, you're the expert on that, but I think that thinking about that's part of what we have to work together. And the problem is we can't just turn around tomorrow and say, okay, all TA functions will go away because we're going to be on this public blockchain. We have to, again, align ourselves with the thinking of the regulators and bring them in and explain to them why, and they can come back and we have the conversations about what parts they have concerns about and how we mitigate away any risk concerns they might have.
If I could just add to what you've said, Andrew, and to address your question, Jason, I think that a collaboration with the regulators is very important. So I mentioned collaboration earlier, and both of you, Andrews, also touched upon this. And I like the way you frame it as a three-tiered approach, with regulation and collaboration there being extremely important. So what we do at Alpha Point in terms of collaborating in that regard is that our customers are the ones who have the direct interface with the regulators. And oftentimes they have questions around the technology and trying to ensure that, for example, the technology is secure, that it can scale. All of these different types of concerns that hit the end user risk parameters to ensure that it can operate and function in a way that it is intended. So I think that that is one of the key components to that three-part analysis and approach that you discussed.
Yeah, on the regulatory side in particular, I think one of the places that we could really improve is on market structure and getting some clarity there, whether that comes from rulemaking or whether that comes from legislation in Congress. It doesn't matter, but I think right now you're looking at a market structure system that feels a bit like you're taking these traditional traffic laws in the form of the existing securities framework and market structure, and you have these really fast flying cars in the form of tokenized digital assets, and you're trying to apply that old framework to these new flying cars, and you run the risk, especially if the regulators don't understand what the technology can do, of over-regulating and taking away some of the benefits. I thought, Jason, your point around the custodian point, it was a good one, because if you look at what the rules require today in terms of requiring a third-party bank or broker to be the custodian, you're overly limiting who can custody this technology, and you may, as a result, be putting in place speed limits that you don't need to put in place. And if you've got some clarity on market structure around who can custody digital assets, expanding the scope of custody to new third parties, to perhaps even self-custody, you would really allow the tokenized ecosystem to operate at full speed and realize the full potential of efficiency that I think we all believe it can get to.
I love that. And I think, Andrew and Reba, your comments are suggesting something for me. And at the risk of putting you guys on the spot, I want to get your reaction. So I love this idea of framing the conversation to regulators. And Andrew, I think you did a good job of illustrating that a little bit. But so as you guys were talking, I was thinking to myself, what are we telling regulators about what we're doing when we're attempting to tokenize assets, right? Are we telling them that we're basically trying to follow a model that's just with a little bit more efficiency and speed that already exists? Are we telling them that this is truly a technological transformation that we see coming? We're going to need a whole bunch of potentially different rules in order to enable it to come to fruition. And when I think about this challenge, one of the things I'm thinking about a very concrete example, right? So I've sat at regulator roundtables, and they've said to me, okay, Jason, you've got a digital asset security, but what are you talking about? Are you talking about a token that entitles you to go down to DTCC and pick up a stock certificate? Or are you talking about a title that represents equity interest? Or are you talking about a token that, maybe just represents a claim on cash flows, right? Which might be more appropriate to something like real estate. But so I'm curious, like, what is the ideal way in your guys' mind to frame these conversations with regulators?
Well, perhaps I can just jump in and then open it up. We always think about it in terms of the use case and what is the need that's driving whatever the project is. And so, for example, Wenia is a use case. It's an app that was developed by Bancolombia, which is the 4th largest bank in Colombia, and the 10th largest, Colombia being the 10th largest cryptocurrency trading community in the world. And what we saw was that there was a need to be able to have, in this case, it was a stable coin, but I also think of that as tokenizing, which was tokenizing the peso, the Colombian peso. And it facilitates the ability to do remittances and for the users, the citizens of Colombia, to be able to interact through the exchange in real everyday investing, trading, purchasing. And so I think that might be an example. And we always start from what is the use case and then work with the customer, the exchange, and with the regulators in turn to help develop what kinds of guardrails need to be placed around that.
Yeah, I think in my experience, starting small and trying to explain the benefits in a really incremental way has been successful. I think depending on how experienced the regulator is, it can be overwhelming when you talk about all the different stuff that you can do once you tokenize all the various asset classes, and it can just really get overwhelming. So starting with something simple about, hey, trade and settlement. A lot of problems are created, and a lot of costs are created by that lag. By one estimate I read, the securities industry spends $133 billion a year just on post-trade clearing and settlement. It's a lot of cost, and a lot of that cost is driven by the lag between trade and settlement. And you talk about what that cost is. There's cost in terms of there's market risk, there's liquidity risk, but there's also risk by way of my own experience. 10 years ago, working as a junior associate at a large law firm, I learned about the risk of the settlement date and the trade date being separated by a weekend in the summer. So this was a bond refinancing, and back then it was T+3. We priced the bonds on a Wednesday. We were scheduled to close on that the following Monday. Friday rolls around, the junior analyst at the bank sends around wire instructions with placeholder amounts for the amount to be wired because they couldn't yet calculate the interest owed on the old bonds to be paid off. So this goes around to the entire working group. The junior analyst goes away on vacation. It was a Friday in the summer, so he probably left the office early. The next Monday, the bank operations analyst, who actually does the wiring, who was away the prior week, opens up his email and he sees a PDF of wire instructions, and he proceeds to not read the email that said these are placeholders, initiate the wires, overwired DTCC by $75 million, and spent the next 24 hours trying to chase down where in DTCC that money went to. So you can imagine the amount of costs that are added to the system from an example like that, including a lot of billable hours that were created trying to track down that money. But starting with examples like that, bringing back to the original point of just, hey, how can we reduce the time between trade and settlement to T+0 when you have this technology where the ability to do that is built into the asset class and reduce some of these costs, I've found to be a way regulators can connect on an incremental level with some of the benefits of this technology.
Look, I think it's a really hard thing, right? It's a little dance with your regulator because you don't want to oversell it. We're going to tokenize everything, and you don't want to undersell it. Well, we could start out by just giving you the opportunity to do a collateral movement. Well, there's a lot more in between there, and you can start with distinct examples, but every time that you talk to regulators, to me, I think it's important that you tell them what the future could hold and really where you're trying to be. If you don't give them both the short and the long term, then they're only really looking at the short term for you, and they may go, that's great. You're going to do 4 things, and then we don't have to worry about it. You'll never go public on the blockchain. You'll always be on a private network. But we know that's not where it's going to end up. So every conversation has to have a consideration, not only of why we're doing it now and what we're trying to solve for, but what the technology really solves for and what it can solve for at scale. Because I think the thing that as a traditional institution we struggle with the most is getting to the point where we can prove efficiency. Because efficiency doesn't come in a real way until we innovate at scale. Because blockchain's made for scale. I mean, what has blockchain been used for? Bitcoin. Let's be honest. That's the use case for it. We have a bunch of use cases that we're trying to prove, and I think we sat and watched SocGen and Citi up here earlier today. Hey, Tom. And we saw them talk about these great use cases they have, but we have to continue to build it up. And it goes back to my original point of you have to build up that infrastructure, and you have to make sure that the traditional and the digital components are aligning together. And that's why you see so many traditional institutions building up a digital asset platform. We have ours. We call it Matrix Zenith. Everybody's got theirs, and you could look up all of them. You can see them all. But that's the point, is we work to tell them what we can do with it, but we work to tell them where it's going to go eventually too, because we cannot undersell it. And we cannot oversell it either. So yeah, it's a tough thing.
Oh, I could oversell it right now. I have 2 cents on that. First of all, I'm wondering if that guy that overwired DTCC got fired. I'm like, how quickly did that guy go?
I don't know if I could comment, but let's just say he probably wasn't working there when he got back from his vacation.
But I'm really glad you outlined that use case, because when you go into the regulator, I don't speak directly to the regulator, but I think in order to achieve widespread disruptive technological adoption, it has to be 2 things, or one or the other at least. It has to be, 1, an order of magnitude better solution than the existing solution, or a solution for which there was no prior solution. And I think that use case hits it perfectly, where there's a settlement over a weekend versus essentially the potential for atomic settlement. So when Andy is speaking with, well, maybe you go with, call it an incremental increase to start, but you also paint a vision for the future. That's actually very interesting to me. As a technologist, we generally only see the beautiful vision for the future, where you take 23 ledgers for one of the core global infrastructure players in finance with, call it 60,000 employees, and you take it down to 2 ledgers using the blockchain. And that to me is an order of magnitude better solution than the prior solution.
Yeah, I mean, we've as we near the end of time, right? We've talked a little bit about the challenges of tokenizing traditional asset classes. We've talked about the very real benefits. We've talked a little bit about how blockchains are made for scale. So I want to try to wrap all these things up, right? Let's talk about tokenization at scale, stablecoins. And we're very bullish at Fireblocks on stablecoins as a use case. We think it does a few things, right? We think it gets the financial institutions into the mix, particularly the U.S. financial institutions, if we have legislation. We think stablecoins themselves grease the wheels of online commerce, right? And maybe we can hear from Polygon's perspective on that. So we think that they're going to be really important, and that potentially 25 or 26 is the year of the stablecoin. But I'd love to hear this group's thoughts. What are the opportunities with stablecoins? Any additional thoughts you have?
I might be most bullish on that, so I'm just jumping in. What if you could rewire the global settlement system on institutional stablecoins that are yield bearing and use them as settlement tokens? And so instead of essentially holding cash over a period of multiple days of settlement, you're actually getting yield on that. And to me, that simple twist is potentially a massive disruption in the global financial system. And I think that those products are being built right now. And I would say look no further than last week, BlackRock tokenized their money market fund on Polygon as one of 5 blockchains that they announced. And there's a lot of potential for products like that as the industry iterates on them and getting those products and gets those products into the traditional financial system. And I think Northern Trust actually has a little bit of an edge on that one as well, if in case Andy wants to disclose.
Which Andrew? Sorry. Look, I think that stablecoins are an interesting product. They really are, and all digital cash instruments have a really an outsized future. When you think about the amount of time it takes to move fiat, I think every institution has looked at what does that mean? Is there something we can do on a banking network? I mean, we saw Signet and Sen years ago before the issues had been at those banks, but how do you extend that out? How do you get more parties involved? Is that the right solution? Can we tokenize a fund of some way of money? Do we have institutional stable coins? And how do those work? So I think there's a lot of questions to have around how do we represent cash? And there's so many solutions right now. I'm really curious to see how it breaks out. And is a tokenized deposit just another form of cash? And how do I move my tokenized deposit to your bank? Well, again, now we talk about bridging or interoperability or whatever you want to call it. And how do we make sure that those networks work together? And then how do you look at eliminating the risk of moving money from bank to bank, even in a blockchain environment where you have banks on 2 different private networks, because there's still going to be a delay when you essentially bridge one network to another network. So I struggle with stable coins in that regard, but I think that stable coins or some kind of tokenized cash is how we're going to start moving cash. But it's that public-private conundrum when you talk about regulated institutions and users versus non-regulated or retail. And retail has eaten up stable coins, and oh my gosh, it's the greatest thing ever. And I'm sorry, I know I guess, but I mean, retail has made stablecoin a great solution for retail, but I don't know that it's a solution for more institutional, because when you see those market events where stablecoin dropped in value on a secondary market, not a primary market, of course, that's still a question is, how are we going to do that? Because we've never seen the dollar drop like that.
I think that's one area where stablecoin legislation can help, and we need to get it right, because I think there's a lot at stake. There's been a lot of ideas thrown out about what rules need to go into place in order to actually be able to issue and hold a US dollar denominated stablecoin. But standardization in terms of what are the reserves, how is it audited, how much can you issue, who can issue it, I think is really important in order to increase the institutional adoption, because I think there's been a huge lack of clarity, and certainly some of the lack of clarity has contributed to some of the banking crisis situations where you had stable coins drop a lot in value because their deposits were held at certain financial institutions. That can be addressed through legislation, and stablecoins, I think a lot of people in the industry agree, is probably the least controversial bill to get pushed through. We'll see if that actually means it's going to happen. But in terms of actually settling on chain and having a proxy for fiat, there's nothing else out there that has gotten the broad adoption the way that stablecoins have. So having some legislation that can take what's already out there and make it easier to actually settle on chain using it at an institutional level, I think would really help to accelerate adoption for some of these tokenized use cases.
Yeah, I mean, we're out of time, but we'll just close on that idea of the acceleration of adoption, right? So stablecoins are in a lot of ways the gateway to the rest of the tokenization ecosystem. You have a market, you have a retail market, you have a merchant market. Merchants love actually to receive payments in stablecoins because they settle so much faster. That's cash in their interest-bearing accounts a few days ahead of time otherwise. So you're going to have that marketplace there. You're going to have banks who are going to want to issue these assets. So you're going to get the financial institutions there. And then, you know, to Andrew's point, how are they transacting with each other? How are they distributing those tokens to the market? You're going to start seeing that infrastructure layer. The banks are going to need to adopt custody solutions to hold these things as they mint them. They're going to need to find ways to transfer them securely. What that does is it starts to bring all three layers that we're talking about into place. And I think that's where you're going to start to see some of the more complex use cases come online. So with that, I just thank our panel. Thanks for coming, guys, and thank you.
Thank you.
All right. Thank you, Jason, Colin, Reba, Andrew, and Andrew. Appreciate you all for a wonderful discussion building the digital asset securities ecosystem. All right, y'all. Remember, we have still some great content coming your way. Next up, the promises and complexity of internet breakthroughs, moderated by the Chief Growth Officer of Sheridium, Kelsey McGuire, with Aviad Stein, Marcus Kunert, Richard Widman, and Tanya Salati. Please welcome them to the stage.
Great. I think we're all set. Hello, everyone. Thank you so much for joining us here today. As they already mentioned, we're discussing some of the promises and complexities, both of which there are a whole lot of when it comes to Web3 and AI. And we'll kick things off with a brief round of introductions. I'm Kelsey McGuire. I'm the CGO at Sheridium, which is an auto-scaling L1. And I've been in the space probably since 2018 on both the investment side as well as the project side. But Aviad, take it away.
Thank you. Thank you, Benzinga, for having me here. I'm Aviad Stein. I'm the Global Head of Innovation and Strategy at Broadridge Financial. We're a large fintech company. We consider to be the backbone of the financial services ecosystem, but nobody knows that we exist, which is unfortunate. We empower capital markets, wealth management, governance. We settle about $10 trillion on any given day through our system for fixed income. And we do a lot of things around innovation, digital assets, identity, payments in the space.
Hi, everyone. My name is Marcus Kunert. I'm the CEO and founder of OneIO. And what we're doing is pioneering the next stage of decentralization. So I have basically a Web2 background, and we were building collaboration technologies for some huge companies like Microsoft, Red Bull, Siemens, McDonald's. And at OneIO, we today built technology which allows like complete decentralization, taking out the middleman and like the original promise from Bitcoin back then. But we do it for data. So it's not primarily on the financial system. It's actually for verifiable data because we think that's the biggest challenge at the time. And yeah, that's what we're doing, and I'm excited to share some insights.
Hi, everyone. My name is Rich Widman. I run global strategy for all things Web3 at Google Cloud. I've been in the crypto space since about 2015. Actually got my start as a white-collar criminal defense lawyer, actually here in New York City, which is how I sort of got exposed to my first crypto cases, and eventually went down the rabbit hole and started finding it interesting enough to try and move over to the product side. So right now I lead our product and engineering efforts as well as our global go-to-market. And if you haven't heard about what Google's doing in this space, I think we have a couple of key themes. The first is, we're really focusing on how we can play an integral part in the development lifecycle for companies like Marcus's and others who are building in this space. And then the other part is really thinking about what are the ways in which Google at large can participate in this ecosystem. And we'll talk a little bit about some of that today around payments and other things. So really happy to be here, and thanks for having me.
Hi, everyone. My name is Tanya Sawadi, and I'm the Vice President of Business Development at Proppy. I've been in the space since 2021. I started at Skybridge Capital and then Salt. And then as of last month, I joined Proppy, which we aim to bring property rights on chain. So yeah.
Great. We'll start with you, Richard, since you mentioned, of course, your background and current role with Google. We're seeing a lot of great traction there right now, with Google recently announcing that they're going to accept crypto payments, which is huge, as we all know. What about Web3 as it exists now, like not just the promises as it currently exists, is appealing to these kind of legacy Web2 companies?
Yeah, so I think there's kind of the Google-specific answer, and then there's the generic answer for the institutions that are in the audience today. So from our point of view, right, our mission is to organize the world's information, make it universally accessible, right? And that started with search. If you think about it, our focus was the movement of information across the internet. And now when we look at Web3, it very much is in sync with our role. But instead of just moving information, we're now talking about moving value. And so when we think about our role and what position we should have in the ecosystem, it's very clear we ought to have one. And we think part of that is really going to start by participating directly on chain, right? I think there are a number of businesses that find the value of moving value on chain to be something that is really worth betting the business on. Because almost every international business is dealing with cross-border payments issues. They're dealing with the general dead weight loss of the current payments networks that exist today, high fees, slow, et cetera. And they see the promise of stablecoins, which is just one way to move value on chain, as a way to kind of perhaps not just improve back office efficiencies, but create strategic commercialization opportunities for them. So if you talk about what Stripe's recently done with the acquisition of Bridge, that sort of has opened everyone's eyes to say, I actually can go beyond using this just for efficiencies for payments that makes my treasurer happy or my chief financial officer happy, and I actually can make my chief business officer very happy because we can actually play a role in that and perhaps collect more yield, collect the spread, et cetera. So I think there's kind of like a defensive and an offensive posture that's exciting for a lot of large institutions, and there really isn't a way to do that in an academic sense. I think the companies that have done this poorly are ones that say, I've read the paper on Bitcoin, so we're going to take a really opinionated point of view, and they've never touched anything on chain, and then eventually those projects usually don't really add a lot of value for the company, and they end up getting wound down, which I'm sure we've all seen before. So for us, it's really both about near-term and medium-term gains. There are certainly things that are very exciting about resource allocation on chain, things around decentralized AI, reinventing the developer experience, particularly around open source development, as like absolutely critical and very interesting to us, but we think it will take years for that to play out and mature.
Yeah, it's great to see the interest from an organization like Google. I do really feel like there's a challenge, well, in the challenge category here, when it comes to perception of Web3. So anyone who's working with or has worked with, Web2, traditional financial institutions here, what perception issues have you seen, and how has that been kind of standing in the way of really the promise of Web3 and AI?
I can take this. So we obviously serving a very large community of banks and brokers and about 5,000 brands that most of them are heavily regulated, right? We're talking about the financial institutions, insurance companies, healthcare providers. And so the transition from Web 2 to Web 3 is extremely painful. But it starts with a literacy gap, right? There's a lack of understanding of what Web 3 is about to enable for them as a business and as a subset of that to their clients and to their customers. And so what we have done is really just try to transform the knowledge around this organization and making sure that they understand what are, first of all, the fundamental differences between Web 2 and Web 3. How do you take your existing legacy systems and operations and services and products, and you are able to really just bring them into the Web3 ecosystem as a whole without disrupting your entire operation model. And that's a very, very painful thing. I'm sure that Richard can talk about it as well, right? We have a lot of data provider out there who are helping. We have infrastructure providers who are trying to kind of make sure that those organizations are ready. But like I said before, the literacy gap is the number one thing that they need to address internally. And then as a result of that, to start experimenting with different technologies. AI is an example, right? Everybody is kind of rushing to AI right now, but defining the right use cases for it is critical. That's going to have a trickle effect on the economics of the business, the operation of the business, right? Finding areas of opportunities for expansion. So those are type of areas that we are kind of focusing right now.
Well, basically, just taking Web 2 and adding blockchain to it isn't Web 3. So
I think people are starting to realize that finally, which is great.
Yeah, so Web 3 is all about cutting out the middleman economy, basically. It's about ownership, owning the data, owning the infrastructure. And Web 2 companies sense that because that's sort of threatening their existing empire, so it's sort of crumbling, and you see all the data is being exploited and reused and manipulated and weaponized and used to influence people. And the promise of Web 3 should be actually to change that. And cutting out the middleman economy doesn't only apply, I think, to payments. So there's so much more you can do with it, and data, for example. We think data is like the biggest challenge, upcoming challenge, which needs to be we need to bring it back to the people and to the organizations who produce it, and they need to own it, and they need to handle it, and they need to decide what to do with it. And a true decentralized Web3 implementation can enable that without middlemen or centralized data centers and stuff.
One thing I want to add to that, right, there's always the debate of evolution versus revolution, right? And if you think about Web3, a lot of the perception around it is going to revolutionize, right, the way that we're doing things right now. And in fact, it's an evolution of what we're doing. And on top of that, people even consider Web3 to be going back to Web 1, right? To kind of like going back to the fundamentals of how the web even evolved and started. And so I think this is part of what you're saying around the data management, right? The relationship that you have, how you own the data, and for what purposes.
Exactly. So in a lot of cases, it's currently Web 2.5 at best. And Web 3 really needs to be truly decentralized. And that's what we have built a technological foundation for. And which means you're not reliant on any centralized infrastructure anymore. So you can use your personal devices, and you have peer-to-peer direct interactions. And that's basically the promise of Web 3. And there's also Web 4, which allows then seamless interaction between human, machines, devices, and so on, and AI, obviously. And that's already the next step.
Yeah, absolutely. And Tanya, I'd love your thoughts on this, and kind of a follow-up question here is, we've had a number of chats and like on our intro call the other day about different business models in Web 2 and Web 3. So I would love to hear what you think about Web 2 versus Web 3 business models. Do Web 2 business models need to adapt to Web 3, or does Web 3 need to change, or is there some sort of middle ground here that we can reach?
Yeah, and I think Marco said Web 2.5, which I think it's like the best description because it's kind of like a hybrid model. I think what Web 2 offers is a scalability and the user-friendly experience, which I think Web 3 lacks, and Web 3 needs to step up their game because I think the issue right now for users is that it's so hard to navigate. And let's face it, I even struggle with private keys, wallets, and then decentralized apps. So I think this is frustrating for a lot of users. And maybe if we can find kind of like Web 2.5, where we can integrate the Web 2 experience and the scalability with Web 3's decentralization, I think that would be ideal.
Oh, I think that's a great point. And another huge piece to this whole puzzle is regulation, which I know we've talked about a lot as an industry over the past few years. And I feel like we're facing a lot of complexities due to the promises that the industry has made in the past. So Avia, let's start with you. Like, how are you seeing this regulatory environment? And I'm speaking of probably US, but also from a global perspective, shaping the future of this kind of emergent tech industry.
Great question. So I think that we are facing right now a non-domiciled economy and a non-domiciled evolution, right, from a technology standpoint. I mean, we're seeing it within digital assets where you can trade things 24/7 on so many exchanges globally. Similarly to AI, right? I mean, AI is a capability that's going to enable so many services and solutions in the marketplace that are not domiciled to one market versus another. And so from a regulatory perspective, and it going back to my previous point about education, I think there is a literacy gap, there's an education gap on the regulatory side of how to even use or how to even put a framework together that enable the ethical components, right, of AI. And so one of the things that we're doing, and we're building right now different consortium for that, is to define the right mechanism for AI disclosure, right? What does it mean? What are some of the parameters by which regulatory bodies need to evaluate the usage of AI for the different use cases across industries? And so I think it starts there. It also by demonstrating different use cases in the marketplace that are serving and creating higher value and touch points for consumers without jeopardizing or risking the data that goes with that and the overall operation of businesses.
Yeah, I mean, I think one of the things I'll kind of add to that is, really the importance of a tech neutral policy position. And that's been kind of murky and very difficult to execute on for a couple of reasons, right? There are some, crypto-based projects that by virtue of being decentralized do create new issues of fact that regulators have not seen before and are not quite sure what mold they fit in from a policy perspective. And then there are things that are just by virtue of being tokenized, but are very clearly regulated. In other words, take, NYSE and take tokenized equities and then open a market for it. It's very clearly something that would be regulated from a broker-dealer perspective. And by virtue of it being tokenized doesn't mean you don't have to comply with the broker-dealer laws, right? And so that I think has been, a point of contention, and it also hurts the education side of things because you really have to have, very clear channels, not just with policymakers, but also the private sector, so that everyone really clearly is able to understand, like, right now we are talking about an entirely new business model with an entirely different tech stack that the current regulations, whether they be the Securities Exchange Act or the Commodities Act, do not apply to very well. And then there are things that are just by virtue of being tokenized doesn't mean that they're completely unregulated. And I think that has been, we spent a lot of time talking past each other. I think the goal now, and I'm seeing this more in the industry and from business leaders as well, is having honest conversations about whether the activity is genuinely new or whether the tokenization of that activity is being used as regulatory arbitrage. And that's the tricky part. But I do think that there has been a lot of growth in the industry, both from policymakers and industry leaders, about what this stuff is and when it is truly unique and new and has got technological merit. And then where it looks a lot like something else that's already regulated, but we tried to say it was tokenized, and so the regulations just shouldn't apply. And I think that's always been a challenge for us to overcome, but I think we're getting close to, again, having open channels, honest dialogue about that.
Yeah, I completely agree with you when it comes to the honest dialogues. I do feel like the industry has been maturing a little bit, and we're starting to slowly move past just yelling about regulation on Twitter, which is a huge step forward. So The next question, I'd love Tanya, then Marcus to kick us off. So we've seen a lot of ups and downs over the years in this industry. And with every high, I see lots and lots of new interests, users, your communities, the numbers can just explode. And then with the lows, all of a sudden people are leaving and it's crickets. And then the highs, everyone comes back again. So how as an industry do we work to retain these people? I know, we can't retain everyone, but some of those groups that are coming in with the excitement and the highs to bear with us through some of the lows.
Yeah, and I think it's all about the user experience. And I'm going to use Robinhood as an example because I think they've done a great job during the pandemic. They draw a lot of people, like millions of users into their platform. And, after the pandemic, everybody went back to work. So they had to figure out how to keep everybody on their platform. And I think this is where they've done an incredible job. They've added options, and they have also added a way for people to express their opinions through the presidential election options. I think last week they added meme coins, which is very reasonable. Like, the young generation can resonate a lot with meme coins. So I think Robinhood has done a great job at retaining their users, which I think this is something that a lot of companies struggle with because, yes, maybe we can get users into our platform by some kind of incentives, but if you're not keeping those users engaged, then they're going to leave. And another great example is the credit company Built, which, when you pay your rent, you get points, and you can use those points towards flights, hotels, and most importantly, for stuff around your community, like restaurants, shops, workout classes. And instead of going to your Built app once a month to pay your rent, you go every day because you want to check out what's going on and also use your points.
Yeah, so I think it needs to be more sustainable for users. So basically, there's like a hype and it goes down and people are off. So there's nothing left anymore. And I think what you really need to do is to empower people. And what I mean by empowerment is allow people to own information, the data, to monetize their own data, to decide who they want to share with any information or data. And then there's a value in it. And if you have value in it, then people will keep using it. And I think that's what we need to have, and where we need to get to. And this also affects regulation, actually, because regulation, as it is today, is sort of just a patch for a broken system on the end, because governments are trying to regulate basically Web2 companies not to exploit data. And if you have a truly decentralized system where you actually own your data, where there's value for those people, you'll keep using it. And yeah, that's empowerment, and that should be the future.
Just want to add to that I think in one word, it's all about the value, right? I mean, I'm thinking about a company like, let's say, Google for that matter, right? That really enabled so many services and products into our life by taking something that's very dear to our heart, which is our data, right? But they did something very valuable to us as consumers. And so we're going to need to find the happy medium, right, between control that users going to have to the value that you're getting by giving that access to companies. And I think that's going to also help with kind of the highs and the lows, making sure that there is a clear transparency around the purpose of the data and the services and the value you're getting out of that. And that's how you keep the consumers and the businesses all fully engaged around the value.
Yeah, I think there's also kind of a point here that was made, before we had kind of the advent of blockchain, which is a lot of people sort of treated their digital privacy as kind of like a third or a fourth order priority for themselves, right? We all do it. It's just like, I want to use this new service, and the TOS comes up, the terms of service and the privacy policy, and you're like, yeah, I get it. I just want to trade on Robinhood, right? And you hit accept. And I think that, this is really the kind of the user, peaks and troughs are really a test about whether public perception around the benefits of having distributed, decentralized, censorship-resistant networks is something they are willing to vote with their feet on. In other words, still engage, even when there may not be sort of a token that's offered to them that goes up in price. And that, I think, is something that is still being put to the test.
But that's what makes this really the most interesting space, is that there really wasn't a way to experiment with that idea at scale, and tokenization and kind of distributing the benefits of those experiments amongst early users is a fantastic way to kind of like bootstrap that ecosystem. And so you could test of Facebook where you have more control over your data in the blockchain space. And specifically the ability to issue tokens to your users as a reward is one way you would do that. Otherwise, it's very hard, because if I start Facebook tomorrow, I have a Facebook of one, just me, and then I'm trying to get everyone else. And if my only value prop is I treat your data better than Facebook, most people who are using it don't really treat that as their top priority, right? It's for connections, et cetera. So I do think we'll see consumer sentiment shift. And we've seen this around one thing, and that is Bitcoin. If you talk about Bitcoin in 2009, and you said, I want to talk to you about censorship-resistant, globally available, money that is not controlled by a central bank, there's a reason why there are Bitcoin whales, and then there are people like me who have some Bitcoin, but I'm on the stage and I'm still working for Google. And the reason is, in 2009, if somebody brought that up to me, I would have said, that's interesting. I don't know if it's like my top priority in terms of where I put my money. And I don't know if I question the value of the US dollar on a daily basis. But now, as you see the next 15, 20 years from that, that is becoming a topic of conversation. And so Bitcoin did not have to do a whole lot to bring people to it. It was consumer sentiment shift that brought the folks into the Bitcoin arena. And I think we may see that around things like these decentralized systems, whether it's around data or access to compute or access to, I know you're doing something in real estate, right? And I think that is sort of what we're looking towards, is where do people vote with their feet? When do they start to prioritize these particular principles of Web3? And that's when you get the next killer app.
Yeah, and I do find that the overall, I would say it's starting to be more of a focus on user experience, to y'all's points as well, will be absolutely key here, because people vote with their feet, but they're not going to walk anywhere that takes like even one extra step, as far as what I've seen. Even with interesting social impact projects, one extra click was enough to just keep everyone away from even the most compelling, I thought, projects and kind of dApps. But kind of moving on to one of the other promises of Web3, removing the intermediaries. That's something that I've heard spoken about for years now. What do you feel like that looks like right now? Have we been kind of reaching that promise, or is that something we're still looking at way into the future? I see interesting use cases with remittances, but still waiting some of those bigger moments when it comes to removing those intermediaries.
Yeah, I think that removing the intermediaries is key, because, we can talk about everything, but if you don't remove them, I don't think it's going to work out, because right now, I don't think my mom knows what ChatGPT is. So what you guys are building, it's not going to be for her. It's going to be probably for the newer generation. And speaking as part of the new generation, I don't have the time and the patience to wait for something, or to like do a lot of paperwork, or, have delays. And when purchasing a home, it's an outdated process where you have a lot of paperwork, delays, and then lots of middlemen. And that's what we're trying to do with Proppy. We aim to make, the purchase of a home as easy as trading a stock on Robinhood, and that excludes all of the middlemen.
Yeah, that's basically what we built. So we have built a software SDK, and it's called CoKit. And with CoKit, it purely runs on users' devices, so there's no central infrastructure needed anymore. And there's no intermediary in terms of infrastructure. You don't need a cloud. You can use it as a resource if you want, but you don't have to. And this is very, very powerful, because now the data is with your devices, and you decide what's going to happen with it. And at the same time, this SDK is built in a way that it's very easy for developers to build basically Web2 applications like a WhatsApp, even easier than they used before, because you don't need to do any background coding. There's no databases, but it's always on sync, and you can very easily build whatever kind of app on top of it. And we're really excited to see what's currently happening here with this SDK. But on the end, it's about removing the intermediaries, or at least you deciding if you want to have one. For example, if you want to trade information or data with someone else, obviously you have like a marketplace or something, but you still can operate this through a blockchain, which then becomes like a trustworthy intermediary in this case. And coming back to decentralization, this also means you cannot run everything through a blockchain, because a blockchain is basically just a huge database. And if you build like a chat application, like a WhatsApp, you don't need every message which is going through being verified through hundreds of thousands of validators. This doesn't make sense. So this part needs to run decentralized on your infrastructure, but when you go public, then you need a blockchain to verify information and data and so on.
Great, thank you so much. And that is all the time we have for today. So kind of last, what is the best way for everyone to reach you all, find out more about your projects, Telegram, a website? We can start with Aviad.
LinkedIn is always a good place to start. Our website, unfortunately, is misrepresenting everything we're doing in the name of innovation. So I would encourage you to reach out directly, and I'd be very happy to talk about what we're doing in this space.
Best is to look up our website. It's www.1io.com with the numeric 1io.com, and you can find all the information and go on from there.
LinkedIn, I don't give my Telegram out on stage. And then if you Google Web3 portal, you'll see all the work that we do and the networks that we build on and the developer tools available.
LinkedIn, and then you can go on the Proppy website, and then also my email is tanya@proppy.com. Pretty simple. And then if you guys want to find me after the event, happy to connect.
Great. Thank you all.
Thank you.
Thank you.
Thank you.
Thank you very much. Wonderful, wonderful discussion. All right, Kelsey and squad, thank you again. We have an amazing conversation coming up for you next, visualizing the future of metaverses and NFTs. Very exciting discussion with two very qualified thought leaders. Please welcome Ian Horn from Money 2020 and Alex Salnikov from Rarible to the stage.
Hello. That was loud, wasn't it? Thank you, everyone. Nice to be here. Thanks to the guys at Benzinga for inviting us too. I feel like we must be in a really good place in the crypto industry if we're talking about metaverses and NFTs again. I mean, that's bullish if nothing else is. So, hey, here we are. Anyway, I'm Ian Horn. I'm the EU head of content at Money 2020. If you want to speak at our show in Amsterdam, I'm the guy you speak to. You're probably more familiar with the Vegas event. And I'm joined by Alex Salnikov, the co-founder and chief strategy officer of Rarible, obviously a huge NFT marketplace. But Alex, let's give you a chance to explain what you do quickly.
Hi everyone. I'm Alex. I'm Chief Strategy Officer at Rarible. As Ian said, we've been doing this for 5 years now. In general, I'm for a long time in crypto since 2012. It's been lots of cycles. It's really great by now. We're at the peak of the bull run, not the peak, at the beginning of the new bull run, which is incredible. NFTs are about to go parabolic again. So it's a nice time to be in crypto. And yes, it looks like it's been a bit of a long day. Let's have some fun with the funny topic. Metaverse and NFTs are a culture and fun.
Oh, for sure. And you're definitely bullish. I think we've had a lot of optimism in the room this year. It's very different to the conversations in 2022 about crypto winter and everything being supposedly dead in this space. So things have really moved. But let's start with the metaverse, because that's an area where when people are talking about it, they're often panning it, right? I mean, if we look at the hype cycle, the metaverse isn't really being talked about in those great terms right now. But long term, I mean, what's your view? This idea of the metaverse, it hasn't really died, has it? And secondly, what do you think needs to happen for mainstream adoption to actually happen this time?
Okay, I'm really glad that you started with this question, because I think metaverse is one of the most misunderstood terms in the whole crypto industry. In 2021, we had this explosion of metaverse. Okay, metaverse equals NFTs, and Facebook was trying to create its own metaverse where you would supposedly go and run with your friends on a treadmill, and you would see them in a visual space. But it's actually totally wrong. Like, I live in the metaverse. I can consider myself, and what was the last time I interacted with the visual interface that looks like a game? Several years ago. it's actually like metaverse interface is not visual. Metaverse interface is like keyboard and mouse and website and a marketplace and a trading tool. So what does it mean that I live in metaverse? It means that I am like 90% of my net worth is in crypto. Some of that net worth is in tokens, and the tokens of the projects such as like Uniswap or like NFT marketplace that supposedly do lending, right? And we have like a shareholder meetings. We vote with our tokens on like these projects are generating revenue, where this revenue would go. And so there is a great essay from Packy McCormack, I think. It's called The Great Online Game, which kind of explains this concept of, okay, what is a metaverse? It's a big game where we all interact, and it all exists in crypto, and crypto provided like financial rails for that. So when I'm in the metaverse, that means that like I have my online identity, I have my wallet that shows up to these events, and my wallet has this wallet is me online, and as soon as I feel it as me online, I want to dress it up. For example, the same way I want to dress up here, I want to dress up me online, and that would be an NFT, right? And for many people, it doesn't make any sense for the outside perspective, but when you really feel like this is your digital identity, and okay, this is a CryptoPunk that is like worth 100K, this is my digital clothes for my digital avatar, and there is no NFT adoption without crypto adoption and without wallet adoption. It's like it's a hard truth that we need to understand, and then this explains how the market is reacting today. The Web3 is trying to solve the scalability issue that would lead to the wallet adoption, that would lead to crypto adoption by millions of people, and then some of them will convert to the NFT holders that would use different things as NFT. That's like a very short explanation of how I see the market.
Yeah, I mean, it's hard to describe it in short terms, isn't it, though, at the same time? I mean, I spend my life halfway between regular traditional finance and fintech, mostly with my work at Money 2020, but also in DeFi. I'm the author of a book called Why DeFi Matters, so it's something I've looked at in detail. And identity, I'm finding, is really crucial to the traditional finance space. I believe roughly 30% of digital transactions made in the US last year were done through a digital wallet. And we're seeing similar things with Web3, where digital wallets are becoming central to identity. So I guess there's a difference between doing things in Web3 versus Web2, but at the same time, identity is everything. I guess the question I want to ask you now is, you know, Raritable's made a lot of its money through the B2B market and brands leveraging NFTs in the way that, you know, we associate NFTs with PFPs and so on, but now it's, you know, brands are using it. To those looking to make money in the metaverse, what advice would you have?
Okay, I was thinking about that as well for a long time. As Rarible, first of all, we're playing a very long game. Is again, the grand vision is to onboard millions of people, hundreds of millions of people into metaverse, which is like using wallets and crypto. And that what we are actually doing is we are building the infrastructure for that. For example, we are indexing all NFTs on all chains that ever existed. So we have a database of all NFTs, and whether there's going to be like RWA NFTs or other NFTs, we will have the knowledge about that. And then we use that data to provide tools for different brands and like retail consumers to do something in this metaverse. So my advice for people, like it would be for brands, would be to not try to build their own metaverses, but to join metaverse in a meaningful way. And then several meaningful ways that we've seen so far. One of the examples would be Mattel, that is selling digital goods. Online. They sold like 10 million worth of digital cars with their Hot Wheels brand. It's one of the meaningful ways to enter the space. McFarlane Toys would be another one. Cryptoys, finally, like the toy sector is there because it's easy to tokenize IP, which is virtual by default, right? But then we would go to other things, tokenizing NFTs that are like go beyond that. Another meaningful way would be, I think, to build online community. McDonald's is doing that by collaborating with Doodles, or we just did a drop with Lamborghini that partnered with Animoca brands. So the traditional brands, they tried to enter the space, they hit the reality hard, and now they took a step back and they're re-entering the space in a more meaningful way by partnering with people who are living in this metaverse, who are like first-class citizens of this world.
Yeah, and I'm going to build on that. If you're trying to use NFTs to monetize brand loyalty, what are the best ways to do that? What is it? You know, how do you create community? What are the things that really you're selling here?
That's actually one of the hardest part, because in the traditional metaverse, like fully Web3 native way, people are tokenizing the IP itself. So a good example of that would be Pudgy Penguins. Pudgy Penguins, there was 10,000 of original Pudgies, and then they created all sorts of derivatives from that. They created all sorts of derivatives from that. They used stickers in like all the popular social media apps. They have like billions of impressions, but then the value flow goes back to the holders of these Pudgies in the NFT world, and ultimately they're all looking for revenue share, right? That would be another hard truth. If I own a Bored Ape, if I own a Doodle, if I own a Pudgy, I'm expecting this to get like up in price, just because there would be value flow back to that. And that is what hard for the traditional brands to do, to tokenize the brand loyalty, because they're not sharing revenue, but different reasons they don't want to, and there is also regulation, right? So I would say like just regulation will change, and they just need to start tokenizing this brand loyalty. They need to start doing something, doing experiments, onboarding their people, giving them wallets, giving them something. So it is a longer road for the Web2 native brands. It's easier for Web3 native brands. Another way would be to acquire one of the Web3 native brands, like Nike did with Artifact.
Yeah, really interesting point. Yeah, and I guess I would like to know what lessons we've learned from the previous hype cycle, right? Because, there's a lot of speculation. I mean, some of the things you mentioned there are relatively speculation based. So what can we learn from all the things that went wrong last time with NFT, hype cycles, and to a point, the metaverse as well, because people were strapping the metaverse to pretty much anything in the hope that it would garner some interest. So what do you think's different this time?
Right. Okay. So there was a lot of things that went wrong. Obviously, the NFT is an obscene word in many communities these days. First of all, what went wrong was the extreme financialization of that and speculation. We basically experienced in 2021 a massive bubble of mini Ponzi's, where all the value was derived from a greater fool theory. Who can you resell it to somebody else? And that's why everybody hates NFTs. That's why everybody will hate meme coins next cycle. It's happening exactly the same way. So hyper financialization was wrong, but I'm not sure there was a way around that. We're seeing that everywhere in the new industries. Another one, we didn't have really infrastructure at the peak of the bull run. It costed $100 to create any NFT, even if it costs $2 to buy one. So it doesn't make any sense. That was totally wrong. And then another one that I briefly touched, it was kind of superficial. Like many people approached it in a very superficial way when we actually are building something grand here. And if you want to do something in a meaningful way, we needed to be deeper. Many Louis Vuitton tried to do this, these boxes of physical items, $40K each. They hired influencers, and then they didn't sell. They realized that something's wrong, right? You need to build a more meaningful online community. You need to invest more into that. Crypto people are kind of quick to judge whether a brand that's coming to the space is doing value add or value extract, and they're like, okay, those guys are value extractor. We're not going to interact with them. They're canceled.
Yeah, that Louis Vuitton example is actually a really, really good one. So what did they do exactly wrong? How was it obvious that they were looking to extract value rather than add it? And could you compare that with someone who did it properly and did it well?
Right. I think one of the things that was done wrong is that they put too much effort into the physical things. The Web3 culture is virtual at the beginning. There was okay, you needed to receive a physical box at your home, so you couldn't flex online. Then they didn't spend a lot of time of cultivating the community, and they were actually very expensive, right? $40K to buy. Most of the successes in crypto started with Bored Ape. It was 0.1 ETH mint, and then it went up in price, right? So, and here we're trying to earn revenue right away with $40K sale. So that's a clearly extraction of $40K out of my pocket right away.
Yeah, well, and again, with Web 2 and Web 3 kind of commingling, that does create some issues, doesn't it? Because the first attempts to build out the metaverse, you look at all the money that was spent on hardware development, the people doing it were Meta, Microsoft, Google, and so on. So how does Web 3 kind of carve out its niche there? How does it compete with that?
Well, that's a great question. the Web2 brands, the Web2 big tech companies spend a lot of resources, and we're actually seeing an interesting results of that. Like Aptos and Sui is one of the two prominent blockchains today that were built for 8 years inside Facebook. Facebook put 8 years and a lot of resources into build these technologies. They're actually great technologies, one of the best tech if you come to the blockchain space. And then management went to Aptos and development went to Sui. That's kind of the same team. So, and the market caps are like tens of billions of dollars effectively coming out of the Facebook. So they did great, but because of the regulation, they couldn't enter the space. They couldn't do that. And that actually gives a lot of opportunity for Web3 native companies to compete against them, because they actually, their hands are tied. Well, at least were tied until this new administration is coming in. Telegram was able to circumvent the regulation, and they did it actually pretty well. They did an ICO, they raised $1 billion, they couldn't launch their TON blockchain, they had to spun it off into open source community, and then they adopted it back, and they are selling the treasury right now, and they were able to get like billions of dollars out of this.
Yeah, and we've got about a minute left, but I want to ask you a relatively tricky question. You were talking about identity right at the start, and I think that's a really crucial piece here. But then social media comes into play, right? You're talking about online identities moving from place to place to place. We see the rise of some Web3 social, like Lens, for instance. Right now, obviously, the dominant players are X, Face, Meta, whatever. How do you think NFTs are going to become more and more important for our social media identities, and how do people make bank off of that?
Right. Thanks. Okay. I'll try to be relatively quick here. So I'm a big fan of on-chain social in the same way. Like Web2 is the internet where the core of your identity is your email. Web3 is the internet where the core of your identity is your wallet. We will have the same apps. We'll have Messenger, which is built on Web3 primitives. We will see a social network that is built on Web3 primitives. We're already seeing that Farcaster is a great decentralized social media. It doesn't have a lot of users right now, but there is like great examples of how people using that. I can connect to like NFT marketplace, and I can see what my friends from Farcaster have produced as NFTs. So this is the way how it's meaningfully connect your identity with like a social graph. Okay, we're out of time.
Yeah, we are. But one thing, everyone's feeling bullish today, right? Yes? You still feeling bullish after hearing about NFTs in the metaverse? Maybe not. Well, we tried. Thank everyone. Please, round of applause for Alex Salnikov.
Thank you very much, gentlemen. Really appreciate you all being here today. Great discussion. All right, y'all, we are still going strong. We have some amazing content coming up. Some good friends of Benzinga. Super excited to introduce the next panel to you. Why Wall Street is embracing altcoins and stablecoins, led by the one and only Kyle Braden, Director of Digital Wealth from BlackRock. I'll let him introduce the panel to you. Please welcome Kyle and squad to the stage. Give them a warm round of applause.
All right, good afternoon, everyone. I'm Kyle Braden. I lead business and platform development for BlackRock's U.S. digital wealth channel. BlackRock is the world's largest asset manager who in recent years has gotten louder and louder into the cryptocurrency space. I'm really excited about this panel today. This panel is titled Why Wall Street is Embracing Altcoins and Stablecoins, where we will aim to examine the benefits and challenges of incorporating altcoins and stablecoins into your portfolio and institutional tech stack. I'm honored to be joined up here on stage by three experts in the space, Jennifer, Chuck, and David, who come from a variety of backgrounds. And before we start, let's do a round of introductions. David, maybe we'll start with you.
Yeah, David Alderman. I'm a research analyst at Franklin Templeton. Franklin Templeton is similar to BlackRock, but a smaller version of that. We have $1.5 trillion assets across all different asset classes. But we have our own focused digital assets team, and that's both on like the building side with tokenization and on the investing side. And then as for myself, I have a TradFi background, spent some time working in a macro fund and in banking, but just personally just got obsessed with crypto and been trying to do that ever since.
Hi, everyone. I'm Chuck Mounts. I'm the Chief DeFi Officer at S&P Global Ratings. This was a team that was set up about 3 years ago, and at the highest level, my team is the mission is to help S&P adapt our products and services, and then create the new generation of products and services that are fit for purpose in digital asset markets. So we're looking to bring into the crypto financial ecosystem the same sorts of data analytics and benchmarks that we provide in traditional markets to enable decision making, enhance market liquidity, and price discovery.
Hi, Jennifer O'Rourke with DTCC. For those of you unfamiliar with DTCC, we are a CSD, or a central securities depository. So again, for that specific group of folks that haven't stumbled over us yet, what that means is when you buy a share of Amazon or Tesla, it ends up being housed with us, even though you're buying it through your broker dealer and it's moving through a custodian. We end up being the custodian of custodians for security assets. I've been with the team now for almost 5 years, but DTCC has been looking at digital assets for 7 to 8 years through a progressive degree of work in white papers, research and analysis, proof of concepts that we've run across tokenization of securities, experimentation with digital cash, and now on the back of our acquisition of Securrency, we're going to be launching platform solutions for tokenization, lifecycle management, and analytics on blockchain. I myself specialize in digital cash and digital settlement. Really excited to be here.
Awesome. Well, let's jump right in. And Jennifer, maybe I hand it back to you first. What has driven Wall Street's recent interest in altcoins and stablecoins? And then maybe a follow-up question on that is, what impact do you think the election will make on this?
Yeah, so it's interesting because many of us have been at this for a long time, and so we're well familiar with the concept of stablecoins, obviously altcoins as well, as those were the front runners in terms of how this market has developed. These tools aren't new, but an inflection point has occurred more recently where we're seeing an uptick in the velocity of folks engaging with these tools. When I say tools, products, whatever. And what I would say that inflection point as a result of is quite simply the fact that we're dealing with emerging technology within a nascent marketplace. And even though many of us have been at this for a long time, in the broader life cycle of the maturization of these new assets and asset classes, marketplaces, and participants, education and adoption, it's early days. It quite simply is still very early days. So before, when there was more experimentation happening to understand what does tokenizing an asset mean, now today, with those learnings acquired and path to production being a focus of any work that's being done at a company, the question becomes, how do you actually truly deploy these assets in a way that can be monetized, not experimented with? And to be successful at that, you need to have some degree of tokenized cash to be able to facilitate a delivery versus delivery payment, or quite simply said another way, paying for your digital asset transaction, or else that transaction will be beholden to the slowest part of it. So even more specifically, what I mean here is that if you're going to buy a tokenized asset so you can access the benefit and the value proposition of settlement finality, of a automated programmable asset that can do what you tell it to do or what it is meant to do when it needs to, then you need to be able to pay for it as quickly as you want to receive it. And right now, the settlement rails for cash and stable coins as one of the tokenized cash assets or digital cash assets just are not able to operate at the same speed as the actual tokenized asset itself. So we're watching the market today start to get creative about how it can respond to regulatory, a lack of regulatory clarity and some other operational challenges around deploying stablecoins. And those creative solutions are carving a path forward in a way that just did not exist before. I know we'll get more into the details of what those look like, but I think especially to close out your question on the back of the election results, it has been explicitly clear that there is a
attitude to increase the velocity around the deployment and utilization of tokenized assets, cryptocurrency, writ large. What that exactly looks like, I've got a couple of ideas that we'll touch on, and I'm really excited to hear from the rest of the panelists as well. But bottom line, things are going to move a little bit faster now than they have before, which aligns with the need of the market on the back of the market's just natural maturization and evolution.
Awesome. Chuck, maybe same question to you.
Yeah, so kind of jumping on in addition to that, so stablecoins really are, I think, positioned to be the accelerant to the mass adoption for TradFi firms and kind of crypto financial capabilities in the marketplace. So we are particularly excited about the tokenization of real-world assets, and stablecoins are the birthplace of that concept. And so when we launched our team 3 years ago, and after we kind of spent a good amount of time doing market soundings across all sorts of stakeholders globally, it became clear to us that there was a lack of clarity around the inherent risks between different stablecoins. And so this was pre-UST Terra Luna collapse. So we decided to launch our first product in the crypto financial space, the Stablecoin Stability Assessment. This is a non-rated product that measures the risk of a stablecoin depegging from its one-to-one intended mark against fiat currency. We launched that product about a year ago. And so that's an example of my team's mission to help build and new products that are relevant and fit for purpose in this marketplace. That's just the beginning of kind of the additional product development that we see coming, bringing together our capabilities around data analytics, risk assessments, and index-sized products. Stablecoins will also be a center point around policy formation. So we've always said policy formation is the single most important non-technology catalyst in the sector. I think it's very difficult to overstate the importance of this last election because it's not just that you have the executive branch that is more pro-crypto, but you have both chambers of Congress. And that is a huge development in terms of getting the U.S. off the sidelines on policy formation and regulatory clarity, and putting it more center stage and an active participant in policy formation around crypto assets, not only in the U.S., like in between jurisdictions in the U.S., between the federal government, between different federal agencies and across states, but also working as a catalyst internationally to help drive cohesion and policy formation around the world. So with all that said, I see it as a very positive development for the ecosystem, but to be tempered by it's still going to take a fair amount of time for rules and implementation to happen. But we think the first piece of legislation that's going to come up and get passed is going to be stablecoin legislation in this new Congress.
Interesting. David, I know you're wanting to chime in too.
Yeah, I mean, I think the other things I would add are, if you look at the previous administration, there was really, I think a lot of crypto companies were really afraid of working in the U.S. And there was the term called choke point 2.0, where basically if you're a crypto company in the U.S., you couldn't get a bank. And I think given the complete flip that we've seen with the Trump administration winning and being like more pro crypto, that's probably most likely just completely done. And so at least we would like to hope to see that, a lot of crypto companies that were thinking about leaving the US will stay, just because now, it's a more pro crypto stance in the US. And then I would also add, I think, there's a lot of crypto protocols that have been really afraid to add utility or some sort of value accrual mechanism to their token, for fear of being labeled a security of some kind. And now that, in the past 2 weeks, I think we've already seen some major protocols put out proposals to do some sort of fee switch or some sort of like token buyback program, something like that. So I think just generally speaking, people are very hopeful about where very hopeful that regulatory clarity will happen in the U.S. and that's going to help just drive a lot of growth, hopefully in the U.S., but also just globally, given the fact that the U.S. is is the biggest capital markets in the world.
Awesome. David, maybe I flip it right back to you. And can you walk us through how altcoins and stablecoins compare to traditional assets in terms of risk, return, and diversification benefits? And at Franklin Templeton, what are you hearing from your institutional clients?
Yeah, I mean, well, the risk associated with stablecoins and altcoins is very different. I would say on the altcoin side, it's really just a function of like from institutional investors how they want to invest. You know, now that we have the Bitcoin and ETH ETF, it's super easy to just get beta to the space. And I think a lot of institutional investors, they would like to invest in the tail, but they're not really sure how to do that. You know, historically they've done it from the venture fund structure, but it is kind of obvious that there's this market inefficiency where most institutional investors don't want to invest in a liquid fund, given like how volatile the asset is, and they don't really have a easy way to just invest in, like, call it like an index product. I think, you know, from their perspective, they would like to just have like some sort of allocation to crypto, and then most of that allocation would be in some sort of index product. But today that doesn't really exist.
Yeah, and Chuck, maybe over to you. Hearing that and what David's hearing from the client base, what tools have S&P come out with to help guide the investor base?
Yeah, so I would say the first product we came out with, as you probably are aware, we're the world's largest index provider, also the world's largest rating agency, so and commodity price provider as well. So we've got a lot of different touch points in market. Probably the first crypto-focused products we came out with were in our index business, and so we've got maybe a dozen or 15 indices that are kind of created around crypto oriented assets. And then I mentioned we launched our stablecoin product here about a year ago. And like I said, that's not a rating product. That's not evaluating the credit fundamental risk and your likelihood of a kind of default of an issuer. This is really looking at pegging risk. At the same time, though, we're in many discussions with different participants about doing an actual rating for a stablecoin. So that would be a rating product. It would be a regulated product, and that would be evaluating the fundamental credit risk and probability of default for a stablecoin issuer versus just a depegging. So that's something we're looking at. We've had a lot of incoming inquiry around, can we do a rating for different types of products? So structured products, tokenized money market funds, tokenized treasury funds, and all of those would pull from our historical expertise in undertaking credit fundamental analysis, and then bringing in component parts that are relevant for taking into account the crypto piece of it.
Jennifer, maybe passing it back to you to talk about the state of the market infrastructure.
Mm-hmm.
How does it compare, the liquidity pools and the market structure for altcoins and stablecoins compared to traditional assets?
Yeah, so there's work to be done here. We have two key observations when we look at the state of play right now. First, as it relates to liquidity pools, and then I'll come back to infrastructure. So within liquidity pools, we essentially have observed over the years that we have seen the launch of smaller scale, isolated, tokenized products. And that resulted in these independent or segregated pools of liquidity that are typically short dated and have less than a full life cycle that the traditional asset would participate in. That's not a problem. That's how you start. And like I said before, we are still in the beginning stage where you have to create, whether it is a experiment and a proof of concept, or it is a product with a path to production or a launch in production, you have to make tightly scoped use cases that make sense to your clients and your product. So a starting place to say that we'll do a short dated bond that's only going to be issued in the primary market that will not be eligible to transfer into a tokenized secondary market, that makes sense because that allows us to begin. But as a result of many occurrences of that, to use tokenized bonds as an example, what we're left with is essentially this federated system of a fragmented marketplace that needs to be connected together with some type of standards or infrastructure. And realistically, it's going to be a combination of both of those things plus some other components. So how do we get there? We've seen some really interesting projects coming up, many through the BIS, or the Bank of International Settlements, that are trying to incentivize the issuance of various modalities of digital cash, whether it's tokenized bank deposits or the interplay between bank deposits, stable coins, synthetic central bank digital currency, to explore what it would look like when we start to see sovereign issuance of money by the state. All of those experiments are really interesting, and in doing so in these essentially global projects, we're able to start thinking through what are the standards that need to be harmonized so that we can actually develop solutions that will be used across nation state lines and don't result in the further expansion of this fragmented digital marketplace. So the infrastructure through cohorts and various public-private partnerships that are exploring this are coming along, but we need to see more of it. I'd also say that just simply applying a series of principles to projects at inception so that we can have kind of some directional harmony is going to be important. And so what do I mean by that? Recognizing that what you're building today should have some kind of path to a future, scaled utilization that needs to include how your clients are not only going to access these different type modalities of money, but how they're going to settle them. So, for example, today, tokenized assets have a native RTGS, or real-time gross settlement model. And what that means is that whenever the requirements of the transaction are closed and have been made available to the participants, then that transaction will settle. And if that happens immediately after trade execution, that's when that happens, or when whatever the constraints of the trade or the criteria of the trade have been fulfilled, then that's when that transaction settles. That's great because that accelerates settlement time, and there are obvious benefits and value propositions to that. A consideration that we need to further explore, and I mentioned this specifically to anyone building or thinking of how you're architecting solutions out there, is to ask ourselves the questions: do your clients want to be settling net or gross? So do they want to settle transaction per transaction? Do they want to pre-fund every transaction if they're going to settle RTGS or real-time gross settlement? Are they prepared to lose out on the capital efficiencies of netting in settlement? These are questions we need to be asking ourselves, because we need to consider what does it mean to exclude future state settlement solution that we haven't seen the deep research and analysis to figure out. Although the benefit of RTGS is great, do we need to start considering T0 intraday, T0 net end of day, et cetera, et cetera? And I'm excited at the prospect of seeing a deeper conversation around that amongst other considerations, so that we can prepare ourselves to resolve these issues and we don't have to reverse engineer into solving them as we more greatly fragment the marketplace as we build.
Gotcha. And David, maybe I'll bring it back to you, and Jennifer touched on innovation here, but you commented on the election earlier too, but how do the current regulations impact the adoption of altcoins and stable coins across the Wall Street community? And then looking forward, what potential regulations might either enhance adoption or hinder adoption in the space?
Yeah, I think there's, I would point to two different factors. I guess, one is the fungibility of different tokens. Meaning, if you have a tokenized money market fund, you have to choose jurisdiction in which it resides, but that also means that token might not necessarily be available to someone in a different jurisdiction. And so then you can see a world where you start fragmenting the space, and it's basically the same product, but it's like, it resides under different jurisdictions. I think we've seen that a little bit with MiCA in Europe, where they're doing, they have Circle is like registered under that framework, but it has to do with any sort of USDC stablecoin that's issued in Europe has to have those assets, the reserve assets in European banks or European debt of some kind. So, I think there's some path to where you don't fragment the market based off jurisdiction, but we'll see where that goes.
Jennifer, you want to jump in?
Yeah, could I actually build off that? Because I think you raised such an important point there. Another consideration around stablecoins is as we start to see stablecoins evolving such that they can be issued on different chains, there's actually operational implications to trying to do a transaction with the same stablecoin but issued on different chains, because if all participants in the life cycle are not on the exact same chain, even if they are paying, settling, whatnot, with the same stablecoin, then the administrators or governors of that execution and post-trade process are going to have to figure out how to enable their members to offboard into either the issuer of the stablecoin to switch into the other chain, or how they're going to actually provide those facilities themselves. And this is another area that we really need to dig into, such that these operational processes that have business process impact can be explored a bit further, again, as this market continues to mature.
Yeah, that's exactly how we're thinking about it as well, in terms of how do we parse out kind of traditional credit risks against operating risk, against regulatory risk, and looking at kind of looking through a new lens of risk assessments that are going to be relevant in this marketplace. And we believe that these are the types of tools that will help facilitate the growth and adoption of the capabilities in the marketplace. Going back to your comment of market fragmentation, to me, it seems like one of the great promises of crypto finance is to start breaking down the historical liquidity silos that exist in markets. And that, coming back to this recent election and policy formation, that is one of the key unlocks, I think, that if we get coherent, holistic, forward-looking prudential regulation and legislation, or other way around, legislation that leads to prudential regulation, that enables financial companies to actually own crypto and own Ethereum to pay gas fees, you're going to see, I think, an ability to kind of move away from private permission blockchains to more public permission blockchains. And that's where, in my opinion, the innovation is really going to kind of take a leg up. So I think there's a lot of movement that has been, I think I've said before, and I'll say it again, I think we will look back 10 years from now with our 2020 hindsight and say that 2024 was a pivotal catalyst year to drive the market forward, whether it's the ETFs being launched, whether it's big firms like BlackRock launching new products, or now this election.
Jennifer, maybe just a comment on major financial institutions that you work with every single day. What are their big challenges and the considerations in integrating stable coins and altcoins into their maybe legacy technology systems?
Yeah, absolutely. So I would say first and foremost, it's a topic that we've been already touching on, but it's regulatory ambiguity right now. And just to kind of run through, I think, like a double click into, so what does it look like as we've been talking about here, this acceleration of a move to regulatory clarity? In my opinion, it's still going to take some time. It's great that we can have an acceleration of bills being passed into laws, which we do expect to see happen quite quickly. But just because the bill is passed into law does not mean that that is ready to go compliance-wise so that the street can use it. There are a couple of other kind of procedural things that still need to happen afterwards. There's a rulemaking process that has a commentary process that can become cyclical, and you can have a couple of turns at that. Then there needs to be harmonization between your federal agencies and your state agencies, both of which have been instructed in all versions of the stablecoin bills that are currently in Congress right now. And we would expect to see considerations for both state and federal continuing in some degree in the reissued bills that are put into the next Congress. And then in addition to that, you just simply have to have a deeper education and adoption process by the market participants, which many firms right now are in various stages of exploring, but we're going to need a larger scale of participation to make this real. So I don't say, and I don't note any of those considerations as showstoppers at all, but I think that they're really important to qualify that this change is not going to happen overnight when we see bill passed into law or signed into law by the executive branch, there will still be steps that need to happen that will take, in my opinion, a few years before even stable coins are readily usable in production. And then we can look at some of the other modalities of digital cash that have their own challenges, whether it's just simply inventory, because there aren't a lot of options out there, or adoption on the back of thin inventory as well. So the bottom line here is it's going to take some time to get to where we need to go, but the work that we're doing today prepares us to be able to execute as those considerations fall into place.
Awesome. So as we wrap up here, maybe in 30 seconds, if you're in this room, you're probably a forward thinker, but you look at over the next 3 to 5 to 7 years, what role do you see altcoins and stablecoins evolving? David, maybe do you first.
Yeah, I mean, I think, we kind of hinted at it earlier, the tokenization that we've seen over the past year, is still very much in the early stages, but I would imagine that that's going to be way bigger than it is today. I would imagine that stablecoins are going to be more active, especially on the consumer application side. And I would also think that, institutional investors will be able to have way easier access to the different types of products that they want in crypto.
Awesome. Chuck?
Yeah, I think stablecoins will continue to play an important role in really the spectrum of cash-like or money-like instruments. So tokenized deposits, stablecoins, wholesale or retail, CBDCs, there can be a role for most, if not all of those. I think it's a little hard to predict the pace and scale of acceleration right now, but that the building blocks have been put in place to provide the solutions kind of as the capabilities are built to help facilitate the solutions. The other thing I'd say is that, there's been a lot of, as stablecoins grow now, there's a growing body of U.S. Treasuries absorbed into pegging or kind of maintaining stablecoins. What are the macro market implications of that? And to me, that's quite an interesting subject to think about beyond the operational efficacy of stablecoins, but also kind of from a more macro perspective. And I'm sure that's going to become an increasing focus of regulatory bodies, but also looking at international economies that, to what extent will stablecoins provide an opportunity or pathway to dollarization of foreign economies? So that is a super interesting aspect to me. And if you're my colleague who's not here today, but moved here from Argentina, and if you want to have U.S. dollars, it's difficult to get them. But now about a third of the market of the black market that trades like at a shop on the street corner is done in stablecoins. So what are the implications of that for dollarization? I think it's a really interesting question that will start to come into focus, I think, in the coming years.
Awesome. Jennifer, why don't you close us out?
Yeah, so I'll just wrap it up quickly. Chuck, I love what you said about the dollarization. I think there are some very important geopolitical implications there that I agree with you on. It'll be interesting to see how it shakes out. I'll leave this group with a slightly provocative idea here. So as we see an acceleration on the altcoin side and perhaps a clearing of potential regulatory barriers, I think that it's highly possible that we also see some market events happening, and then we see the market respond in kind to those with more of a view on security, safeguards, regulatory guidance as a response to market events on the back of an acceleration towards altcoins now.
Awesome. Well, we are at time. I want to thank each of our panelists for their expertise, their time, their insights. We hope you found this very valuable, and have a great day. And we'll talk soon.
All right, thank you so much. Wonderful discussion led by the infamous Kyle Braden from BlackRock. Appreciate you, sir. We have some more wonderful discussions, just a few more pieces of content. Reminder, we will be celebrating our 10th annual FinTech Awards this evening at 5, followed by a reception right outside this stage. Please stick around. We have some awesome recognition happening. And if you have not scanned this QR code, Benzinga APIs, we have a booth upstairs to have a conversation with you as well. With that being said, please welcome to the stage the next panel led by Eric LaPaglia, the CSO of Property.
Good afternoon, everyone. Anytime you're at a conference, it's the hardy crew that stays till the end. And I think you'll be well served for staying towards till the end because this panel is going to be amazing. I've already been guaranteed backstage. Guaranteed. It's a mortal lock. So anyways, again, Eric LaPaglia, primarily an angel investor in technology, longtime advisor, and obviously very heartened by where we're at in the space. With that being said, I'd love you all to just introduce yourself briefly and we'll jump right in.
Yeah, thanks, Eric. Zach Pandel, I run research at Grayscale Investments. Grayscale is the world's largest crypto-dedicated asset manager. We run 25 different crypto investment access products here in the US. Thanks.
I'm Robbie Mitchnick. I'm the head of digital assets at BlackRock.
Anthony Dixon, FTSE Russell. We've been in the space about 5 years, traditional index provider. We have a number of different products across the space, from flagship series covering large, mid, small cap, staking series. We have a sector-based series and a number of custom products on top of that.
My name is Paul Capelli. I am the head of ETFs at Galaxy Digital. We manage a number of digital asset ETFs and equity ETFs globally.
So we have a really compelling topic of mitigating risk. I know everyone loves talking about risk. I don't know if you all had on your bingo card at the start of the year where we'd be at and kind of the adoption curve and the enormity of the inflows that we've seen into the ETF products. I certainly did not. And so I'd love to hear a little bit about what you're thinking or what you'd advise investors to be looking at as these products are now launched and live. And obviously there's a strong expectation even more will be coming down the road. So how are you advising your institutional or even educating your retail clients in regards to direct exposure, leverage, accessibility, which the ETF obviously provides for?
Great, I'm happy to pick it up. First, we can take it from there. Maybe I'll offer the sort of macro angle. In addition, these guys can pick up on the product side of things. So, of course, there's a bunch of products in the market. I think our product is the single best way to get Bitcoin or Ethereum exposure into your account. But these guys will have their own views. So, a lot of what I do, though, is not so much talk to investors about product. It's to talk to them about the Bitcoin investment thesis to begin with. Bitcoin is coming on 16 years old, and yet the vast majority of investors have not spent any time thinking about it, don't have it in their portfolio, and it's been a bit of an afterthought. And in fact, something that is considered too risky and even inappropriate for a financial advisor to be offering to their clients. That is completely changing, and I can tell you, myself and the Grayscale sales force are maybe the closest people to the front lines of this issue, traveling the country, talking to financial advisors about these products. And so really it's telling the Bitcoin story first and foremost, explaining what this asset is, this digital form of hard money, and why it makes sense in the portfolio today because of many of the things that we see around the world. The macro case, a high inflation, a legacy of government debt, a fragmenting international monetary system. These are all the things that drive people to Bitcoin. So the products are a huge part of it, but the macro case is really where the conversation begins.
Yeah, I think for a lot of investors, they're overwhelmed with this space still. And I think they're learning, what digital assets are, what the different options are for them. A few years ago, there weren't any ETFs. There were no really easy access vehicles besides maybe, downloading an app on your phone and, getting yourself a little bit of exposure to Bitcoin just to learn what it is. And, there's a variety of different options that exist out there, depending on what your risk tolerance is and what your investment thesis is, right? So you can, look at, venture options. You can look at ETFs. You can, buy and hold Bitcoin on a ledger. So for, the investment community out there, whether you're talking to retail, you're talking to high net worth, you're talking to, an institutional investor, you really have to tailor that conversation based on, what they know about the space and, what their risk tolerance is and, what their time horizon is for an investment. Do they want to be liquid? Do they want to be illiquid? Do they want to have some mix of both? So I think that as investors continue to learn and come up the space, and certainly ETFs help with that, they then start to make their own decisions, and we just try to help them along the way as we present those options to them.
I think I agree. I think it's very safe to say that the appetite's there. Aside from education, I think the appetite's there. We see a lot, even crypto adjacent asset classes. You see the appetite. So you look at names like in the traditional equity space. You look at names like Marathon, Coinbase. I would say even. I mean, there are a number of options out there, but the appetite's there for this asset class. I think the ETFs are a great entry point. I think these are still. It's still very early in the process. I think what we see now are a big focus on single asset products. But I think in 2025, 2026 and on, I think we'll start to see more diversification. I think we'll see some activity away from Bitcoin and Ethereum in particular. And I think even, looking even further down the road, yield-based products, I think will be really interesting. So I think that's something to keep an eye on. Again, still early in the process. 2024 was a big year, but looking forward, I think we can see some more elaborate products in the space.
Yeah, I think we'd be a little bit more skeptical of that playing out. I think if you look at the trends in Bitcoin's dominance, it's been pretty staggering. I think part of the reason for that is it really is in a different category today versus the rest of crypto. And there's a ton of really interesting, promising projects kind of down the table in crypto land, but Bitcoin as a emerging global monetary alternative in this sort of digital gold thesis has just a total step change, different level of resonance with a lot of our investor base from a investor narrative and thesis clarity perspective, and for the potential role it can play in a portfolio. So I don't think we would have predicted that Bitcoin dominance would, shoot over the course of the year to quite the degree that it has. But I do think, we'll sit here probably a year from now, and I don't think we'll say, oh, that was just the first thing, but then there were, all kinds of other things, and actually those were the big thing. I think a lot of the trends that we've seen this year probably are well positioned to actually continue.
So, I mean, just if you look at the inflows and outflows, I think that echoes what you all are saying. Bitcoin's inflows this last week were several $100 million versus collectively the Ethereum ETFs had an outflow of, I think it was 39 million. So you're definitely starting to see a divergence in at least institutional adoption of the asset class and probably on the retail side. And I see more and more vocal, let's say, individuals, high net worth and institutions who feel like they have cover now. They can actually publicly say, Paul Tudor Jones, I'm sure you saw today, and it's actually, I believe, into your product, doubled down on his position and took an even larger position in BlackRock's Bitcoin ETF. Also, the options launched today for BlackRock, and the inflows into that were, I think, $400 million, which is certainly unheard of. Was it higher? Give me the number. What's the real number?
Earlier this afternoon, it was over $1 billion.
I'm sorry. I prepared my notes this morning, so I apologize.
Things happen fast here.
So institutional adoption, I think, we all want to see more of that. Signum released a report last week saying 57% of institutional advisors and investors are looking at taking even larger allocations into the space. What products outside of what we have right now as we go into Never Never Land of next year, what are some of the things that you're already hearing from these institutional investors that they'd like to start seeing in the marketplace?
I can start this time. I think our view, there may be some interesting things that come up that resonate with clients that we start to hear patterns of interest in. We haven't necessarily seen that yet, although certainly with the advent of options on IBIT and potentially other ETFs, I think there's some interesting things you can do around that. But it's not like, we did IBIT and now ETHA and now what's next. There's a ton of work to do to actually flesh out the opportunity and the investor uptake around what we have, right? I think we're at such an early stage in the education journey for so many different investor types, right? The end investor direct buying of these products has been off the charts, but wealth advisory is still only, a fraction of that pipe that's really been opened. And institutional, they're still, I would say, for the most part, pretty early on the education journey. I have some thoughts around, how the education has been unduly impaired by some of the narratives that are out there. I'll maybe come back to that later. But there's a lot left for us to do in 2025, frankly, 26, even with what already exists.
I could maybe add, I think there's a little bit of a misperception that institutional investors don't have access to crypto. The largest institutional investors have a lot of private fund investments, and a lot of that is venture, and a good chunk of what is happening in those venture portfolios is crypto venture. And so, if you sort of look at many large diversified endowments or whatever, they're going to have some crypto through a venture portfolio. So some of that is covered already by the private fund industry. So what I foresee happening is products that target a ultra high net worth individual or the fund advisory business. So things like separate accounts or other types of private fund structures, I think is what the marginal capital is going to seek. The institutional investors that want token holdings specifically rather than ETF and rather than equity venture stakes. So that I think that'll be a big part of the growth of the business over the next year.
I think it's important to remember that institutions have such a long time horizon as they develop their, different investment theses, and we've, seen them investing in venture in this space forever. They're coming around on the liquid side, certainly with Bitcoin, but Bitcoin's been around for 15 plus years. It's got a pretty long track record as a diversifier now in a portfolio, and they can kind of, test that over, 1, 3, 5, 10-year, 15-year time period to see, how it performs. But I think that they're also realizing that this is also the beginning of a new asset class, right? You're going to see, companies now coming public. I think there's something like 70 or 80 crypto equities that exist out there. So you need those companies to kind of come around, in addition to things like Bitcoin and Ethereum and Solana and these tokens that have real use cases, but they're getting educated. So I think agreeing with what Robbie and Zach said, right? There's still that bridge that retail and wealth and all those advisors provide before you get to that institutional level, I think, for the asset class. So I think we're just going to slowly see each institution start to, stagger in to different points of the asset class as they always have with other asset classes. But I think, with crypto, there's certainly appetite at that, wealth and advisory level that's going to help, certainly increase the appetite for the asset class.
And I'd say, I think there's a little bit of hesitancy around some of the names that are outside of, the most well-known names, Bitcoin, Solana, Ethereum, et cetera. I think there's some concerns around liquidity. And I think that's something that comes back to the point on education, where there is liquidity in a lot of these big names. If you were to compare it to something like the Russell 2000, the lower end of the Russell 2000 and the top 50 crypto assets, the liquidity it's there. It is absolutely 100% there. So I think that's something, it plays into the education piece, but it also plays into the evolution of the asset class.
Well, do you think that's simply contempt prior to investigation then? People just hear that narrative and they don't do the further research to look?
I think some of the complexity around the actual names, again, I'm looking at the top 20, top 30, something like that. I think the intimidation on what are these, what are the use cases, I think that's still a big blocking point. I think that's still going to be a challenge. That could be a challenge for a few more years, to be honest. But I think that's where we come in and we say, hey, we've looked at these names, we've bucketed them, we've classified them, we've put some structure around the ecosystem. And I think that's a great way to educate potential customers.
Okay, so everyone's used the word education at this point. What do you think's missing? I've said this for years. It's a decentralized industry, and I think it's one of the primary difficulties is there's no clarion voice that you can turn to and say, this is our North Star, this is the one who's going to disseminate the source of truth. What role?
And that's great.
It's wonderful, but then we're 15 years into Bitcoin and we're still talking about education. So what roles organizationally do you feel like you as stewards in the industry play, and not only on the institutional side, but for the retail investor as well?
I think education's great, and I think we can all talk about the different ways that we educate investors. But I think the big theme that we're going to see going forward, and we've certainly seen it come about in the last 2 weeks, is regulation. And I think that once we have clear guardrails for the industry, once we have some rules of the road for every level of investor to play by, I think that is actually going to be a bigger thing for the industry than just the educational piece, because I think all these firms that are sitting here today have spent a lot of time educating investors, but you can't really move that ball forward without the regulatory piece behind it.
Yeah, I would just say maybe to stick my neck out a little bit. I mean, I think Bitcoin sells itself. People just need to look around at the world and see what is going on. And the election cycle was a great example of that. We have a 100% debt to GDP ratio. We're running a $2 trillion deficit, and both candidates talked about how they could expand the deficit in their policy plans rather than do anything about it. So, that's the kind of thing that financial advisors, investors are aware of and wondering what it has to do in their portfolio. So, just my role is just to explain to them that you have an instrument, a tool to own in an investment portfolio that can help with exactly these sorts of problems or benefit from a return standpoint from exactly these types of macro trends. So, people are aware of all these facts. I think it's just connecting them back to the Bitcoin story is the education that we need to provide.
So I think from an education standpoint, a lot of the crypto research that's been out there has been very counterproductive, because it has, if you think about business models, sometimes if you're, a prime broker or research outlet or an exchange, you have an incentive to create news that'll drive trading every day, right? And Bitcoin and crypto don't generate fundamental news on a daily basis, right? And so what I think has happened is a lot of these publications have then gone and relied on macro news and traditional markets and tried to tie that across to Bitcoin and crypto. The fundamentals underpinning that are incredibly dubious. It's not actually a harmless stretch, because what it does is create this misperception that Bitcoin is a, quote, risk-on asset. Bitcoin's obviously a risky asset, but risk-on is an entirely different thing. Bitcoin has very distinct kind of risk and return drivers from traditional equity. It's probably inverted on a lot of dimensions. You talk about, debt and deficit accumulation, inflation, geopolitical instability, et cetera. Those are all bad things for most, traditional asset classes. They're potentially catalysts for Bitcoin adoption. But what it's done is it's really confused wealth advisors and institutions, because they say, well, I kind of get the digital gold thesis and everything. It feels like it should be a hedge in various events, but then I see like the correlation spikes, and the day that equities went down and Bitcoin went down even more, what's going on with that? And they sort of retreat and they pause. And so there's been a major muddling of the narrative that's been kind of an own goal.
Well, just to debate it a little bit, I mean, I think that the reason that we observe that price performance is that Bitcoin is this quirky thing where it's essentially like a digital gold, but it has $1.5 trillion of fintech stuff glued to it, right? So it behaves as if like you took the gold ETF and a bunch of IPOs or something and put them together. That's what Bitcoin trades like from a market standpoint. So I don't know if it's so much the narrative, it just is what it is. It is both a hard money asset and a piece of frontier technology, and it trades like that in markets for me.
Well, I think that there's no question that there's an element of this which is self-fulfilling, right? I don't think that, various media and research outlets can just retreat behind, well, look at the data, it's correlated, without acknowledging that there's a sort of self-fulfilling effect, right? If enough people repeat that narrative, then it starts to show up in the trading behavior, which strengthens the data, which strengthens the narrative, which reinforces the trading behavior, right? So I think that, we've seen some very kind of irrational moves in the market. You look at August 5th, for example, Bitcoin basically had a flash crash because, the yen was unduly strengthening. Like, what the heck does that have to do with the fundamental value Bitcoin. You saw that with some of the geopolitical flare-ups, Iran, Israel in the spring. Bitcoin sold off. That makes no sense, right? So I think it's important from our perspective to be out there educating clients so that they're not caught up in panic selling into some equity market sell-off that has nothing to do with the price of Bitcoin, and then left in a place of regret for not having taken more of a long-term fundamental approach.
Well, it seems like the activity is there. One thing that I was looking at this morning, through September, there's 220 million active wallet addresses, which is ostensibly 3x what the end of 2023 was. So you see the adoption, you see people opening wallets, and at least this defines active as trading at least once a month. So that is someone who's participating in these digital markets. How are you looking, or how are you advising your clients around portfolio construction and allocation, especially with your institutional clients? What are you talking to them about, or how are you giving them clarity on what sort of proportion of their overall asset pool they should be looking at putting forward into this asset class? And is that growing over time? Are you suggesting, we're at 2% now, but we forecast that should be a 6% allocation 3 years from now, as an example?
I think part of it is one, meeting them where they are on the risk spectrum, and every client is different. We've traditionally heard recommending 50 basis points to 100 basis points. But I think if you look at where Bitcoin is, and you look at kind of the progression of this asset class, those expectations have probably increased. Certainly, as Bitcoin has become more of a diversifier in a portfolio, it's become an inflation hedge for a wide variety of clients that exist out there. I think we've seen some of the more risk-on clients maybe look at Bitcoin as a 5 to 10% allocation of their portfolio. Some of the clients that are just starting off are probably well below that, still hovering around the 50 to 100 basis points. But I think in general now, people are adopting the idea that if you aren't long, you're short. I know that's a cliche that we've probably all talked about, but the train has left the station. Right, we're living now in a world where Bitcoin is becoming part of every portfolio. There's a excellent case for why you should be holding it. It's a finite asset, right? I don't think we've brought that up yet, right? There's only ever going to be 21 million Bitcoin. So if you are ignoring the fact that Bitcoin is being adopted, at some point you're going to feel short, and your portfolio performance is going to reflect that.
Maybe one little tidbit that we tell clients a lot. So just when people are trying to understand the risk or how to fit this in the portfolio, I think it's helpful to remind people that Bitcoin is $1.6 trillion and has a volatility about 50% annualized. And so from a units of risk standpoint, it actually looks very similar to the mega cap tech stocks from a market cap and a vol standpoint. So if you're thinking about how much risk you're putting in a portfolio, think about a unit of Tesla, a unit of Nvidia, a unit of Bitcoin is very similar from an aggregate portfolio risk standpoint. And that helps people to sort of, I think, come to grips with the idea that a couple of percent of Bitcoin is not all that big of a deal.
All right, I want to do price predictions, but your compliance guys would come up and kill me if I asked. But from an adoption standpoint, where are you looking? Like, say that the strategic reserve is in fact the first 100-day bill that's adopted. Do you think that hyper accelerates activity? Obviously, we all feel like regulatory clarity, the FIT 21 or other acts could potentially be an unbelievable catalyst as well. If you were looking into your crystal ball, where do you see this industry in the next 3 to 5 years? Are we still talking about education, or do you feel like it's just a cornerstone asset of a shrewd and prudent portfolio mix?
I'd come back to the point of the technology, the evolution of the technology itself. I think education will always be big here. I mean, there's going to be a certain subset of the people that just aren't going to understand these technologies. So I think that's always going to play a part here. Again, I think if you want diversification across other assets, I think there are products that will be out there that will be more widely known, widely accepted, and I think that's that's part of our job as index providers, ETF, ETP providers, etc. But I think I think going into the second half of 2025, I can clearly see more inflows into other products outside of Bitcoin. I'm really strong on that point.
I mean, this is probably a good question for Thanksgiving table, look, we have the first pro-Bitcoin presidential administration. We have the first pro-Bitcoin Congress, the first pro-Bitcoin Senate, and also, pro-digital assets broadly. And I think we're going to see regulators in the seats that reflect that. So, I would say we're going higher. And I think it feels that way just from an adoption standpoint. It's going to feel that way from an education standpoint, and I think it's going to reflect that from a price standpoint.
So I'll break it into three buckets: stablecoins, Bitcoin, and then other crypto assets. So stablecoins, I think we have very high conviction that adoption and usage is going to grow significantly. It's such a profound game-changing technology for how value moves around the world. So I think we're very optimistic on that, and to see it expand actually beyond just crypto trading and DeFi ecosystem into some TradFi use cases. Bitcoin, I think the key thing is going to be, is there one or two moments where you have a major disruptive event now that everybody's paying attention and everybody has access through these ETFs, in addition to obviously all the direct channels that already existed, where it's a disruptive event for traditional markets and Bitcoin outperforms? Whether that's U.S. fiscal concerns or some sort of geopolitically destabilizing event or another surge in inflation, then it shifts the conversation from, is this too risky for me or us to own, to, is it risky not to own any? That's a game changer, right, if that happens. And then the rest of crypto, it's an exciting moment. I think regulatory clarity means even more to the rest of crypto than to Bitcoin. But now it'll be time to put up, right? Because the industry's been talking for a long time. We need regulatory clarity. We need regulatory clarity. Now it's going to have it. So now it's time to actually show the use cases and adoption that have long been theorized. And so we'll see how that plays out.
Well, I will just opine. I've been around the space for quite some time. I was speaking at the Bitcoin conference this year in Nashville. It is the first year that I can remember a litany of elected officials being there instead of just like one brave soldier. So I think the best is still yet to come. I appreciate everyone's time. Let's give these panelists a warm round of applause for their time.
Team, really appreciate the discussion. Fantastic education, y'all. All right, we have two more pieces of content in this area. Do not leave. We have an amazing discussion led by Chris Broderson, the managing director of Eisner Amper, Catalysts for Hire, M&A, VC, regulation, and more. Ladies and gentlemen, please put your hands together for Chris Broderson and the next panel.
All right. Well, thanks, everybody. So buckle your seatbelts because I think we're going to get, what did you call it, Elliot? Hot takes out of today's session?
Let's do it.
Yeah, let's do it. So as mentioned, Chris Broderson, Eisner Amper. For those of you that don't know Eisner, we're a professional services company across tax, accounting, audit, compliance, et cetera, et cetera. And with that, I'd like my panelists to introduce themselves.
Sure, great. Thanks. So Corey Davis, I run FinTech investment banking for BMO. We're one of the top 10 largest financial service firms in North America. I'm actually based in San Francisco, but I've only been out there for about 6 years, so I'm technically a New Yorker.
Hi all, Prashant Kher from Ernst & Young. I lead our digital asset strategy transaction solutions. EY covers digital assets across tax, audit, operations, risk, and compliance, and the vertical I lead is supporting a lot of TradFi firms on their go-to-market strategy, incorporating this technology, as well as supporting part of the deal lifecycle as well across transactions. Nice to meet you all.
Olivier Dang. I run the venture vertical of Laser Digital. We are a fully owned subsidiary of Nomura, the Japanese bank, active in trading, asset management, VC across crypto spot, crypto derivative, and present in both DeFi and centralized exchange.
Elliot Chun, partner at Architect Partners. I did get really excited that Bitcoin hit all-time highs and busted my ankle from that. Architect Partners, we are one of the only crypto and blockchain dedicated M&A and strategic financing advisory teams globally. So all we do is M&A and capital raising.
All right. So I know that regulation is mentioned in the title. Way too much to unpack. Obviously, we're going to see a shift in the regulatory landscape, and we could unpack that all day in terms of how much and how soon, et cetera. But let's just say that we are going to see a change. Net, it should be more positive for the industry. What kind of impact is that having on your client conversations?
Yeah, I'm happy to start here. So, look, I would say starting this year after the Bitcoin and ETH ETP approvals that started to, compared to the past year, start to warm up some of our traditional financial firms' appetite and interest in the digital asset space, whether it was launching a fund or looking at things like custody or providing access to these funds. And since the election, I would say there's been definitely a big increase with speaking with some of our TradFi clients, as well as what's come out in the news with some of the big banks starting to eye things like custody, exploring potentially how might market access change. Given the past few years, that's been more focused on some of the crypto natives. And so there's been a bit more of excitement around what might this new administration, what might regulation bring around what types of services TradFi can provide to their clients.
Corey, anything from you?
Well, first of all, how many people in the audience considered or identify as TradFi? So we've got a few. So we got a lot of, I guess, crypto enthusiasts. So I come from a different perspective with regard to my clients, right? So when you think about my clients, they're really more of the payments, bank tech, insurtech companies. And so, there's been a lot of talk more around stable coins. In fact, PayPal today announced that they had a new partnership on the Zoom side. So people sending remittances back and forth could use a stable coin rather than having to wait for dollars to settle. So really that's where we're starting to see more activity. And it's really about the on-off ramps. I mean, if you think about it, right? So you can't send money from your PayPal account to your friend's Venmo account, even though it's both owned by PayPal, right? And so those are some of the topics that are being considered and why stablecoins are becoming more a topic. And I recall back at Stripe sessions, they mentioned that they were going to start accepting crypto again, and that was big news. And I think it was lost in translation because we weren't even close to the election.
Olivier?
A couple of things will happen, I think. One is TradFi, they have no choice. No, they have to come into crypto. That's not optional anymore. And at the board level of every single bank and asset manager, the discussion is happening. Two is that the crypto native who have done business outside of the US in smaller jurisdiction to do kind of regulatory arbitrage are now going to come back to the US. I think it's going to drive a lot of M&A or at least organic build. Certainly the price discovery, the regulatory agenda is going to be set in this country and not in Switzerland or Dubai or Hong Kong and Singapore. And it's going to happen much faster than we think. None of the TradFi, none of the native are going to wait for regulation to be crystallized. The decisions are being made now. And I think it's going to come even before regulation is clarified by the SEC or whatever is the agency setting this nowadays. So it's going to move very fast.
Yeah, I mean, Olivier, exactly to your point, it removes the excuse for any TradFi organization to not participate in crypto and digital assets. Removes it. It's gone. Today, when we talk to acquirers, it is, I don't want to put my career risk on the line to participate in this asset class, participate in this technology. We all know what the answer is going to be. Everyone, it's out of the bag. We're not going back. We're only going forward. And so acquirers, they do not have an excuse anymore. When regulation comes, It's going to be, we're going to see who's going to move and who's going to move fast. On the company side, those companies, generally speaking, that have embraced regulation will make it much easier for those traditional companies to acquire them. And so the pain and suffering that they have had to endure, particularly when you're meeting compliance and regulatory requirements, which is very, very difficult for startup organizations, I expect those companies to be rewarded as they bring regulatory infrastructure and clarity to traditional companies that are going to be the acquirers down the line.
So I want to expand on that a little bit. Corey, you mentioned something in our prep call that what you're seeing is everybody's racing to be second.
Well, I think that's right. So when you think about TradFi, right, they tend to be more conservative. And so there's a saying that, financial institutions are in a race to be first, to be second, which means they want to be fast followers. They don't want to be the first one to jump in and get into trouble. It's easy for, a startup fintech to, run in and break things and then, ask for forgiveness. That doesn't work for firms that have been around like mine for 200 plus years, right? Like, no, you're going to get fined and it's just going to be a very bad mark. And so, there's that, hey, let's wait until somebody else figures it out and then we'll quickly go in.
So let's just talk about the acquisition landscape. Is there much worth buying out there? I know we've talked about the fact that there's a lot of these companies that are just, what did you call them? Zombie companies? Phantom companies?
There are definitely a lot of zombies out there. I think, and Elliot can speak to it because he lives in it every day. The companies that we look at are typically trying to find technology to be an on-off ramp. And so similar to a lot of the fintech startups that we see is that you've got companies that raise money in 2021 in what I call champagne valuations that aren't going to grow into those valuations. Maybe they have good tech, maybe they don't, but they haven't scaled, right? And so what we saw last year was all of the investors were saying, hey, look, we're not giving any more money, so we want you to scale back your growth so that you can get some line of sight into profitability. And so where does that leave us today? This with a bunch of companies that are not growing and are not profitable. So who wants to buy that, right? And so you're going to see acqui-hires. You're going to see companies that are zombies that have just enough money to keep going down the line, and hopefully they hit escape velocity with regard to revenues, and then that will maybe attract additional investors or companies to come in with the M&A.
Well, I mean, just along that, I think our industry is young. Our industry being crypto is young. Capital didn't really start flowing in from an institutional perspective until 2016. There are only 4 outcomes when any founder or executive team takes investor capital. 1 is you go to 0 and your company doesn't work. 2, what Corey mentions, you're a zombie company, i.e. your valuations are too high and your business does not defend that valuation any further. 3, you go IPO, and our industry only has a handful, call it less than 10, that have the profile of a successful IPO in 2024. And the 4th is a majority transaction, i.e. a merger or an acquisition. So when people step back and say, what am I building for? You need to be building for ideally outcome number 3 and outcome number 4. And if you're not thinking about that, then you have a lot higher risk of outcomes number 1 and 2. Then we add on the whole token component that makes it so much harder for a IPO or a majority transaction. We're really convoluting the process and making it much harder for acquirers to acquire companies that are building in our space. And that's one of the hardest things that we have to deal with as we end 2024 and go into 2025.
I mean, I agree with all of that. The only thing I would say is we're big fans of token-based kind of fundraise because it provides you, as VC, a kind of at least a path for monetization. And if you go and do a classic equity kind of investment and a pre-seed, you need to wait for the seed, the Series A, Series B, and then this IPO or this acquisition, which can be taking 7, 8, 10 years. On a token raise, it can be SAFT or equity with token warrants. you tend to push much faster for a listing, the token generation event. No, you still have your token locked and the vesting is along a couple of years. But there's different ways then to hedge your position, to get a loan on the back of it. So as VCs, we're very big fan of those type of raise. And I think there's going to be M&A in protocols and tokens. We saw a few already, like 3 AI tokens have merged together, representing almost 4 billion of market cap. When you think of it, it's actually a sizable one. So it's Ocean, Fetch, and Singularity. And I think we're going to see more of that. There's so many kind of zombie token, but those companies are actually trading at a decent FDV. And you're going to see some of this M&A happening. No, I think the governance, all of that is actually quite complex on those kind of situation, but I'm sure it can be solved.
But just on, there has really only been one successful token M&A transaction, and that was the Polygon Hermes transaction. The one that you're alluding to was announced, but it hasn't been figured out yet. We've been involved in multiple token-related M&A, and it is hard. Mostly because there's an unfortunate, unintended outcome, which is you better walk into that discussion knowing that your token's going to trade from 0 to 75% discount at best. And many of the token holders will defend, well, our token is very special, our community is very special. When an M&A transaction or conversation comes, those two facts, they get moved to the side very quickly. So we're in I appreciate and agree with Olivier, our industry has had a very big problem with return of capital from an investment perspective. You look from 2016 to 2021, very, very little monetization outcomes, which has made it even harder to raise LP capital for your funds to allocate. So it's a very tough position that we're in. I just urge when companies raise in a token structure, trying to look a little bit down the line because your eventual outcome is going to have a significant hurdle if there's a token component.
To add one perspective on perhaps different types of M&A transactions, over the past few years, we haven't seen a lot of what we call bridge transactions. So these are traditional or TradFi firms acquiring a digital native. So we saw PayPal Curve, we're seeing Stripe Bridge, MasterCard Cypher Trace, a few examples like that. What we might start seeing now, as regulatory landscape opens up, as to Elliot's point, the excuse of doing something becomes, almost gone away. We might start to see some of these TradFi firms, instead of taking a build or a partnership approach, acquire some of these potential zombies at a discount, or do some acqui-hires or acquire some technology from some of these companies just to accelerate their move into things like custody, into things like fund administration, data and analytics. And hopefully we see a couple more of those over the next few years. And that might be an interesting strategy as well. When you look at some of the larger digital natives, I think even today there was an announcement where Coinbase made an acquisition. And you might start to see some more of the bigger digital natives acquire some of these smaller capabilities to build out and really drive their scale, drive the footprint across the globe.
And actually, I'd just like to unpack a point that Elliot made about return of capital. So if you go back to 2021, when we had champagne valuations, there were $19 billion put into, invested into the crypto sector, right? Since 2021, there have only been $6 billion of M&A, and 1.1 billion of that was, last week or 2 weeks ago when Stripe acquired Bridge. So there really hasn't been a lot of return of capital. And when you think about investors, right, they have a 3 to 5 year time horizon. So we're getting at that time where you either need to raise more capital or you need to sell. And so I think now is the time people need to look inwardly and think about, okay, do I have a good tech here? Is this something that I could sell to a TradFi or another crypto native company? Or am I at risk of going out of business, becoming an acqui-hire? And I think that's what we're seeing now, is that conversation is happening in boardrooms.
How are those conversations? Do you have them?
Well, because I work for the TradFi companies, we're not having those conversations. We're looking to buy them. And so I do believe that there still is a bid-ask spread, right? Sellers still think that their companies are worth more than buyers are willing to pay for it. It does help that valuations in fintech land have started to come back up. Unfortunately, we don't have a lot of crypto native companies that are trading publicly, so you can't say, oh, well, this guy's trading at I mean, Bridge was 90 times revenue, but that's not the value of crypto native firms, right? That there is a strategic value that Stripe saw, right? That they can plug and play into their vast universe of clients, right? And so if you have something like that and you can make the case, then yes, you can, argue for a higher valuation. But there's a lot of companies out there that may think they're a Bridge and they're not.
I mean, valuation gap is massive. It still is, and it's scary for a lot of companies. When they come in and say, "Hey, here was our last round," and they're looking at running a process, and you mentioned significant discounts, it's scary for everyone that's on that cap table. Corey, to your point, 75% of our conversations when we talk about crypto natives come from someone on the cap table to say, have a conversation with this company. Now, we are providing our objective view on the types of conversations that are happening and how a company should position, particularly now that we actually have some market momentum. I mean, the last 30 months were brutal. The Stripe Bridge transaction, we're on record saying it was the most important M&A transaction in the history of our industry for multiple reasons. Bridge transaction being one, valuation being another, Stripe being a defensive, offense by defense being the third. But if you are not, one of the most important things that founders and executive teams can be doing today is putting themselves in a position for optionality in an up market, right? What does that mean? We were just coming off 24 months of brutal performance. Anyone that's kind of survived here actually has some pretty strong operating capabilities. They've made it through. If you go into this next up market and you don't give yourself options, which means you're talking to strategic acquirers, you're talking to other strategic groups that are crypto natives, you're doing yourself a disservice because unfortunately, we all know our industry is up and down, and the downs may happen faster than you think. And valuations, if you think valuations are hard in 24, try having those conversations in 22 and 23 and early parts of 24. So you really got to give yourself optionality and start those conversations now.
Yeah, I agree. That's we have around 20 companies in our portfolio, and that's definitely what we're advising to do right now. It's like, go and raise money, extend your runway. Now is a good time to do it. Everybody's excited, or look at options. And on the flip side as well, we get approached a lot by various kind of startups. Given the backing we have from Nomura, we're seen as a strategic from time to time. And sometimes they approach us for fundraise, but definitely they also want to explore the option of a strategic partnership or a full acquisition. And certainly in those type of discussion, the valuation gap is very much present. They come with a view that the anchor point is the latest raise. For us, we take a very different approach to that, especially for an acquisition, like strategic synergies, actual cash flow, and then suddenly it's like, well, we have a sizable discount to what they think they can raise at or M&A at.
And by the way, no one is at the valuation of Coinbase. Everyone loves to point to Coinbase is trading at X. Sorry, guys, you're not Coinbase.
Yeah, I was going to ask. I mean, what sort of impact does a Coinbase or the Stripe acquisition have? So if I'm a founder of a smaller company and I'm saying, well, they went for these valuations, or this is how they're valued, and I deserve something similar. I mean, does that trend actually make matters worse?
We don't care. It's like we invest in, at most Series A. What's happening to Coinbase or Galaxy, at what multiple they trade is completely irrelevant to us. We look at similar size transaction. Valuation are creeping up, I would say, right now, definitely, since the election, and Bitcoin at 95 puts everybody in a better mood. But it's certainly, not comparable to what Coinbase is trading at. We don't care about this.
But I know you don't care, but the founders care.
Not really. Frankly, the guys on the early stage life cycle of a company, they also are relatively kind of focused on similar transaction in the same stage as opposed to look at Coinbase. I mean, it's completely incomparable when you think of it. So we tend to look at deals that other VCs have done in relatively similar industry at relatively similar stage of the industry. And this is, more art than science when you price a deal, I would say, especially at early stage, and you look at dilution, you look at governance, you look at, all of those things to try to price something. So Coinbase, not really. I think when, auditors are auditing the funds and look at the marks in our portfolio, they usually look at the traded comparables, but again, it's like the level of discount we have to apply is also art more than science, I would say.
Crypto valuation is very, very difficult, right? As an industry, we are applying a lot of different concepts, a lot of different services, a lot of different product types, and we're all trying to bucket into one easy to calculate number based upon either a SaaS model or a transaction model. Yes, that works for Web2 companies and all other kind of services-based companies. It does not work for crypto companies because of how different the revenue models are. That's one, very different business models. The second part is, and this is probably one of the biggest valuation calculations, is show me how your company is not tracking the beta performance of Bitcoin and crypto assets, and show me how you are actually generating operational alpha, i.e. revenues that aren't associated with the ups and downs of the price of Bitcoin. That has been one of the hardest things to defend, but for any company that's going out and trying to defend their valuation. But if you can do that, then you will be rewarded for doing that. But right now in 24, we have to answer the question, companies, founders, executive teams, they have to answer the question, why not just buy Bitcoin? And our industry is having a hard time with the numbers defending that statement. And it's not really fair to be able to do that because, back in equities, you cap yourself to S&P 500 for fixed income and futures and FX, you cap yourself to rates. Like it's something that's very specific to crypto only as we've gone through our evolution cycle. So valuation very difficult because the businesses are very difficult and how you engage and generate revenue is not standard. Plus we have this big behemoth called Bitcoin that we need to differentiate from.
So I fully recognize that the dynamics are vastly different from the internet boom to what we're seeing now. But do you guys think that we're going to see some sort of IPO style or internet style bust in this sector where these companies just give up and sell themselves for pennies on the dollar?
Well, we already did it. We already had our bust, right? Like that was what 2022 was.
We're going to see 5 more of these before it feels more comfortable for sure. It's going to remain very volatile, I suspect.
I do think we'll see a few IPOs over the next year or so. We know there were some that were planning pre-21, pre-22. Do expect to see a few more in the next couple of years, next year or two.
Okay. All right.
So we try to put numbers around this. We try to answer the question, how much value has crypto as an industry created? Question 1. Question 2, compare it to another emerging technology. We did the internet. So we compared the internet starting in 94, took the NASDAQ 100, went all the way back. We did crypto starting in 2016, and we tracked them together. They're very, very, very close. There's 2 key points. The first is in Q2 of 2024 was the first time that crypto as an industry surpassed the internet from a value creation perspective in their respective growths. That's a really, really remarkable metric and one that our industry should be proud of. Second part is what's at stake. Well, and this is the 2002 equivalent, from 2002 to 2018, 18 trillion in value was created by internet companies. We think that the same is going to happen for crypto companies, but it's going to happen much faster. And so the numbers are already showing us, and we're about to update for year end, like with this move higher, we're going to be much, much, much stronger in terms of the value created of our industry. So I think we're past the internet bust. I think we're well past it. And I think we're already into the recovery mode, which there's a lot at stake, tons at stake.
Yeah, just to add a few more data points on this, if you look at different reports, the wallet or the fee pool from traditional financial services globally is around $7 trillion. That's including, wholesale bank, payment, market structure, and so on. And if you believe tokenization, blockchain, crypto in general will represent, according to various reports, 15 to 20% of the GDP, you apply that to this 7 trillion. and that could give you a revenue wallet addressable by all of those startup companies operating in crypto of close to $1 trillion. And that's what we play for when we invest in those companies. And that's a sizable number. You achieve that through reducing cost and friction, creating new business model, bringing new people into this asset class for different purposes, whether it is payment with stablecoin or various other things. So it's actually a sizable market to invest in, and we tend to be maybe focusing too much on the market cap of Bitcoin and associated coin, but $1 trillion of revenue available for the startups and the players that are moving and grabbing market share is a sizable number when you're a VC.
All right, well, we have less than a minute left. Does anybody have any parting thoughts they want to give to the crowd?
Well, we were talking about TradFi, so I would say for TradFi, it's really about the picks and shovels. They're not worried about the tokens. It's really about on-ramps, off-ramps. How do I know my customer? How do I make sure that compliance is done well? And so if you're a crypto company today, if you've got those two things done, there's the opportunity for you to get the big valuations by selling to a big strategic TradFi that wants to get into this business.
No, I was going to say the same. So from working with some TradFi and private equity side, there's been a thesis for a while around picks and shovel infrastructure, data and analytics, and providing, supporting the holistic investor experience, the holistic institutional investor experience. So I think areas that really support the institutional investor, more on-chain capital coming in from institutional investors, I think that'll come be positive over the next year or so.
We launched Laser Digital about two years ago, just after kind of FTX blow up. It's been lonely as a subsidiary of a TradFi operating there. So very excited to see many of our peers coming into the space now. Looking forward to do business with them.
I think there will be a global systemically important bank. A GSIB is going to make an acquisition of a major crypto native company by mid-2025, and that's going to light the fire for all the fast followers that Corey is talking to. We're about to come into a very active market environment. Let's go.
All right, gentlemen. Thank you very much.
Thank you very much. Really appreciate the conversation. Ladies and gentlemen, we have one more panel for you on this stage. Incredibly excited for a great lineup of speakers to wrap up a great day of content. If you have not, please stop by the Benzinga booth, talk about our APIs. Beyond that, if you have any questions, you want to see some content, you can visit our event website, benzinga.com/events, to go ahead and see all the content. Make sure you keep an eye on our editorial page, benzinga.com, for all of our editorial team's thoughts and comments on what has happened and been discussed here at this event today on both stages, if you missed that content as well. With that being said, we have one more panel. Again, please welcome to the stage Yuxi Yang, crypto reporter, with the information and the next panel up. Give them a warm round of applause.
Hello. Thanks everyone for staying till the very end. I'm very excited to introduce some of the most influential crypto OGs in the industry to you in our very last panel. My name is Yue Qi, and I'm a crypto reporter with the information. I'm going to start by having everyone to introduce yourself and your organization.
Raoul Pal, I'm the CEO and co-founder of Real Vision, and also the CEO and co-founder of Exponential Age Asset Management.
Dan Tapiero, founder of 10T Holdings and 1RT, as well as Zenrock Labs.
Hi, I'm Perry M. Boring, the founder and CEO of the Digital Chamber. We are the advocates for the industry in Washington, D.C.
Good afternoon. Pleasure to be here. Maya Wianovich, founder of O Group. I've been 12 years in crypto. We are a fund of funds and an advisory firm.
Hi, Dan Moorhead, Pantera Capital. We invest in blockchain from tokens to venture.
Great. So we have quite a few topics to cover today. We're about 2 weeks from the election result. And I was looking at Bitcoin price this morning. It went above 93,000. And it really looks like the crypto industry is heading into this new big moment again. So I wanted to ask each of you, what is the number one thing that you're working on to make sure that you're positioned to take advantage of the upcoming cycle?
From my side, two sides. One is via the Real Vision platform, educating people and giving them the opportunity to participate in this. So this is an industry that's $3 trillion today. I think it goes to $100 trillion by 2034. So it's a very big, it's in fact the largest wealth generating opportunity of all time. So we educate millions of people on that side. On the asset management side, we have a crypto fund of hedge funds to allow institutions, family offices, high net worth investors access to this trend, which is this 3 trillion to 100 trillion. So simple as that, access to everybody.
You know, I think all that's really happened is, I mean, everything has become accelerated. So the investments that we've been making in the space and the growth names, so larger companies, generally making over, let's say, 50 million in revenue. I mean, nothing has really changed in terms of what we're doing to take advantage. You know, I think what is surprising is the speed at which things have changed and also the degree. You know, you now have the, you know, most important, most powerful government, richest, you have the richest person, you have the entire cabinet, you have a president who is, they're all massively pro-crypto. Just a few weeks ago, the US government was attacking, and, you know, companies like Coinbase and Kraken and Ripple. So we went from being under attack to the most positive, most supportive government in the world. So I think that is certainly not priced into markets. And I don't want to say that you can do just about anything, but I think if you own just about anything in the space over the next, let's say, few years, you're going to do just fine. But I think it's Perianne who really should be commenting on this one. She's the real pro.
This is our moment.
Yeah.
We've been waiting 10 years for this moment. This is a once in a lifetime opportunity to make the United States the crypto capital of the world and not only ensure that we are welcoming to this technology here in the United States, but we're also preserving our world reserve currency status and our prosperity for the next generation of Americans. So this is, it's an honor to get to be a part of this conversation, to get to be a part of building the regulatory framework for crypto, but it's taken a long time to get the political alignment. We've done that. It's time to get to work.
I think it's a loaded question what we're doing on that. One thing that comes to mind is stablecoins for me has always been from the beginning, maybe because I worked in emerging markets early on in Africa and Latin America where we see the biggest need in that. I mean, for us here, right, stablecoins are mostly used by traders. It's a great tool. It's actually, to your point, you know, stablecoins become an amazing way for keeping the dollar around the world. And slipping it in. But I think on the other front, when I look at opportunities, I think Dan is absolutely correct. I mean, this is once in a lifetime opportunity. It has been, people think they missed the boat. But I think when I look at opportunities, I look at number of things that are going on in some of the L1s, a number of things that are going on in service providers, number of things that are happening with AI and decentralized infrastructure, and then obviously stablecoins, which is institutional and kind of retail. So those are some of the things that we are looking at.
I agree with Dan Tapiero. This is a massive tectonic shift, and I don't think it's priced in. The election really just changed everything. As Perianne said, we've been fighting a really aggressive regulatory stance in the US for a decade. And it not only changed in the White House, in the House and the Senate, it's somehow the US politicized Bitcoin and blockchain, which is really weird. It became partisan. One party was into it, one party was against it. I never really understood why anybody would be anti-crypto in Congress. But in this past election, there were 58 races that the crypto PACs got behind. They won 54 of them. And so I don't think you're going to get a peep of anti-crypto talk out of Congress again.
I want to start by asking about what should we expect next in regulations and coming out of DC. So how have conversations in DC changed since the election? And what is the timeline that we should be looking at for something to be passed in terms of crypto legislation?
All right, everybody's looking at me. Well, I was I was just in DC last week, meeting with congressional leadership on post-election, kind of what's the plan, what's the strategy. So I would say a couple really big takeaways. One, we have elected our first pro-Bitcoin and pro-crypto president of the United States. That's massive to have that kind of support at the very, very top of our leadership chain. But it's not just in the White House. We also have a pro-crypto Congress. We have over 250 members of Congress that will be sworn in January that ran on pro-crypto platforms. So we are the majority, and this is a bipartisan group of supports. So this is, an incredible opportunity. I would say one thing that's changed since the election is Republicans won everything. There's the red wave. They have the White House, they have Senate and House majority. There were a lot of talks of some legislation, like a crypto package getting done this year, or potential stablecoin legislation has been a very big priority to try to get something done in this congressional session to get that regulatory clarity the industry needs into law. The bill that had the kind of most likelihood of success is the stablecoin legislation. I met with leadership on both House and Senate last week, and it's not dead. It's not that it's impossible. It's just very unlikely anything's going to happen. And the reason why is because Republicans swept both the House and the Senate. So I think, if I was advising Republican leadership, they're going to be in a better negotiating position next year where they have the majority in both chambers versus today they don't. So I think the likelihood of wanting to negotiate is probably just going to push things into next year. So that means we're looking at 2025, 2026, the 119th Congress for actually getting legislation through the legislative process. This likely will not happen at the beginning of the year. Just in my talks with members of Congress, members of the Senate, there are other priorities that are going to take precedent over crypto. I know, shocker, we think crypto is number one. I think it's number one, but there are other issues our country faces. Some of those bigger legislative packages include the Farm Bill. There'll be a continuing resolution or some kind of spending bill, as well as a tax and a finance reform package. And those are likely all going to happen first before Congress is willing to entertain crypto legislation or digital asset legislation. So we're probably won't really have movement until the end of, or maybe like halfway through 2025, 2026 timeline. But we can still get something done in the first 100 days. And this is something I've really been talking about a lot, which is if we have the right people in the key agencies that have oversight over the digital asset markets, people who can take leadership and know how to get things done, the agencies themselves have the statutory authority to create a lot of relief for our industry. The biggest issue that so many crypto companies face, which I know you guys as investors have seen and experienced this, is that lack of regulatory clarity coupled with very aggressive regulation by enforcement. So the agencies themselves can reverse this regulation by enforcement agenda, just stop doing it. And two, they can issue regulations to create a degree of clarity of which digital assets are regulated by the Securities and Exchange Commission, create the registration regime for that, and clarify which digital asset commodities are in the CFTC's jurisdiction. And that is something we could do within the first 100 days that would create tremendous economic opportunity here for the crypto markets in the United States.
Anyone else want to?
Just gonna say that's huge. I mean, is there anything else left to say?
I think the bar is kind of low, though, to be totally honest.
Yeah, that's all right, though. That's okay.
I want to ask about banking access for the crypto industry. It's long been a problem for crypto startups to really get most basic banking services, to open a bank account, to be able to accept deposits from their users. So do you see, or does anyone see possibility for that to change and for crypto companies to have greater access to banks?
Everybody's looking at each other.
Yeah, I mean, I think it's all changed now.
Yeah,
so
everything's
it's
up for
very,
grabs.
I don't want to say it's straightforward, but it sort of is.
Yeah.
So
all of the roadblocks of the past have disappeared.
yeah, I mean, even just look at from 2 or 3 years ago. I mean, we have this one page in one of our decks that shows all of the traditional, financial entities, how many of them offered or used to offer custody to crypto, or even offered the ability to trade. And yeah, 3-4 years ago, you'd have 3 or 4 names on that page, and now there are 30 names and many different things that they offer. So I think it all just goes into hyperdrive. The question that's, I think, maybe, I don't say more interesting, but is, given where the US is headed, are they going to completely crush Europe and Asia and the rest of the world? Because those governments are not moving and they live in slow motion. And this government is moving very quickly, is very energized. I mean, Brian Armstrong just met with Trump, or is meeting with Trump. I mean, can you even make up that kind of scenario? I mean, who is meeting with the heads in Brussels? Like nobody. So maybe this is where we really just blow away everybody. Yeah.
I want to move on to talk about institutional participation. For the investors on this panel, do you see LP showing more interest in crypto, especially from the non-crypto crowd of investors?
I'll start with one observation. I think a lot of us can answer bits of this because we all see different component parts. The high net worth family office space were here first. That's fine. The institutional layer has been slower, a lot slower, because of regulation. And that's all gone away. The lack of clarity of what they're doing is now going to change. And, if we're right and we get something like a strategic Bitcoin reserve, I mean, there's no better signal for every single institution. So I think we'll see, Dan is the longest of raising money from these kinds of people. We will see a lot more of the people that he'll have spoken to for 10 years, trying to get them into the space, finally going, yeah, we can do this. So I think mandates change probably later on this year. What do you think?
Yeah, I would say that Raul's spot on, that there was going to be a big swell of this about 2-3 years ago, and then FTX happened and BlockFi and Celsius and all that. And then the regulatory onslaught where the current administration is suing Brian Armstrong, right? And so it really put a chill in the institutional investor space. I do think this just kind of unlocks all of that. And the reason I'm so bullish on blockchain is the trendiest endowments have maybe 2% of their assets in blockchain. In the median...
Wait, you said total endowments 2%?
No, the trendiest, the most aggressive endowments.
The trendiest. Yes,
the most aggressive endowments have maybe 2% in blockchain. The median institutional investor, 0. And getting off 0 is going to be huge. And that's why, like, over the next 2 or 3 years, I think there will be this massive flood of institutions coming into our space. And at 3 trillion, it's still pretty tiny compared to the 500 trillion they're currently managing. So if they go, ultimately, I think they're going to something like 8% of their assets in blockchain, something like that. It's going to squirt up like a watermelon seed.
Dan,
I think sorry, I was just going to say, I think it's really normal though, right? I mean, it's normal. You've seen it even from the early days of .com or anything else that came on the market. I mean, I went in front of Emory, which is my alma mater, in 2016, and I said, hey, you guys should be investing in Bitcoin, right? I mean, they literally didn't even know where to start. They didn't know what it was. I had to send all the research paper on it, right? And they just announced they invested in Bitcoin, right? So it's kind of normal for people that learn. I think we take it for granted because we came from certain areas, or we've seen it early, we invested in it, we know how it behaves, we hang out with these coders and developers, and we see the path forward. But I think it's really normal for somebody who has a 9-to-5, has other obligations, to kind of take time to invest in this, right? When there is no regulatory clarity. So I it's going to take a while for some of them still, because there's no regulatory clarity. But I do think that what we're going to start to see next year is a bit of a polarizing investment. What I mean by that is things that are kind of off the regulatory eyeballs, you're going to see huge acceleration of those investments. And in other markets like UAE and Singapore and the rest. And then here in the US, you're going to start to see more institutions waiting for just that moment when legislation is passed. To Pierre's comments, when you pass that legislation, they're going to start coming in and acquiring companies, right? They're not even going to wait because they see a huge opportunity and because the retail is asking for it, right? Retail is knocking on a door, and most of the bankers I speak to say their clients are asking for crypto, but they can't do anything about it. So then they go to funds and they invest around them. So yeah.
Oh, do you have anything to add?
No, it just reminds me back in the old days when we were all working together in different guises, when Goldman introduced the commodity indices, there was zero weighting in every single institutional fund. It took a few years, and then it went to, I don't know, $250 billion in 4 years, and the markets were much smaller then. It feels the same kind of floodgates are about to open.
We know one thing that LP investors do care about is exit opportunities and liquidity events for portfolio companies in crypto. And recently, Stripe made a big acquisition of Bridge, and that really kind of put the crypto acquisition topic back on the map. And we know Circle has filed for IPO. We're waiting to see when that will happen. So for the panelists, I want to ask, do you expect the floodgate of M&A and IPO to open for crypto companies? And what kind of companies do you think will be the first to go public or get acquired?
Well, I mean, you mentioned Circle. We have a position in Circle. I think, Dan, you do too. But I think any of these businesses, just about, I would say, that have been around for 5 to 10 years and that are making, 100 million in revenue or more, have been thinking about, when to go public. And I think that, we have at least 6 or 7 companies in our portfolio that have been are beginning to ready the ground and have been. They're just waiting for things to change a little bit. But I think that there's actually very strong demand amongst equity investors. Right now, you only have really Coinbase and MicroStrategy, and then to a lesser degree, you have Galaxy, and then you have the Bitcoin miners. So if you're an equity-only investor, you have no really place to invest. It's assuming, of course, you're not doing the cryptocurrency, you're not doing the ETF. You really want to own businesses in the digital asset ecosystem. So right now there are only 3. In MicroStrategy, you could argue whether that's actually an operating business. So I think over the next 18 months, you'll see quite a few, and you'll start seeing more M&A, some of the mid-tier companies coming together to make a big company. Yeah.
Anyone else want to chime in?
I mean, we see it a lot. We spoke about that earlier. I think what you see it now. I mean, you could just put M&A in blockchain and crypto. You'll have a list of companies. I mean, Dune recently acquired a company for A16Z. They don't have to make $100 million. I mean, that's for IPOs and the rest. You can acquire small platforms. You can acquire teams. You can consolidate. I think that's what's going to happen because not all of these L1s are going to survive. Not all the service providers are going to survive. I mean, I think people on this panel know that as well. I mean, you see these companies and, when Franklin Templeton's come in, they're not going to build this internally. Some of it, they're going to look to acquire these teams. It might not be a huge revenue producing company, but it might be a team or a tech or a service that they provide. And they'll just want to have that in their stack because it makes sense, right? DeFi makes sense. I mean, all of this makes sense. So I do think, I'm not sure about IPOs. I'm not as confident maybe on the IPOs next year, but maybe 26 probably. Yeah.
Well, and also, why would you go through the process of an IPO when you can do a token offering?
Yeah, absolutely. Yeah,
in 4 hours for $20.
Yeah, and that's why I just think this whole thing with tokens and meme coins and everything has turned its VCs and traditional finance a little bit upside right down. And so, but I still think that there are companies out there who will be absolutely scooping up the tech. Yeah,
and that's kind of the point of blockchain technology is to reimagine the capital markets, reimagine
Yeah.
the financial system. So it's not just about mergers and acquisitions and initial public offerings and kind of your traditional activity. You're going to see complete evolution of how these markets exist. Why can't we trade shares of XYZ stock 24 hours a day on our cell phones?
Yeah, a lot of
That's
equity
coming.
will get tokenized. I mean, I think that's what you're saying.
That's the promise.
Yeah, I think that's right. We'll move in that direction.
This has got to be the only $3 trillion industry with only 3 public stocks, right? I mean, it's crazy. Massive industry with only 3 companies. And so an enormous amount of money flows into just 3 suspects. I think it'd be great when Circle and others are public, because there's a huge demand and it'll be spread amongst a lot of great companies instead of just 3.
How much do we think that ICOs are going to come back? Because you mentioned this, can you just offer a token? Obviously, attaching a token to the economics of a company is a big deal. That's what we need to get to. I don't know.
I mean, it's been back. I mean, it's been on fire.
But isn't
Like
it
a
back
lot
with
of
tokens,
projects.
right?
Sorry?
Isn't it back with like tokens and meme coins? I mean, it's kind of
Yes, but meaning to be able to tie a token to the economics of a firm, right? It's difficult to do without doing buybacks and all these stupid ways of kind of scratching your ear by putting your armband around your head. It's like we just need a straightforward mechanism.
Well, we need a registration framework. A lot of this should be regulated in registered financial products.
Yeah.
So I don't think we're going to see ICOs come back that we saw in 2016, 2017. There was a pretty aggressive backlash from the SEC.
No, but a new variation of it.
But having a process where a company is issuing a security token, they're registered by the securities regulator, but they're doing it on a blockchain. They're not going through, your antiquated systems to do so. So companies should be able to get registered to do that. And that's what Congress is building.
I thought that's such a good point that under the new SEC share, there might be new ways of registration for crypto companies. Do you think that will need to come from legislation, or do you think the SEC as an agency can single-handedly push for a new?
There's definitely various opinions on this. My view is that the SEC has the statutory authority to develop a registration regime today. I mean, we've been asking them since 2016 to do so. When we saw the whole ICO boom develop, we went to the SEC and said, give the industry clarity, help them get registered. How do you register? What is the process? And they didn't do it. And that's why all eyes have turned to Congress. So Congress is doing it in the absence of the regulators doing it within their own authority. But I actually think the conversation really needs to get away from the Securities and Exchange Commission. The SEC has kind of been the leading voice in digital asset policy for so many years. Most digital assets are commodities. They're under the CFTC's jurisdiction. I think that's one of the hopes of having Donald Trump come in and appoint pro-crypto people. Let's get a leader in there who will lead, not let the SEC lead by this very aggressive approach to expand their mandate and their power to include everything. Digital assets are commodities. The CFTC should be that leading voice. And they really should be the lead regulatory voice for crypto markets globally.
Well, why not a separate regulator? Why not a digital asset regulator? It feels shoehorning it into commodities. It's not a commodity.
You want to expand the government even more?
Well,
I think that's the big thing.
Yeah, but to shoehorn it into as a commodity or a security, it's neither. We're just shoehorning it in for somebody to look after it. Really what we need is somebody to look after digital assets as a new asset class. And in the end, you can fold in the other stuff underneath it.
Well, on that point, there's a really weird black hole in regulation in the US. There's no regulator that can regulate a spot commodities exchange. The CFTC can only do futures because that's the F and CFTC, and the S and SEC is securities. And so literally there isn't a regulation right now for anyone to regulate a spot.
But you don't have surveillance oversight. You have fraud and manipulation authority, but you don't have surveillance oversight. And that is the main piece of the market structure legislation in Congress, is giving the CFTC that spot market oversight. So that's likely coming.
That kind of reminds me of how Trump has said that he wanted to set up a crypto Presidential Advisory Council. And I wanted to ask the panelists here, have you been in touch with his team? Have you heard more about how exactly he will do it? What's the timeline that he will be able to achieve in terms of setting up this crypto council?
I'm British, I don't count.
He said he's going to do it in the first 100 days.
You said, did he say?
He's going to do it in the first 100 days of his presidency.
Which means then that goes kind of opposite of what you were saying, which is like that is his priority, right? It seems like that is his priority.
Well, Congress,
Yeah.
Congress has other priorities, but the administrative powers, there's a lot they can do in that first 100 days. But I wouldn't expect legislation passed in the first 100 days. That could change, but based on the meetings I had with leadership last week, there's a few other bills that they're going to prioritize first. But I don't know, maybe Trump will twist their arms and crypto will be number one. That'd be great.
I want to move on to talk about stable coins. For a long time, Tether, Circle have been the dominant players in this field, but increasingly, as regulations come along, we see new entrants, we see fintech companies, payments companies potentially wanting to become stablecoin issuers. So when you think about the future market structure of stablecoins, how do you think that will look like? And do you think it will still be dominated by one or two stablecoins?
Well, I think, I don't know, the way that I sort of see this developing is that the stablecoin market will eventually replace the traditional sort of analog world currency trading market. So 99.8% of all the stables are dollar backed, right? So it's 0.2% for the euro. I suspect that within the next sort of 5+ years, you'll have, yen stables, and you'll have, all the various currencies that exist out there will be stable coins as well. So I don't know, that's hundreds of trillions of dollars of currency.
It's also a nice way of creating a lot of demand for US government debt.
Yeah, absolutely. Can you expand on that, Raul? I think that's a great point because you know a lot about that.
Well, they all hold, and anybody who's regulated has to hold US treasuries. So what you've got right now in the US, the largest bar of short-term notes and everything else is the money market fund market. What you've actually brought in is an exponentially growing market which has demand for US treasuries. So not only do you dollarize the world further into the furthest corners of the world, the rice fields in the Philippines, Brazil, in the Amazon rainforest, that's where you're getting the dollar into. So the US becomes more powerful, but it then means those people, not the money market US crowd, but foreigners who are using stablecoins are actually buying the US debt and they don't realize it. It's a very big deal.
Yeah, and the reason why I asked Raul and expand on that, I actually think, and just because this event is recorded, I won't be able to express my full views because I do think the stablecoins are extremely political. It is a security issue. I think it's a national security pressure where we have to be doing it. But at the same time, again, there are forces out there who would not want what exactly Raul said, right? And so I think we are entering into an extremely interesting world where that is important to do. And that's part of the reason why I think it's being pushed and adopted by the government, because we understand that we are in trouble with our debt and we are in trouble of de-dollarization. And I do think for investors in the room, if you're interested in stablecoins, I really think there's no larger opportunity than looking at stablecoins in terms of investments, of issuance platforms, of peer-to-peer stuff, of exchanges, of all kinds of things out there to invest in that will literally make billions. And so I think that as an investor, I would put that hat on. Now, on the national security and geopolitics, that's a whole different conversation and a very important one, which I think that we won't have an easy time to push the US denominated stablecoins.
Oh, I'm happy to comment on that. Just last week, we put out a new policy report titled How Stablecoins Are Extending US Dollar Dominance. I do think this is a national security issue. In fact, I think stablecoins can be a tool to advance our national security goals. And Raul, you really identified one of the biggest challenges facing the United States is the looming debt issue. So what's important is how do we create more demand for US dollars? Well, we have some new data. There hasn't been really great field data on how stablecoins are being used outside of the United States. Visa and Castle Island Venture did an international survey of international stablecoin users on who are these people, where are they from, why are they using stablecoins, and trying to learn more about this demographic. The number 2 reason why people, non-Americans, people outside the United States are buying stablecoins is to save in US dollars. This is massive. If you really think about what this means, this is taking US dollars, putting them in the hands of communities that would otherwise not have access to the US dollar. So this is creating new demand, and then it's also creating new financial prosperity and financial inclusion opportunities we have not really seen before. Why don't people around the world have access to US dollars? Well, usually the most affluent can figure it out, but just normal everyday borrowers and savers and spenders don't have access to US dollar-based banking. By definition, they're out of the US banking system, and many people around the world are completely unbanked or underserved. This is how we reach those people. So it's not only a way to increase demand for US dollars, extend dollar dominance, it's also a way to extend economic prosperity to people around the world where we have never had the opportunity to do this before. It's huge.
The top 5 countries were, it was Brazil and Nigeria in that Castle Island study, right? Where were the
India,
others?
Indonesia, and Turkey.
Yeah, that was incredible.
Every continent. I was
going to say, I think a big change is coming to stablecoins, and I was thinking back to the early days of investing in Circle. The CEO, Jeremy Allaire, is a fantastic, wonderful person, but rates were 0. And I was like, poor bastard, like he's never going to make any money because rates were going to be 0 forever. And then SARS-2 came, and the policy responses to that, crazy amount of money printing. The Fed bought $9 trillion of bonds. All this insane stuff happened, which I think is unfortunately structural and permanent now. Like both candidates' budget deficits are astronomical. So with very high rates, the current stable coins that don't pay a yield are making incredible amounts of money. It seems inevitable yield-bearing stable coins are going to be big.
I do want to.
But the irony is, I think Europe banned the payment of interest on stable coins, right? Like in their legislation, they were like, I mean, that seems kind of like, medieval usury laws or whatever.
I think the reason being is because they want to issue a digital currency, digital euro, and one of the best ways to service your debt is have that and pay no interest.
I agree. Governments are going to be sending their
look
debt.
at the US interest payments. They're as big as the defense payments now. And imagine if you have a big stablecoin market or all currency market, you get rid of a big chunk of your interest payments. So yeah, there's a game there.
Yeah, the U.S. has funded its deficit for a long time, issuing little pieces of paper that say $100 on it, which is a 0 coupon note that they send to a lot of weird places. But now anyone with a smartphone can do that, and that's huge.
I love this discussion on the business model of stablecoins, and I think about it a lot as well. So who do you think will be able to make money in the future of stablecoin ecosystem, especially considering that there's this whole generation of yield-bearing stablecoins, and stablecoin issuers are kind of under pressure to share interest income with their partners?
The economics currently we think of as the interest payments. What these are gigantic monetary networks. Once you own a network and you have a vast number of users, as we're seeing with Tether, you can make huge amounts of use cases out of it. So the point being is what you build on top of a network once you've bootstrapped a network. So what you've created is a network that's very attractive across the world, which is using a stable coin. Right now, you're getting this premium from the interest payments. Maybe that lasts, maybe it doesn't. But once you have enough people using Tether, you can build asset management businesses, you can build anything you want on a monetary network of millions and millions of people. So yeah, the business model is only just started.
Anyone else want to chime in? How do you think about monetizing transactions volumes?
I think they're still led by primarily traders. That's very obvious. I think all the traders maybe in the room or finance guys, I mean, that's stablecoins today are primarily driven by traders and trader volume and used for that. Okay. Then they're used by retail and, in emerging markets. And then I would say, because that's where the biggest demand is. And then here. I don't think that here you're going to have such a great utility of stablecoins. Stablecoin here it could be used for other things such as that we just talked about, but I don't think for retail is a way to go. There's a whole host of other things that you could be using as a retail to make money.
I mean, I think the way Rome was looking at it is right. The value of that monetary network is huge. I mean, Tether on Tron, I think, is all just tiny retail payments. So that may not be so applicable in the US, but the value of a monetary network is huge.
Shall we delve into crypto and AI? The hottest buzzwords. What is real here? What is the example of intersection of crypto and AI?
You talked about this. I don't know anything about AI.
Again, crypto is the place where the earliest experimentation of everything happens. It's so dynamic and so fast. What we've talked about for a while is the rise of AI agents and how they will have to use crypto rails for payments. Essentially, agents which are coming, we're already starting to see the rise again in crypto, the AI agents. What is happening is an agent, if it's undertaking a task for you, think of an agent as somebody on Fiverr doing a job for you. You have to pay them. And how an agent works is you're going to have to pay them for compute and electricity. And you'll have streaming payments because these things can do lightning fast things. So crypto rails is the way it's happening. How it starts is always the funniest way is somebody releases an AI agent on Twitter and it bootstraps its own currency by bribing people to start it. It's now worth $1 billion. This has happened in a month. And it is now using incentivization to spread its meme, the Gospel of Goatsy, which is an old internet meme from 4chan or somewhere, and is now spreading this. But ignoring the ridiculousness, because crypto always goes to ridiculous first, what we're seeing is the rise of individual currencies or tokens driven by AI for the economic purposes of the AI. It's an extraordinary thing. So these things are just layers of the internet. If we think of the internet today, we've got this security truth layer, as Dan called it many years ago, which is the blockchain layer. And the AI layer is coming, which is the applications layer of the entire internet at scale. They can't exist without each other. Because in a world of everything is replicatable instantaneously in endless numbers, you're going to need to prove what's real and what's not. And this goes back to Dan's idea that he brought out back in 2019, this is the security truth layer. You need to secure stuff and you need it to be true. There's no way to be true in a world where 50 million AI agents can scale in one day. I mean, we're launching 10,000 meme coins a day right now. And now I think in the space of a month, I think there's probably 50 AI agentic things. They're not all fully agent. Again, it's very early testing. So we're going to need to prove who is who, what content is real, what content is AI, what is AI, and we're going to have to prove a whole bunch of other things, and we're going to need to have instantaneous payments for all of this stuff. If you think of another way of explaining agentic AI is Tesla is going to have robo-taxis, and we will be paid to use our cars. It's a very much easier way to use a cryptocurrency for streaming payments, for micropayments. It happens instantaneously. You don't get a banking system in the middle. You don't have anybody in the middle. So there are so many ways. Robots as well will get paid. Crypto is the way. So that's where it's all going. It's all the same thing.
So short way saying that in 2017, I said that AI is going to need blockchain, not the other way around. And so in AI, in 2017, when I launched the kind of first combination of smart contracts and machine learning on devices on the edge, that's when I said, if crypto is never used by humans, it will be used by AI, because that's the only way that they will be able to operate, and that's the only way that they'll be able to pay each other, right? They're not going to go into a Wells Fargo account and pay each other, right? So they will need another way to communicate. And so that's just a short way of saying it, and absolutely coming. And we just had that conversation, so Dan has a lot to comment on that. We've seen some deals, definitely looked at it. And I do think in robotics, absolutely, Raul's correct. Those are first things. I think a lot of it out there, what you see in AI is probably wrappers, and those investors in the room probably seeing the same thing. I think in robotics, it's real. It's payments, it's real. And then with meme coins and the rest, if you're into that, it's absolutely real. I mean, just in the last week, you anymore, as a human, you can't keep up anymore. I think it's just almost impossible to keep up with what's happening.
Dan, would you like to add anything?
Oh, I just say I think the intersection of AI and crypto is very, very important. That if you think about it, OpenAI isn't open; it's controlled by very centralized thing. And I believe strongly that AI is so important that it has to be decentralized and it has to be community controlled, community governed. And the current generation of AI models have literally already read the entire internet. There's no more free data. They're going to have to start incentivizing people to contribute data, and blockchain is the way you do that.
Great. So we have about 2 minutes left.
Also, just want to add one thing.
Sure.
The other thing I'm trying to think through, and I don't know if it's correct, is these open source models are so important that it feels that you need a blockchain to protect the actual code, because it's freedom and it's truth, and somehow that you need to protect these from government interference. And I don't know if that can be done, whether code goes on chain in this way and whether it makes the difference.
Or you mean the interference from other AIs?
Yeah.
But so how does that work, though?
Well, if it's on chain, you can't change it. It's the only way. There's something I'm trying to get through my head. This open source thing is, I think, a much bigger thing than people realize, because you're going to hand the keys to AGI to one person? No way.
My last question, I want to do a rapid round. I want to go around the panel and ask everyone, if we were to gather here in a year time, what do you think we'll be talking about? Sorry to pick on you since you're on my left-hand side.
I think we'll be talking about the same things, but looking back yet again in how far we've come. I think really it's, when we always look back, it's like, wow, we have come this far with all of these hurdles. Now, if we've got the wind behind our backs, how far can we go? So I think that will be that.
I think we'll be saying, last year there were 50 people in the room. Next year there'll be 500, and we'll all be nervous about whether we should be exiting something.
That's right. That's exactly right.
Well, I mean, I think we'll be measuring our progress. I mean, at least we will, on the policy and the regulatory front of what did we actually get done now that we have the political alignment, the political will in place. Now is what did we operationalize? What regulatory clarity did we achieve? What legislative priorities were completed? The strategic Bitcoin reserve, I think that's definitely going to continue to be a big topic of discussion.
Very busy year.
It's going to be awesome.
Crazy busy year.
Anybody who wants to join, we're a nonprofit, and we're here to serve this community. So we need all the help we can get, and everyone is invited. It's very exciting.
I think we'll be probably talking about, either I wish I invested in all these coins last year when these guys were on a stage, stable coin platforms, or you probably won't be here. It'll be sailing because you'll invest in some of them. It'll do well. And I think on a serious note, yeah, I think it's correct. We'll talk about, probably a couple of exits. You'll talk about number of different institutions that are going to start looking at this in a serious way. Banks probably as well, in an interesting way. On the payment side, Visa for sure is going to come out with some interesting things and similar. So I think a lot of movement. I still don't think we will be talking about, at scale RWAs or, that is, I think that's still going to take a little bit just because there's no two-sided marketplace yet, but for kind of larger crowd. But I think, yeah, some of these topics will be, and AI, obviously.
I love that question because that's why I love investing in blockchain. I have no idea what we're going to be talking about in a year. There's always something super cool that comes out that you had no idea. The one thing I know we're not going to be talking about, and spending half of every panel I've been on for a year, regulatory uncertainty.
Great. With that note, we'll end our panel. Thank you, everyone, for your insights, and appreciate you staying till the very end.
Thank you for coming to our panels regarding the future of digital assets. Please join us upstairs in Hall 2 for the 2024 FinTech Awards, happening right now.